sessions. There's 2 minutes before 9 at a crucial couple of the audience.
Do you want to hide the videos? I think you need to, or you can do it better if you like get the intro.
Okay. Good morning, everyone. Thanks for showing up early. We have a packed schedule today, so we'll get right to it. Alicia. Maybe get to it.
Yes. All right, good morning and thanks for being here. My name is Elisa Belfiori. I'm coming from Torcuato di Cella in Buenos Aires in Argentina. And this is joint work with Dan Carroll from the Federal Reserve Bank of Cleveland and Sean Hull from Dallas Fed. This is a paper, the paper is called Unequal Climate Policy in an Unequal World. And it's a paper about optimal taxes in a world with inequality. So the paper studies climate policy in an economy with heterogeneous households. We have clean and dirty consumption and a climate externality that arises from consumption of the dirty good. The paper has 3 parts. It begins with a data part in which we show that we document something that is well known, but we did some data work here. Which has to do with the carbon footprint of low-income household consumption. So we document that low-income households have a higher carbon intensity. I guess I have to talk to this one, per dollar spent. And so if we put a carbon tax in this economy, the carbon tax potentially can be regressive. So then we go and build a model, and this is a theoretical part in which we model an economy that captures the fact that low-income households spend relatively more on dirty consumption. And we characterize how the optimal carbon taxes look like. We know that the optimal carbon tax will follow a Pigouvian rule. And so in particular, we look at how this Pigouvian tax will look like if we take into account that households are heterogeneous with this feature, that low-income households consume relatively more goods that are intensive in carbon. And then we do a quantitative assessment. We bring the results to a model that resembles income inequality in the US, and we say, well, how the carbon looks, how the carbon taxes should be in an economy if the economy is like the US. And what we do there in the quantitative example is to quantify the effects of the taxes on the economy, the climate, and also the overall welfare. So why did we write this paper? Why does inequality matters for climate change? In general, as an economist, and for a long time, we thought about, or maybe we still do, think about climate change as an externality. It's an efficiency problem, and the externality problem is at the heart of climate change. But more and more, I think we are moving into thinking about that the problem is not only the externality, but also the inequality problems associated with climate change. And inequality matters in many dimensions. It matters across countries. It matters across generations. How in the current generation, I have worked a lot on this, how to design policies that take into account the welfare of future generations. And it matters across households. So among all these dimensions, the paper is going to be about the last one, taking into account the inequality across households within a country. So what is the empirical fact that motivates a paper? What moves us to say, well, we are going to write a paper on this? We documented this fact. This is income decile. And this is the CO2 equivalent emissions embedded in carbon in household consumption. This comes from the consumption expenditure survey in the US. And so what you see is that low-income deciles have per dollar spent a higher content of CO2 in consumption. So if we put, of course, the high-income households consume more, and so they pollute more, but per dollar spent, the low-income households pollute relatively more. And then if we put a tax, it's going to hurt more the low-income households. And this has to do with the consumption composition, the consumption basket composition. So low-income households have most of the basket already exhausted in consuming food, transportation, and energy, and these are three high polluted categories in consumption. So we want to capture this fact. We say, okay, this is a fact we know then in advance without doing anything, that if we put a carbon tax, it's going to be bad for low-income households. So what do we do with it? We will want to have a model in which we capture it. So this model is going to have the externality embedded in consumption. It has nothing to do with production, with renewable energy or energy sectors. Everything has to do, the dynamics are built over consumption. And then the question is, the second question we had to address is, how do we think about climate policy? So we want to still think about climate policy as a policy to fix an externality. That is what we want to do with climate policy. So we don't want to think about, okay, I want to do climate policy to do redistribution. We don't want to solve existing inequality doing climate policy. Climate policy is supposed to be addressing the climate externality. But having said that, we also want to acknowledge that the climate policy itself has redistributive effects. So we take a stand on what is the optimal, the climate policy we are going to look for. And in particular, we want to think about carbon taxes that are neutral in terms of the initial income distribution. So I want to think about an economy that has inequality. There is an income distribution. If I put a carbon tax, that is going to be regressive. So I want to put a carbon tax that after the tax keeps the same, the initial income distribution unchanged. And we are going to call that neutral carbon taxes. And those are the taxes that I'm going to be characterized. So the climate policy we are after is a climate policy that fixes the externality, but also undoes any redistributional effect associated with the climate policy itself. And what is the main result of the paper? Is a Pareto improving result, a win-win climate policy. What we show is that the benefits from doing climate policy, having or reducing carbon emissions, compensate any disutility that arises from changing the basket. So we are going to be changing the basket of households, trying to make them consume more cleaner goods. So people will not like that. But the benefits are higher. There are not going to be any income effects. And what we show is that we can design, if we design the policy well, the policy so that everybody is better off. Current generations, future generations, low-income households, and high-income households, everybody is better off with the policy. So let me jump into the model. There is going to be an economy populated by a continuum of households. And there is going to be two consumption goods, clean and dirty goods. And this is what I said, is we are going to think that dirty consumption leads to carbon in the atmosphere, and this is going to be what leads to an externality. So this is a carbon cycle for those of you who are familiar with integrated assessment models. This is how the climate enters into the economy. Consumption of the dirty good leads to carbon in the atmosphere, and there is a natural rate of carbon reabsorption, which is delta. But otherwise, carbon, it keeps accumulating in the atmosphere as long as people keeps consuming dirty goods. Okay, so the externality is totally built over consumption. Then the other feature that is going to be important in the model is that we are going to take, okay, so the externality is going to take a utility cost. This is the welfare loss from climate change. Every damage associated with carbon emissions is going to build into the damage function in the utility function. This is a modeling assumption. It can also go into the production sector, but because we are not modeling production, here it's going to be built in welfare. And we use a Stone and Jerry utility function because this is going to lead us that even facing the same prices, low-income households will spend a relatively larger share of consumption in dirty goods. And this is because of the non-homotheticity of the utility function. So this is going to be another of the modeling choice that we do, motivated by the empirical fact. We want to capture that in equilibrium people with low-income households consume more in the basket of dirty goods. And this is the whole economy. For now, it's gonna be an endowment economy. Later, we open it up to being a production economy. We want to do optimal policy in that economy. Optimal policy, the optimal carbon tax is gonna come from trying to maximize social welfare. So there is gonna be some Pareto weights over the individual welfare. And I'm gonna choose to maximize welfare subject to I have to take into account the carbon cycle, and I'm gonna take into account that the economy will not be able to consume in clean and dirty more than the endowment, right? So this is gonna be like the first best, and I'm gonna just characterize 3 cases. This is gonna be the first best, saying, okay, I just can do what is the best that I can do, right? So, and what we do is we try to characterize what we call the social cost of carbon. This is the key element in these models, which is that is associated with the Lagrange multiplier on the carbon cycle. So what we want to do is to price the externality. The price of the externality is going to be the shadow value of carbon emissions divided by the shadow value of the consumption good. So what's the price of carbon emissions in terms of the consumption good? And usually, like in the first, so this is going to be the element I will be looking at. And usually the social cost of carbon in the first best is going to be just homogeneous for everyone. So it's going to be equal to the social cost of carbon, and the externality is valued at the mean consumption. So if in the first best, and if you think about here like a representative agent economy, the formula that we have in mind is that we need to price the externality at the marginal utility of the representative agent, right? But the thing is that the homogeneous carbon tax is going to have, in an economy with inequality, implied a set of transfers. So in order to be able to tax everybody the same, I have to take from the rich and give it to the poor, because otherwise the poor will not be able to afford the high carbon tax. So this will be the first best. Now we want to think about, this is going to be what would prevail in a representative agent economy. We want to think about this same policy, but in an economy with inequality. So now, as I said, I want to make sure that I keep the initial distribution unchanged. So the optimal policy design in this case will have to take into account that I have to take into account the budget constraint of each of the consumer. So I'm going to be able to charge you, but I'm not going to be able to take resources from you and give it to him. So this is the way in which we are thinking about climate policy, not as a way of doing redistribution, but we want to think about climate policy as fixing the externality and keeping the market constraints. So this is what we call the constraint optimal climate policy. We solve the problem again. Now we are ruling out the possibility of doing transfers across agents. And what we find is that in this case, then, the optimal carbon tax is going to be, again, equal to the social cost of carbon. Remember, the sigma is the Lagrange multiplier on the carbon cycle. But what changes is how do I price the externality? And so the optimal thing to do, if you let me choose what is the optimal carbon tax in an economy with inequality, is to say, well, I'm going to charge each of you in terms of your private valuation. So of course, $1 unit of $1 of consumption is more valuable for low-income households than high-income households. And so that will lead that, okay, then the optimal carbon tax is going to be higher for households with high income than low-income households. So these are going to be the main theory results, and we stated in terms of the proposition. The first result is going to be, if you let me choose, then the optimal carbon tax in an economy with inequality is going to be unequal, and in particular, it's going to be higher for wealthier income households. And again, this is not making redistribution with climate policy. I'm just taking into account that the private valuation of 1 unit of consumption is higher for low-income households. And that the policy keeps the distribution unchanged, because the other component of the household is that whatever I charge you, I rebate it back to you. So I'm not doing transfers, but I'm just taxing and rebating back to you. So the income distribution remains unchanged. Whatever was affordable for the household before the policy is affordable after the policy. And so the main insight I want to convey is that the constraint efficient carbon in an heterogeneous economy is heterogeneous and it is progressive. So it makes sense to think about a progressive carbon tax system, and that this comes out as the optimal policy prescription in a model. Now you may think, or you may say, well, this is difficult to implement. I mean, I have to design a tax per each person. And actually everybody is talking about an homogeneous carbon tax. So we might think, well, can I get an homogeneous carbon tax out of a heterogeneous economy? Is it possible to get, and how, in that case, how does this tax looks like? So in order to be able to get an homogeneous carbon tax, if you have an economy with inequality, you must impose that as a policy constraint. I must say, well, now I want to design the best policy that I can, given that I have to charge everybody the same tax, right? So that has to be an extra constraint that is going to look like that. We are not going to go into the details. I can solve the problem again. Now I'm constraining myself as a policy designer to tax everybody the same tax rate. And my question is, well, what is this tax rate? Is it the same as in the representative Asian economy? What is the tax rate looks like? And so this is the main, I guess, theory result, which is a characterization of the optimal carbon tax with heterogeneity. And here what we find is that, again, we are going to be taxing a Pigouvian tax. So we want to tax the social cost of carbon. That is going to be the tax rate. But then in terms of the pricing, we are going to price the unit of consumption in terms of a weighted average of marginal utilities, right? So the marginal utilities of the individual consumption is going to be weighted by individual consumption levels. And notice that the tax rate is homogeneous for everybody. So yes, you can do an homogeneous carbon tax, but you have to design it well. You cannot go and price the externality to the mean or to the average utility of consumption. And in particular, the other thing that we get is that typically you will get out of this tax rate a lower tax, right? So if you have now to charge everybody the same, and you know that you are hurting low-income households, the optimal tax rate, constrained optimal tax rate, constrained to the fact that there is inequality in the economy, are constrained by, and also constrained by the fact that I have to charge everybody the same, then the optimal tax rate has to be lower. But the good thing, and so that will be the second remark, that typically the tax is lower and it has to be a weighted average of marginal utilities. So in the last 3 minutes, I guess, I want to give you some sense of the quantitative results. So what we do is to say, okay, we have this tax, we know how to design this tax well. I want to put this in a quantitative model. So we take the heterogeneous agent model that people use to think about income inequality. I didn't bring the model here to the slide because of the time, but think about the models that people use to study inequality in the US. Heterogeneous agent where people can work and they have capital, and they also choose between clean and dirty consumption. So we are going to calibrate that model to replicate the income inequality in the US. And we are going to put the optimal carbon tax in that economy. And the income inequality after the tax is going to be the same as the initial one. This is by construction. We design a policy that keeps the initial income inequality unchanged. So we calibrate the preferences so that we can replicate that the carbon footprint of low-income households is 30% more than high-income households. That is empirical fact. We calibrate the technology and the shocks to replicate the income inequality in the US. And this is what we get. We get a carbon tax that, 1 minute, starts in 40 and then increases over time. This is a carbon tax because we calibrated everything to replicate in a representative version of the economy to replicate the goals of a North result, which is like a carbon tax of about $60 per ton of carbon. So we get values that are about the same. Now, the first feature of the carbon is that it's not flat. It's not that I can do a flat tax. It has to be increasing over time. And the panel on the right is the heterogeneous version of it. The lower, so the tax for the low-income household starts at 10, and then for high-income households can go to up to $190 per ton of carbon. We look at what we do for the global temperature, and what we find is that this is temperature increase over with respect to today. And so we don't get much action in terms of the climate. And this has to do with the social cost of carbon that is not too high in current calibrations. And so if we compare to business as usual, the constraint optimal carbon tax is able to reduce temperature by about 0.5 degree, but this is compared to now. So if we think about Paris agreements, that we need to just have like 1.5 increase in temperature compared to pre-industrial level, we are just very far above. But I want to finish with this graph, which is the welfare gains from the policy. So these are the welfare gains relative to business as usual. And what we see is that the welfare gains, this is with respect to wealth, and this is with respect to income. And then, as you can see, everybody wins. So all the numbers are positive. Everybody wins. This is even with the uniform carbon tax or the heterogeneous carbon tax. It's very it's a powerful result that usually you say, well, because the carbon tax must be regressive, well, we cannot do a carbon tax or something. So we can design the carbon tax so that even low-income households are better off. I'm going to finish with this. We derive optimal carbon tax rules for economy with inequality. We apply them in an heterogeneous climate economy to quantify the carbon tax effects on climate and welfare, and we find a Pareto improving result. This carbon tax, as I said, it has to be, if I can, heterogeneous, otherwise I can do it homogeneous, but I have to design it well, and they imply rebates back to people, to individual people, not transfer across people.
Okay, good morning, everybody. Thanks for having me. This is a paper about insurance markets. I should tell you, I'm Jed Boomhauer. This is joined with Meredith Valley, Jacob Gelman, and Andrew Plantinga, who hopefully are all asleep right now. They're all in California. That's how I feel, but I'm here presenting to you. So this paper is going to build very nicely, I think, on everything that Catherine and Claire told us yesterday, and they're going to make my job easier in some ways in terms of motivation. And I will also say that I've taken a 90-minute talk and reduced it down to something closer to 20 minutes, but there's still going to be probably more to get through than I should have given you. So there are places in this talk where I'm going to aggressively skip. And if you want me to slow down, tell me to slow down. But I think Claire and Catherine did a nice job of setting the stage and telling us that one of the best opportunities that we have potentially for mitigating the welfare cost of climate change is to make insurance markets work better, at least where I live in North America. And I think around the world, there are lots of concerning signs that those markets might not be handling climate risk as well as we would like them to. Here, many of these exact same bullet points appeared in Catherine's talk yesterday. So I'll just remind you that there are a few reasons that climate risk is a challenging problem for the insurance market to handle. One, aggregate risk, catastrophic risk means that firms have to think about protecting their solvency, which is expensive. Many jurisdictions put a lot of regulation on how firms can price this risk and how quickly they can adjust their prices in response to changing baseline risk. But this paper is really mostly about these information problems that I think have received less attention than the previous two bullets. So Catherine told us yesterday that because the kinds of weather disasters that we're thinking about in this context are relatively rare, thankfully. There's not much of a historical record for applying traditional actuarial methods that insurers usually use to price perils like car accidents and heart attacks. And by the way, the fundamental risk is changing, which makes that historical record even less useful potentially. It means that to the extent that insurers are going to try and price this difficult to model risk, they are going to be fundamentally reliant on simulation-based stochastic models that are in themselves just inherently uncertain and will never know to some extent whether they're correct or not. And they're also actually quite expensive to use, especially the sort of leading the frontier models right now. And so we're going to think in this paper about insurers making a profit maximization decision about how much to invest in modeling and risk segmentation. And by the way, when you start to think about insurers competing in a single market to offer coverage for these difficult to model perils, then you have to, insurers have to start worrying about something that looks a lot like a common value auction. So everyone who knows their basic IO knows about the winner's curse in a common value auction. The way that that's going to come through in the setting that I'm thinking about is if Catherine and I are competing in a market to insure Claire, if I offer Claire a lower price for insurance than Catherine does, I have to worry that she knows something about Claire's risk that I don't know. So we're gonna take all of that intuition, and our empirical application is going to be the homeowners insurance market in California, which is where I live. I will just tell you quickly, and the peril. So the climate peril that's most relevant today in California is wildfire risk. I'll tell you quickly that this is a risk that's a peril that's growing rapidly. Historically has been less important than hurricane wind and floods and others, but the rate of growth is a lot higher right now. And if we were in the US, I would try harder to convince you that California is relatively important within the United States, but I'll just ask you to believe me about that. And the other thing that's been happening in California in particular is that we've been seeing very quick increases in insurance prices and surprising reduction in the availability of private market insurance, particularly in high hazard areas. Okay, so the question that we're going to think about in this paper is how are information problems and regulation, and particularly the interaction of information problems and regulation, affecting insurance prices and availability in this market. And we do three things in the paper, and I'll tell you what those three things are, and then in the talk today, I'm going to take you through a subset of them just for time. But what we do in the paper is we provide some sort of new descriptive evidence about how the players in this market are actually modeling and pricing wildfire risk that comes from regulatory filings that all of these firms are making public as a result of insurance law in California. We'll show you that there's a surprising amount of differences across firms in terms of how they're thinking about these risks. And then we're going to step back and we'll think about developing an empirical model of what we would like pricing to look like in a perfect market with complete information and perfect competition. We'll take that as sort of our benchmark cost of offering insurance in a market with catastrophic climate risk. And then we're going to use some fun data that I'll tell you about to actually estimate the relationship between the prices that firms are actually charging in this market and that benchmark gradient. And we'll develop an equilibrium model to sort of think about what explains the differences that we're seeing. So at a very high level, what do we find? I told you that we find this striking variation in risk classification strategies across players in the market. And then we're gonna show you that variation in pricing alone is potentially sufficient to generate significant adverse selection. We'll do some kind of simple benchmark stylized examples. And then we're going to turn to, as I said, the actual empirical relationship between prices offered and assessed wildfire risk. And I'm going to show you there that firms appear to be behaving in a way that's consistent with what a rational player does in this kind of market, which is to be conservative. And by conservative, I mean to price high and to be careful about which markets to enter. And then we use the equilibrium model to show you how that selection problem interacts with price regulation in a way that potentially restricts supply of insurance. And to the extent that there is a pithy policy takeaway, I think one pithy policy takeaway is that lowering the cost of accessing and using the best available information to price these risks can potentially make these markets work better. Okay. This is one of the sections that I'm going to aggressively go through. If you really care about the institutions of insurance regulation in California, find me after the talk. But I'll tell you that in the United States, wildfire is covered under what's called a multi-peril homeowners insurance contract that covers lots and lots of different risks. Every mortgage lender in America requires that home buyers have this coverage. We have 30-year fixed rate mortgages in the state. It means very close to 100% of US homeowners have homeowners insurance. In high hazard, either high wildfire, high hurricane, tornado, hail, other high hazard areas of the US, it has recently become more difficult to get this coverage. I think that's all I want to tell you on this slide. Now if you're confused, I'm sorry, find me after. I promise we're saving time for the more interesting stuff, what I think is more interesting stuff. If you can't get coverage through a private market insurer, this is what I was going to tell you on the previous slide, there exists in most states in the US a public backstop option for you to buy expensive, low quality insurance. Okay. The California Department of Insurance is the regulator in the setting that we're looking at. There are some particularities of California insurance regulation that, again, I'm going to go through relatively quickly. But what I want you to internalize is that these regulations make it difficult and expensive for firms to change their prices quickly, even if costs are changing quickly underneath. And then there are also some limitations on the information that firms are allowed to bring to their pricing. And we'll talk more about that as we go. Okay, one important piece of background that I do want to spend a little time on is just to talk about all of the innovation that has been happening in wildfire risk classification over the past 15 years. So this is in some ways kind of a climate adaptation story in itself. 15 or 20 years ago, wildfire risk to homes was not a quantitatively important part of the losses that insurers considered when writing homeowners policies. That has changed dramatically. And as that risk has increased, innovators have innovated and come up with better ways to model this risk. And one would think that would make the market work better. So as recently as 10 or 15 years ago, this risk was priced through broad kind of territory, zip code, postal code, or county level factors that are quite coarse. And then there's sort of been a second generation of GIS-based parcel level scores that are kind of high, medium, low and get a little better. And the real sort of frontier of wildfire insurance modeling these days is to adapt the kind of catastrophe models or CAT models that have been built for earthquakes and floods and hurricanes to this new peril of wildfire. These models have a lot of promise in terms of delivering like dollar-denominated estimates of risk, as well as the variance and the covariance of risk across properties, which is going to be important as we'll talk about. They are, as we said, fundamentally uncertain, but this is kind of the frontier, and this is where the arms race is right now to develop better models. Okay. So building off of that story about innovation in risk screening, let me show you just some descriptive data about the degree to which these advances in wildfire risk pricing have been adapted by different players in the California insurance market. The reason that we know this is because we put together a lot of information from regulatory filings with the California Department of Insurance. It turns out that there's just like a striking degree of variation in the granularity and sophistication of wildfire risk pricing, even across the very largest firms in the California homeowners insurance market, which is a large and important market. So this slide is showing you on the left there, the top 10 homeowners insurance groups in California with their statewide market share, as well as their market share in high wildfire hazard postal codes. And then what we've sort of appended on through our work with the rate filings is our best summary of the information that each insurer is using to price wildfire risk. And you can see in this column, I'm showing you sort of the physical unit, the spatial unit that this firm uses to bin customers together for pricing. State Farm, who happens to be the largest firm in the market, is also the leader in terms of the sophistication of pricing. So they've divided the state of California into 400,000 1 square kilometer grid cells. They've run a wildfire catastrophe model to generate a predicted loss in each grid cell, and that's how they price wildfire risk. The other two big players in the high hazard regions also do something pretty granular with thousands or tens of thousands of segments. And then the rest of the market is still doing relatively old-fashioned, pretty coarse wildfire rating. And there's a lot more information in the paper about what these different classifications mean. This column is this is a measure that we can generate with our data for a subset of the firms. This is just telling you a firm using the indicated method of segmenting could predict what fraction of the actual variation in wildfire risk that we can see in our data. So again, there's more details on this in the paper, but you should interpret this as telling you that State Farm's model, the ceiling on how well it could do in terms of predicting wildfire risk is an R squared of 0.82 relative to Allstate, which, just because it's so coarse, could only ever predict 20% of the risk. Okay. So then there's a natural question: how does this persist in equilibrium, right? How is it possible that for this big money risk, you have different players that aren't all using the best available method? And there's sort of a collection of cost stories that we think explain this, including just the pure fixed cost of licensing and adopting the best models for insurance use, as well as the complexity costs of adapting the firm's back-end system to do all this granular pricing, and potentially significant regulatory costs, especially in California, to convince the California Department of Insurance that this complicated pricing method is quote unquote actuarially justified for your book of business. And there are reasons that we can talk about afterwards that that's particularly difficult in California. Okay, so what we use, let me tell you a little bit about the data we're going to use in the empirical analysis. So we have a data set of 100,000 randomly selected homes in high wildfire hazard postal codes in California. And what we know for each of those homes is some information, and this, I should say, this all comes from CoreLogic. We know from CoreLogic a collection of variables that are actually used by insurers in the market to price insurance. Those include, among other things, CoreLogic's wildfire risk score, which is an important input in the pricing formula of some companies. We also know how much it would cost to rebuild the house, the quality of the local fire department, other things. And then we have, from a wildfire catastrophe model, what we're going to think of as sort of the best scientific predictions of the expected annual wildfire losses for every one of these houses. Okay. I will just tell you very quickly what we do with that data is we put it together with all the data that we've scraped and collected from regulatory filings, and that is sufficient for the 100,000 homes in our data to reconstruct the exact insurance price that most of the major insurers in California would offer to a given home. So we're going to observe sort of a menu of price options across insurers for each of the 100,000 homes in our data set. That's going to include firms that price in a relatively granular way, as well as firms that price in a relatively coarse way. I'm not going to take you through the development of the cost-based benchmark, but in the paper, we think about sort of how to calibrate what the price of insurance should look like in a competitive market with perfect information, which is, of course, going to depend on expected losses due to wildfire, expected losses due to other perils, because this is multi-peril insurance. And then this is the important thing. This is the catastrophe or risk load term that goes back to Catherine and Claire's talk. These firms need to purchase reinsurance or hold reserves in low return accounts. And so we're going to calibrate essentially what the risk load is in California. That's in the paper. These guys are not the important thing to remember is that these guys are not pricing risk at the individual property level. They're doing some degree of pooling, right? And firms are pooling in different ways. I'm sorry to skip these, but the important, when you start to think about this pooling and in particular firms pooling differently, as I've shown you, firms using more granular or less granular segments. Now we start to get sort of the intuition for the adverse selection problem, right? The firms that are setting prices based on inferior information are going to end up potentially serving higher risk customers. How does that work? Well, the less informed firm by construction has to offer a single price to all the customers in a given segment because they can't tell them apart. The more informed firm is going to differentiate prices within that segment according to risk. And then if you just imagine in the simplest case that this is a homogeneous product market and households always choose the lowest cost insurer, the lower risk households are going to see lower prices from the more informed firm and higher prices from the less informed firm, and you're going to end up with this mechanical selection problem. You can write that mathematically with that equation that says, essentially the same thing that I just said in a more parsimonious way. But basically the expected losses in a segment, given that customers prefer to get insured by me relative to my competitors, are larger than the expected losses in that segment overall. This does a lot of work here, right? And so the demand side, the consumer choice problem, really determines how severe the adverse selection problem is. Ideally, one would be able to work with transaction level data to know who's being insured by whom, and then you could absolutely nail down precisely how large that selection is. That we are not able to observe who's insuring whom, and it's not clear that one would ever be able to get that information. So what we do in the paper then is we work with sort of a variety of assumptions about switching costs and attention, and those give us sort of different degrees of selection. There's a lot of calibrations in the paper that sort of show you for most plausible values, you get potentially significant adverse selection. So what I've done so far is I've kind of set up the intuition of the paper, and I know that I'm right up against time, so I'm just going to tell you what happens in the rest of the paper. We use that all of that risk data and insurance pricing data that I told you about to estimate what we call these wildfire risk price gradients, right? So we think about, for a given insurer, the average price that they're charging for homes in a given risk category and the average wildfire risk associated with homes in a given risk category. That's what these two regressions in the paper estimate, with a bunch of other things that are just holding constant reconstruction cost and other variables. There's a fun within zip code identification strategy that takes care of some omitted variables concerns. And at the end of the day, what we get are these segment level price gradients. So there's a lot of pictures in the paper that look like this. I'll just, because I'm short on time, I'm just going to focus on this one panel on the left hand of the slide. This is Allstate's wildfire risk price gradient across the 100 segments, risk score segments that they use for pricing wildfire risk. So this again is coming from the 100,000 homes in our data set. Each one of those homes falls in a different one of these risk segments. There's about 100 risk scores here. And this is showing you on the horizontal axis the mean wildfire expected loss for homes in each of those segments according to our wildfire catastrophe model. And on the vertical axis, we have Allstate's annual homeowners insurance premium, which again is covering not only wildfire, but lots of other perils as well. And so the relevant object here is the slope of this gradient in a market that was following sort of our benchmark, quote unquote, cost-based gradient. That would be about 1.18. Because the 0.18 covers the risk financing cost. Allstate is charging something substantially more than that. We see the same thing for the other insurers in our data. That's consistent with this idea that firms are behaving rationally and correcting for selection, particularly the firms in our data that are using less granular information. So I will just say then, in itself, that selection problem is interesting and does interesting things in the market. It pushes up prices for the uninformed firms. It also pushes up prices for the informed firms who exploit their superior information to earn profits. It doesn't collapse the market in the way that traditional adverse selection in health insurance does. However, when you layer price regulation on top of this selection channel, then you can create real issues in insurance supply. And the idea here is that a price cap that would accommodate pricing at segment average cost is actually going to restrict supply if it prevents firms from marking their prices up as much as they feel like they need to mark themselves up to protect themselves from selection. Okay, so I realize I'm at the end. I'm obviously not going to take you through the equilibrium model, and I'll just leave that up there to tell you what we're back. Thanks for your time.
Hey, great to be here. Thanks for the offers to include our paper in this nice conference. This joint work with Mark at Wake Forest and Wei Ting at Duke and Juan Carlos at Stanford and Daniel also from Duke. So what we're thinking about in this paper is this idea that in a world of regulatory differences, sort of economic theory tells us that pollution will really move to the less regulated places. And this is sort of an idea that's been put forth in like the empirical literature from the early 90s onwards. But when we look sort of 30 years on, the cross-country data has actually told us very little in terms of how important this effect is. So what we're going to try to do in this paper is we're going to try to do what sort of we've learned from empirical macroeconomists, which is to use subnational information, subnational variation, where we have a much more controlled environment and can be much more precise about the kind of variation we're using to estimate these pollution haven effects. And what we're going to do in particular is we're going to look at the case of the Clean Air Act that creates differences in regulatory stringency across the US. And we're going to try to leverage that to estimate sort of potentially an upper bound of how large these pollution haven effects can be in the context of a very well economically integrated case. And this is sort of building on the large literature that already looks at sort of what this literature calls the direct effect of the Clean Air. So how do the plants and factories that are regulated by this regulation, how are they affected in terms of their economic activity? But what even this literature very quickly had to acknowledge is that these sort of different studies sort of inevitably run into difficulties of whether they actually capture local effects, whether those local effects are contaminated by spillovers, and they really also can't really tell you much about the aggregate effects of such policies. So what we're going to do is we're going to try to revisit how important those spillovers are empirically. So we're going to try to show you like a lot of reduced form effects around that. And then we're going to use, in the end, a quantitative model that eventually tries to aggregate those. So what do I mean by spillovers? So obviously spillovers could go in many different directions. So to be precise here, what we have in mind is that the manufacturing plants that are regulated by the Clean Air Act, they often serve overlapping product markets. So what we have in mind here is that there's, for example, a cement plant that's in Pittsburgh, and there may be a cement plant that's in Philadelphia, and maybe Pittsburgh is regulated, Philadelphia is not regulated, so that the plant in Philadelphia has now a competitive advantage. And these are the kind of spillovers that we're thinking about here. So to be more, so what we then do in the sort of reduced form is we're going to like look at those, we're going to first look at direct effects. So this is sort of more like bringing the modern event study policy evaluation tool to this literature that has maybe sort of done comparisons that we, I think now 20 years later, find a little bit more difficult to interpret. And then we're going to decompose those spillovers into things that happens at plants that are operated by firms that are somewhat exposed to the regulation. So these are these within firm spillovers. A lot of these firms are very large, so you can expect that they simultaneously operate regulated and unregulated plants. So we're going to look at those spillovers. And then we're also going to use publicly available data. So a lot of the things that are not related to within firm spillovers, you can actually replicate with publicly available data in a very straightforward way. And we're going to use this publicly available data to estimate sort of geographic spillover. So essentially, you're going to see this on the map in a second. There are a lot of areas that are unregulated right next to regulated areas. And we're going to find that if you are in an area that is sort of fortunate enough to be surrounded by a sea of regulation, then employment in that area goes up quite strongly. And in the end, we're gonna sort of take these reduced form effects. I mean, it's a little bit now I will show you evidence of a lot of spillovers. It'll be a little bit difficult to sort of do the accounting in your head. So what is now the total effect of that? So to that end, we're gonna write down sort of this spatial model with thin firm that has this sort of within firm component where firms can operate several plants, but also has this sort of market dimension where consumers substitute across the products offered by different locations. And we're going to use that to sort of quantify what are the local costs, what are the aggregate costs, who are the winners and who are the losers of the clean air. So to go a little bit into, give you some idea of what these policies that we're looking at. So the Clean Air Act has been in existence, I think, since roughly 1963, but the initial Clean Air Act really didn't have bite. So it was very quickly amended in the early 1970s. And sort of to give you a sort of anecdotal piece of evidence that this is really like the first time regulators got serious about the environment in the US is that this was actually the point in time when the environmental protection fee was actually established in the United States. The centerpiece of this legislation that we're going to look at are these national ambient air quality standards, which essentially are a federal guideline, a binding guideline that if a county exceeds a certain federally set pollution threshold, it becomes regulated as a non-attainment area. So it's an area that is not an attainment of this air quality standard. I'm going to try to not use that language and just simply call the non-attainment areas just regulated areas. What is the cost? So what does this policy entail? In a sense, it's sort of a broad set of command and control, a broad set of command and control requirements that these plants now have to meet. So you could think of the cost as coming from sort of potentially several different sources. There could be compliance costs because you have to hire additional lawyers that have to sort of help you figure out this very complicated permitting. So these plants in non-attainment areas, they have to file much more expensive permits that often run into hundreds of pages. There could be capital cost because these plants have to install additional pollution abatement equipment. And then there's something that I think the literature has sort of highlighted quite prominently. There's this new source review, which requires regulated plants to pass a review if they want to expand, their facilities. So this is, you can kind of think as a cap on investment. There's in some subperiods of the Clean Air Act, there's also an offset scheme where firms that want to expand essentially have to find a partner within the county that then limits their activity so that the total amount of pollution coming from manufacturing is sort of roughly set. So this map tries to give you an idea of what are the regulated and what are the unregulated areas. So since we are looking here at the case of the early 1970s, there are some issues of how to of measuring which counties are actually regulated. So the way we get around this is actually use monitor data, which is in principle what the letter of the law tells you you should follow to designate regulated areas. And what we see is that we find roughly 270 counties, a number very comparable to prior literature. We're going to look at total suspended particulates, which is sort of a catch-all for like PM10 or PM2.5. That was what the regulator deemed as important in that period. And we're not going to look at the other pollutants because this strategy of using monitors to designate counties that are regulated doesn't really work because the other pollutants are barely monitored in that time period. So it's pretty much uncertain which areas, I would say, are regulated here. Since it's only around 1/10 of the counties in the US that are regulated, you think, well, this may not be so significant in the aggregate, but actually these are the most populous regions in the US. So roughly 47% of the relevant industrial activity takes place in these counties. So to give you sort of an idea of the data we're using, so we're using confidential microdata to estimate the effect at the plant level and this within firm spillover effects. So this data set is sort of 1963, and then from 1967 onwards, we have data every 5 years, and it gives us, so we use this data for 4 major polluting industries. In the paper, we also do a robustness for the remaining industries, but these are the industries that in this literature are considered the primary targets. Given that the EPA was pretty cost constrained at this time, it is sort of, a plausible sort of starting point to look at the most polluting industries, but we find some much smaller effects outside of the set of industries. What we can do with this data, since it gives us sort of the activity status for every plant in manufacturing in the United States, we can also be pretty careful in terms of how we can measure plant entry and exit which is sort of important. Yeah,
Just curious about what is the industry,
yes.
what is the measure of polluting?
That is, I think, so we have tried to correct, so originally, this is a little bit sketchy of what was used to measure what's polluting, but you can also do this with polluting with like toxic release inventory data, and wood also measures pretty highly because of the dust, I think, essentially that is created in the process of wood manufacturing. Yeah. But obviously, I'm totally with you that this definition is maybe somewhat arbitrary. We have mainly done this because those 4 industries were what was originally labeled the targets of the regulation in prior literature. So we wanted to kind of find our hands and not look for our own definition. But as I said, we also show effects on the full range of industries. Yes, that would be cement, and primary metal is sort of steel. Yeah. And reduced harm outcomes that we're gonna measure using this data are like the change in firm activity that takes place at the sort of firm level. So do these firms move from the regulated area to the unregulated area? And then we're gonna sort of try to decompose that into a direct effect. So what happens at the directly affected plants and what happens at the unregulated plants. So this is what we're going to do with this data. So this is sort of the first stylized, you can think of this as more of a stylized fact. So here we look at a set of firms that are active in the regulated and the unregulated region. So in the white and the red of what I showed you in the previous map. And we can look at relative to 1967, so relative to prior to the regulation, how does the share of activity that they carry out in this non-attainment area, how does this evolve over time? And so you see that like from sort of 1967 to 1987, there's roughly a 3 percentage point decline. Yeah.
So reason to stop it.
There is, we thought that this is sort of like a good idea of like the medium to long run. I think we could use the county business plan to go even longer. We could even maybe also do it in the census. I think we have disclosed those results for until 1987. Yeah, we could in principle also go longer. But then I think the idea was that this is sort of the first period of the Clean Air Act, and afterwards there's like new amendments that come in. So I think this felt like sort of a reasonable time period to evaluate medium to long run effects. I think in 1990 is when the next big wave of regulation rolls in. Yeah. So this obviously captures changes of what's going on at plants in unregulated areas and what happens at regulated areas. So we are interested in, what's going to, what is potentially something, a measure of the direct effect. So what we do here is we just this is following prior literature pretty closely. We have plants that are in regulated areas, we have plants that are in unregulated areas, and we compare them before and after the regulation. And we are a little bit careful about how we construct the control group here, since we don't want to exaggerate those effects by comparing to the sister plants that are unregulated. And we also exclude some plants that eventually face, there's like a smaller set of plants that faces regulations for other pollutants that we are also excluding that here. And we are doing this all in a sort of PPML framework to account for the possible exit of plants across time. And this is sort of what we find here. So these effects are, since we sort of have this more long run data, and we are looking at a potentially more narrow set of industries, we find like some very large effects on employment and sales. So you see that relative to plants that are in the unregulated area, we find a 29% decline in sales and like roughly a 26% decline in employment. But what I would like to emphasize is, if you sort of to give you an idea of how to think about this number, this still captures potential SUBPA violations to unregulated plants that are maybe not part of regulated firms, but that are still exposed to these sort of that are still benefiting from the competitive advantage of being in the unregulated area. So we sort of think of this as like overstating the direct effect. So you shouldn't think of this as the causal effect of the policy, but this is sort of the relative effect of the policy. And I think in the paper we also look at energy that follows a similar follows a pretty similar trajectory, and we also show that there's substantial evidence of plant exit. So this is why it's important to use this PPML method to account for the effect of exit on sort of average employment. Now we want to see what's going on at unregulated plants that are operated by these partially regulated firms. So what we're going to do is we're going to construct this exposure variable that tells us, well, how important, how big was the regulatory shock to the firm in terms of the distribution of its plans prior to the policy. And we're going to see whether plans that are more heavily, firms that are more heavily exposed to the regulation, whether they disproportionately increase employment at plants outside of the regulated area. So we're going to use this sort of continuous treatment variable here. And in the paper, we show that these results are highly robust to just discretizing this treatment variable in one way. So the sample here, this is sort of now at the firm level. So we collapsed all these plants that are in the white area in the previous map and that have some connection to the red area through the parent firm network. And we try to see whether those that are more heavily exposed increase employment by more. And this is sort of what this regression here shows you. So we find a little bit less, we find not that much reallocation in terms of the number of plants, but we find a pretty strong effect on employment. So for example, here this says that a 10% increase in exposure increases employment by roughly 4%, or if you want to think about this, if you're above the median in this exposure variable, then your employment goes up by roughly 11%. We haven't disclosed the full distribution of this exposure variable from the census, so I cannot really fully tell you how much this now really means, but this is going to be the next step in the paper. We also see the same in sales and fuel cost. Fuel cost is a little bit more noisy because potentially less well measured, but this we find sort of pretty consistent effects across a range of outcomes. Now the next thing is okay, so the first thing that's maybe not so nice about this is that this is using confidential data, so it's kind of you have to maybe believe us a little bit. But you can do a lot of this using publicly available data because recently people have digitized the county business plan, which gives you county by industry data back to the early 1960s. So we're using this data to estimate the direct effects, but then we also are interested in spatial spillover. So you saw on the map, there were specks of red, and then right next to it was white again. So you can imagine that these white counties next to the red are benefiting. And this is sort of what we're doing. This is formalizing this here, essentially using sort of a gravity weighted average of counties exposure. So this treatment variable seems maybe a little bit arbitrary, but in certain spatial models, this can be a sort of sufficient statistic for spatial exposure. And this is this term that we call here indirect exposure. So we're going to look at the effect of treatment, but we're also going to look at the effect of indirect exposure. So this is just the result that you get when you look at the county business pattern. So you see that this is pretty consistent with what we found in the census, which we think is nice. We can also use the county business pattern because we are not sort of subject to the same disclosure requirements to do all kinds of robustness checks, and I'll refer you to the paper for that. And this is the indirect exposure. So this is again saying that if you are a county that's close to many regulated areas, you actually find that there is a competitive advantage from this regulation. So employment shifts to these counties. So now I guess I have maybe 2 minutes or so left. I mean, there's now a model to aggregate those things up. So the model is sort of a heterogeneous firm model where there is sort of a continuum of firms in every location. There's entry and exit, and then we borrow from Felix Tintelnot, who has written up a very nice paper of how to sort of very attractively model the behavior of these multi-plan firms. And essentially what that does is putting the Eaton and Corlin sort of comparative advantage structure within the firm. So each plan the firm operates has a comparative advantage relative to the other plan. And this leads to share. So every firm sells to location, but it's how much it sells to those locations depends on the comparative advantage of the plans it operates. So you can sort of use this to essentially what looks then like a nested CS structure that is sort of, again, this connection between CS and free share. I think at this point in trade we understand a little bit, but in the end, what the structure this leads to is you can think of the firm as producing as a nested CS of the different plans it operates. This comparative advantage gives rise to natural selection because firms exploit this comparative advantage. So this leads to a selection, and coupled with the fixed costs, you get you get a sort of realistic profile of more productive firms sorting into multi-unit status. So this is roughly the model. We can sort of to a first order characterize the effect of this regulation, where so this is the essentially residual demand effect. So if prices go up in a regulation, this is sort of residual demand goes up, so this pushes up revenue. But obviously these firms are it's not only the revenue in your own location J, but it's also the revenue in the other location J prime that changes. So these are sort of the spillover effects we were talking about earlier. And then we can also look at the behavior of these multi-unit firms. So the model gives a pretty nice condition, which is basically theta. This is sort of just within firm elasticity of substitution, bigger than the cross-firm elasticity of substitution. If that's true, then essentially you can have these within firm leakage effects. And now we haven't really done, so in the literature, it's a little bit unknown what is theta, but if we like take a standard value of what, for example, Felix Simpleton using his QJE paper, I'm going to skip a little bit of this. You can see here that we can match the within firm spillover effects using very standard parameter values from the literature very well. The spatial effect we're a little bit off on because I think essentially we're not calibrating the gravity structure in the reduced form in the way the model tells us to. So there's a little bit of work to do, but what I'm going to leave you with is that, you know, this very large direct effect that we have estimated in the reduced form, so I showed you is up to 30%, that this actually reflects only half of it is really the loss in the regulated area, half of it is really like a spillover in the control area, so you should be very careful in taking these sort of difference estimates that I showed you initially at face value. And this is maybe like to sort of show you why these numbers are credible. So what we feed into the model here is to generate the effects of regulation is a productivity loss of 5%, which is very much in line with what for example, Michael Greenstone, List and Silverstone have estimated when they actually sort of try to be serious about estimating productivity and seeing how productivity evolves as a function of this regulation. But since I'm out of time, I'm going to leave you with this. And I just want to highlight that I think it's important in the context of like a very integrated country like the US to take these spillovers very seriously relative to the pollution haven. You may think of this as maybe like an upper bound of how easily production reallocates, since you would think that the relevant elasticities are maybe a bit higher in the context of the US. Additionally, I think you should be careful in sort of estimating the effects of this regulation on very short run data. I think this is sort of an additional pitfall I think the prior literature has been prone to. So when you look at long run responses, you often get something that's much, much larger. And finally, we have so far only said something about the cost of the regulation, but in reality, this regulation also had a lot of benefits of decreasing pollution. We have been pretty silent on those, but there's more to come on that. Thanks so much.
Yeah, sure. Thanks very much for having me to present this project on organization and environments. Actually, at least part of the inspiration of this project really comes from the Environment Week last year, where I remember during like a one policy session, like a chief policy advisor to a national government asked this question: how should government respond to the future of climate change and environment degradation? And one explicit question I think he asked is that should the government set up a separate ministries that take care of all the environmental issues, or should they ask all the existing decentralized and regional political organizations to have an environment mandate? In other words, I think it's about how do you better design the shell of the bureaucracy to organize and incentivize local agents to achieve better economic and environmental performances. So this paper is about answering this question. Maybe you can tell me whether it's a good answer or not. So with a very simple theory on organizational form and looking at a specific empirical context of river chief system in China, I discuss how different organizational forms incentivize local agents to internalize environment-related externalities. So the theory of organizational form really comes from an earlier distinction between this functional U form versus regional N form. I'm going to go into the details in a minute, but I think a short, overview of this distinction is that this functional U form basically describe the case where all the activities are under these different functional ministries or departments. You can think of departments of, say, human resources, departments of education, of research, et cetera, Whereas that of the regional N form is describe a case where all the organizations are under the regional headquarters, whereas different headquarters they take charge of all the functions within their regions. And I would like to argue that the river chief system in China, which I examined in this paper, is a shift from this U form, functional U form, to regional N form. So prior to this river chief system in China, So water management in China is under the Ministry of Water Resources, which take charge of all the rivers in China. Whereas what this river chief system does is that it asks all the existing, say, local leaders, say mayors, vice mayors, party secretaries, to take charge of one river that flows through their jurisdiction. And in this paper, I'm going to examine the average and heterogeneous effect of the adoption of the river chief system across cities, basically implied by the theoretical predictions. So I'm not going to go through the mathematical details of the formulation. It's actually a very simple theory. I'm only just like talk through the core arguments using the following figures. So think about there are two regions, upstream region A and downstream region B, and there are two tasks, promoting the economy and protecting the environment. And there are two types of externalities that I consider in this paper. One is this task externality, which means that if you want to promote the economy, you have to allow for some of the large polluting manufacturing plants to operate, which is largely the case in many of the developing country settings. On the other hand, if you want to protect the environment, you have to at least impose fines or shut down some of the polluting factories. Okay? And another type of externality is the spatial one, which I think it has been examined extensively in the environmental econ literature, which basically says that the pollutant from upstream will be flowing to the downstream and affect its performance there through the flow of the river or the blow of the wind. So the U-form organization basically asks all the local leaders just to take charge of their economic performances. Whereas the bureaucrats at the water resource bureaus just take charge of all the rivers in China. So here, I think almost by definition, there will be better internalization of this spatial externality because this water bureaucrats take charge of they care about both the upstream and downstream performance, river performances. Whereas there will be no internalization of this task externality because how can you expect this local leader to care about the river since that is not reaching their objective function. Whereas this under this M form, which I model as this river chief system, you ask these local leaders to take charge of both the economy and the environment. Okay, so there will be better balancing between economy and environments, and of course the better internalization of this task externality. But the spatial externality is not being taken very good care of, simply because how can you expect this upstream leader A to care about this downstream leader B, who is often going to be his competitor, for future promotion prospects. Okay, and that's pretty much all my theory is all about. So I basically argue that each of these functional forms can incentivize agents to internalize only one type of environment-related externalities. And neither will achieve the first best, the surplus maximum. Although I'm not really, rigorously defining what is surplus maximum here, you can think of this as like a first best benchmark that internalize both types of externalities. Then the remaining task would be to find what is the second best organizational form. And the result is again intuitive in the sense that this M form will likely to dominate U form when that task externality is stronger and that spatial externality is less salient, which is something that this M form cannot really do. So you can understand this spillover from economic task to environmental task as some kind of the economy's reliance on its polluting sectors. Although I think I have to really define what a polluting sector is. But I think this theory basically predicts that this M form reform will the shift from U form to M form will more likely to be more successful in those areas with this high reliance on these polluting sectors, simply because that's basically their advantage. They ask the agents to internalize that type of externality. On the other hand, you can think of this intensity of the pollution externality as something that measures how much of the pollutant can flow to the downstream instead of just staying at where it is generated. Okay, and what this theory predicts is that this M form reform will work better in those regions where pollutant just there's not so much movement across regions. Pollutant just stay at where it is generated. And this is the core results for my comparative analysis of these organizations. I think a key takeaway that I want to emphasize here is that unlike some of the previous arguments in favor of this M form reform, I think most of the argument involves they ask all the local leaders to get involved in these regional tournaments to compete against each other to pay high efforts. I want to emphasize this M form reform's impact can be highly context specific if you apply this logic to the environmental settings. So apart from the, of course, the effectiveness of the effluent reform depends on the two types of externality, the intensity of that. It also depends on the relevant expertise of the river chief, the local leaders. I mean, this is intuitive because, if you are assigning this rather specialized task of river management to us as a general purpose bureaucrat, of course, it does not really always work simply because, it might be too costly of the effort, and they are not very much experienced in that task. And then it also depends on the intensity of the competition here, because you can think about if you're, all of your counterparts or competitor river chiefs, you have similarly high aspirations for higher office. Of course, you'll exert more effort and try to improve the environmental outcomes. Okay? And I think in this slide, I'm going to talk about this empirical proxies.
It's implied here that the river chiefs can't negotiate or bargain to, is that?
Yeah, thanks very much for bringing that up. I think maybe this is my next slide of the project. I think one can basically show some equivalence results between these different organizational forms if you allow for this Coase bargaining, the Coase theorem actually holds. And that is actually what is happening right now. I think in this one recent paper talk about this ecological compensation initiative in China, which basically says, there are some bargaining between this upstream and downstream regions, and there's some compensation if you just pollute too much of the upstream things. But I think this one is less empirically relevant in my context because I think because I'm looking at the river chiefs' introduction of that in 2015. That's like still a premature stage of the compensation package. And another thing is that I think I'm looking at the specific incentive of the bureaucrats, but the compensation scheme is more transferable among governments. So I have to think more about how much of these benefits of compensation can be captured by this bureaucrat themselves instead of I have to think more about that. Yeah. So I basically construct these empirical proxies for the four theoretical parameters that just mentioned above, trying to build up this linkage between theory and empirics. On the river chief expertise, I basically collect the river chief's information on whether they have prior experiences in environment management or their highest education degree they have obtained. So basically, the theory predicts that the river chief system will work better in those areas led by river chief with such expertise. I mean, this is like a simple result. Second thing, on spatial pollution externality, I captured this by the land slope of the city. This actually comes from some of the hydrological studies where they argue that if the terrain of the land is very much steep, and the slope is very steep, it's more likely for the pollutant to flow from upstream to downstream. There will be more movement across different regions. Okay, and the theory predicts that the river chief system works better in those areas where the land is very much flat. There are not so much movement of pollutant across regions. And thirdly, for the spillover from economic task to environment performance, I captured this using, I think it's a crude measure, but using the service share of city GDP, because I think I'll show you later, the pollutant variables I'm going to look at in the data sets of Monitor Station is going to be capturing agriculture and industrial pollutants. So you can think of, if a city has a high reliance on the service sector, that means it is less environmentally costly, measured in terms of these agricultural and industrial pollutants, okay? And theory predicts that this river chief system may work better in those cities with actually low service share, with high reliance on this polluting, on these agriculture and industrial sectors, which produce all the pollutants that I'm going to show you later. Okay, and then very lastly, on the intensity of competition, I calculate the variation of age among river chiefs within the same province in China. So here are two caveats of the Chinese policy. One is that I'm looking at in this paper the city level river chiefs and who are waiting to be promoted to the provincial level. Okay, and second is that these promotion decisions often determined by the upper level officials in the hierarchy. include a lot of factors. Of course, bureaucratic performances in, say, economic and environment tasks, but also political fractions, and then age, which is what I'm focusing on here, because there are like some specific age thresholds, such as if you are above that threshold, it is not likely that you'll get promoted. You will retire soon simply because they want to select relatively young bureaucrats. There used to be such thresholds in the system. So that means that if you realize all of your competing river chiefs have relatively similar age as you do, and have similar aspirations for high office, of course there will be fiercer competition among yourselves. On the other hand, if you realize that your neighborhood river chief is going to retire soon, of course you're pretty sure that you're going to win this election. So there will be less intense competition on the environment and economic fronts. Okay, and the theory predicts that this river chief system will work better in those areas with very low variation of age. Everybody is similar in terms of these age factors, so that there will be more intense competition in terms of environment and economic growth. Okay, so I think in my remaining presentation, I'm going to just walk you through some of the empirical results that speaks to the theoretical predictions that I just talked about. So this is the rollout of the river chief system across cities in around 2017. All this dark purple area, they are like the experimental regions of the river chief system, which can date back to, say, 2007, where there was like a large environmental crisis and people invent this term of river chief system to combat the crisis. But when looking, but I think in the late 2016, there is, so the central government announced to roll out and apply this river chief system to the rest of the cities in China, which is colored as orange area. And this rather staggering implementation, which lasts within, say, 1 year, is something that I will exploit for my different specification. Okay, and this is the spatial distribution monitoring station, which I obtained my water quality data from. They are very much centered around this southern part of China, the Yangtze River, Pearl River. They are predominantly the economic center of China. Okay. The data I'm looking at, dissolved oxygen. So there are basically three indicators, three chemicals from these monitoring stations. Dissolved oxygen. Here, I think the higher of that means the better quality of the water, simply because oxygen are being consumed to downgrade some of the chemicals. Yeah, so more oxygen, the better. And then this K variable and N variable, they have very long names, so I have just call them K and N. They are direct measure of agriculture and industrial pollutants. So the lower of them, that means better environmental outcomes. I also construct this Anderson type index just to get a overall idea of how the level of overall pollution. I also get city information, river chief information from the relevant sources. And then very lastly, to address this potential spillovers, a violation of the super assumption, because of the spatial pollution externality, which is what I'm emphasizing in this paper, I construct a subsample by excluding monitor stations that are too close to each other. Actually, this is also based on some of the hydrological studies on the dilution of pollutants in water, and also belong to the same river, but in different cities, so that, and all the results I'm showing today is based on the subsample, but in the paper I do compare, the different results obtained by different samples. So this is my main specification of the adoption of the river chief system. So first I'll talk about the average effect. Okay? I include this CT fixed effect, time fixed effect, and then also fixed effect for the relevant bureaucrats. I include both local leaders who becomes river chief after adoption of the river chief system, and also water resource director, because I believe they are all present in the bureaucracy. So what my estimate of this beta 1 factors is this de jure, whatever, organizational form change on river quality outcomes. I also ran this event study specification I'm going to show you right now. So this is the average effect. So you do find that the river chief system leads to around 0.1 standard deviation reduction of the overall pollution index. This is a good sign, but I think the magnitude of this effect is rather limited, especially, and it's disturbing, especially given what this initiative was introduced for. But I think this is actually consistent with the theoretical predictions in the sense that this average effects estimate may be hiding some of the rich heterogeneity of the effectiveness of this AMP form reform. So these are the, this event study diagrams. So we do find that there are some signs of improvement in dissolved oxygen here, starting from the 6th and 7th months. More pronounced effect for K variable, and then very lastly for pollutant index, we do find there are some signs of improvements or as a reduction of pollutant index after the adoption of the LSE system. Now I'm going to talk about the heterogeneity, which is what I'm emphasizing in this paper. So the specifications like this, I include this interaction term between the river chief system and the different types of city I've just, the different 4 variables I've just specified earlier. So the beta 2 estimate captures this differential impact of the river chief system on the different types of cities. So you do find that here actually expertise matters quite much. It's associated with 0.5 standard deviation additional reduction of pollutant index. And higher competition is also matters in the sense that it reduces leads to 0.4 standard deviation reduction in pollutant index. On the other hand, for those cities with below median service share and below median slope, a river chief system is associated with a 0.2 standard deviation reduction in pollutant index, whereas higher service share, higher slope, which captures low task spillovers and high spatial spillover externalities are counterforce to the effectiveness of this M4 reform. So these are, again, this event study specification, but I ran this for different types of cities. You do find some pronounced effects, the divergent paths between these 2 types of cities led by a rather experienced river chief. It's the effect is more pronounced, whereas there's not so much effect for those cities led by a river chief without such expertise. I think here, not so much effect, but you do find some differences between 2 cities, high land slope and low land slope. Again, high service share, you do find it's low service share cities, they are actually doing better than high service share after the adoption of river chief. And then finally, for the high competition case, we do find there is some more pronounced effect of pollution reduction. I guess that's pretty much it. I think going back to the question I started this presentation with, I think the optimal or second best choice of bureaucratic structure depends on the intensity of different externalities. And I would like to argue that effectiveness can be highly context specific. It depends on the type of bureaucrats you're talking about. It depends on the nature of competition. It depends on the geography. It also depends on the local economic structure that determines how much of the spillovers there is between different tasks. That's it. Thank you very much.
Yeah. Go ahead.
So we got
Principalmente, depois a gente fala, tá? Eu quero ver a opinião sobre isso. Tá. Eu fiz um trabalho desses 15 anos atrás, numa dimensão publicada.
Okay, everyone. So we're starting again. Please take your seats. Don't worry about the microphone.
Okay.
This one's enough to pick you up. Thank you.
So, good morning, everybody. I'm Mauricio Moreira. I'm with the IDB in Washington, D.C. So this is a paper about the role of trade policy in climate mitigation. It's a joint work with Lorenzo Caliendo, Marcel Dalla Bella, which is here to answer all the tough questions. Matthew, Murilo, and Fernando Paulo. So, of course, thank you, the organizers, for the opportunity. I mean, I've been learning a lot this last couple of days. So let me jump to the motivation. I think it's pretty apparent to all of us that trade policy as an environmental policy has become a very popular type of strategy, particularly among the world's largest economies. The number of environmental related notifications and measures have skyrocketed, reported to the WTO, have skyrocketed in the last decade or so. And it raises a lot of questions. I mean, there are people that are very excited about it. My childhood hero, Paul Krugman, says whatever it takes to save the world. But I mean, I'm not that sure about it. I mean, I think we have to answer this question. Does trade policy really helps to mitigate climate change? I mean, it usually just, those measures are usually just filed on carbon leakage grounds, which makes sense. I mean, everybody's going its own way, then generate distortions. But, we do have to answer questions about its empirical relevance, the trade and administrative costs of those measures, and of course, the risk of being captured by protectionist interests, which, as you all know, has been very active recently. So many of the previous work on those issues, on those trade-related carbon measures, have been focused on large economies. Of course, they are the large emitters. As Todd was saying in the previous presentation, the evidence is mixed, probably because of identification issues. But what is missing there is a discussion about developing economies. There's not much out there. I mean, a couple of CG models on the UC band. But we want to sort of turn this discussion around and think in terms of how developing countries can use those measures. If it makes sense for them to use those measures, given that they have climate goals, if they are, a useful tool in terms of mitigating, reduce emissions, particularly because they have different policy dilemmas than those big, large economies. I mean, because they are small, their leakages tend to be very negligible. I mean, why bother? And also because they usually have very high share, very high trade shares of GDP, which means that usually the trade losses associated with those measures tend to more than offset the, any type of climate welfare gains. So, what they should do about it, that's the type of questions we get a lot of the time in the bank. I mean, stakeholders are asking, what should we do? Usually they worry about the C-band, the UC band, but they have to start thinking about, should we follow this type of trend and get into the same sort of thing. So the main objective of the papers is try to assess the role of trade policy as a climate policy. We're thinking about a typical developing country. I mean, we're not thinking about China, that's very clear, and try to estimate, not only the emission impacts, but also its impacts on trade and welfare to have a sense of the trade-offs involved. The metric we use, we are calling here the voluntary emission restraints, sort of put a link to the trade literature, the old voluntary export restraints of the Reagan years, but they are basically the national development contributions. So we focus on their net zero emission targets for 2050 or later, because it's the only type of target that is homogeneous enough across countries to be useful in terms of comparison. And of course, we had to focus on a subset of those TCRMs, the trade-related carbon measures, because they are all over the places, industrial policy, export restrictions, so on and so forth. So we focus on two sets. First, the standalone type of trade policy, the strict sense of trade policy, just trade reforms. And the second set is this combination of trade policy with climate policy, the famous C-band type of measure. So in terms of methodology, and here I think is the main contribution of the paper is we developed this new quantitative trade model that builds on Calendo and Paro 2015, which is kind of a workhorse for trade economists to assess the impact of trade agreements. And we stand the model in three dimensions. We include extractive sectors, we include differential emissions across sectors and countries, and we add a household utility from global emissions and a general set of taxes. So we want to play with this idea that we have different options in terms of carbon tax, which base you're going to use, where in the value chain you're going to apply those taxes. So we have tax for intermediate goods, production, intermediate goods, final consumptions, material consumptions, and labor use. So I don't have the time to go through this, but the paper is related to this growing literature that all use quantitative trade models with this environmental flavor. Ours is closest to Korte and Weisenbeck in terms of motivation questions they ask. The difference is that they are worried about the big emitters. We want to look at the small guys. And what we mainly do is for sort of filling the blanks in terms of coverage of emissions, extractive sectors, the full set of input-output linkages, and as I said before, a broader set of broader instruments. So what we find, in case I run out of time, trade policy is seems to be a pretty much poor substitute for measures that directly target emissions, like carbon taxes. They barely help those economies to meet their VERs. But they often come with very palpable trade losses and usually very negligible welfare effects. Standalone emission-guided reforms, tariff reforms that try to reduce the carbon footprint of trade, then they usually can, generate trade and welfare gains, but very negligible mitigated effects. When you go to border tariffs adjustment, when they are paired with a carbon tax, it does reduce leakages, for developing economies, but it barely affects emissions, despite the trade costs they generate. And they clearly don't have, obvious welfare gains. And finally, in a scenario where, those countries are facing carbon taxes and carbon tariffs from the large guys, the best strategy, I say quote unquote, because we don't go as far as defining optimal policy, is not necessarily retaliation or replication as a way of responding to this thing. So the model, I'm going to go very quick to the model because of time. I just try to emphasize. Go ahead.
Can I ask a question? So one would think that with reduced activity, so if there are trade costs and trade is reduced, that should lead to reduced emissions, but that's not the case. So I was wondering why.
Sorry, when does?
You're saying that there are trade costs, but emissions are not affected.
Yeah,
right?
yeah.
But so what is the connection?
They are affected, but not as
they
are affected, but not as much to make a difference. In terms of them achieving their VRs. That's of course their impact on emissions. But if you're thinking that this is a useful tool to achieve as a climate policy, there are other ways you can do that. Given that you're going to have trade costs, and you have a welfare cost as well.
As a proportion of the national emissions commitments and so forth.
Exactly. Yeah. And even in terms of their local emissions. So, trade economists know very well this type of model. So for those that are not trade economists, I'm just going to give a brief overview. It's the Ricardi model of multiple countries, sectors, and factors. open economy, perfect competition, constant returns of scale, a full set of input-output linkages, which is usually not there in most of the models, fixed label supply across countries, but by within. And that's something different from the previous model that we had those energy endowments that are fixed for each country, and they are not tradable, and they're specific for each of the sectors. So, I mean, the usual standard household problem, you maximize utility for the consumers subject to, a budget income constraint. The main difference here that we add this utility function, the damage parameter, the delta there is calibrated according to one of the latest social cost carbon estimates of the US EPA. We put a 163. I know that there are all the numbers going around, and income here comes from labor, rents from natural resources, lump sum comes from taxes, and the trade deficit, which is exogenous to the model. On the supply side, here's different from the previous model. We have these two types of intermediate sectors, and extractive sectors, which is basically coal, oil, and gas, and non-extractive sectors. They all produce a continuum of intermediate goods. The difference in terms of production function between those two is that the extractive sector has this, beside labor and a composite of materials, they have this input of natural resources. So, and of course, there's productivity that we model like in Eaton and Corton. So it's realized random variable from a fresh air distribution. And so the perfect competition, firms price at unit cost. If you solve the cost minimization problem, you get to this expression. So cost depends on wages, rents, and the price of the materials, intermediate goods. The composite good, the producers of composite good is just the typical CES aggregator like Dixon and Stiglitz and Ettier. So it's a costly aggregation of intermediate goods, and they try to source from the lowest cost supplier either at home or abroad. So trade goes into the model through those producers of the composite good. We have trade costs, the typical iceberg trade costs and the ad valorem tariffs. As I mentioned before, firms buy from the lowest cost suppliers, take into account the trade costs and productivity. So, and solving the profit maximization problem of the composite good producer, you get to an expression for the price of the composite good. So with this structure of demand and supply, you can derive expressions for total expenditure, which has to be equal. This first term is the intermediate demand. This is the final demand. So the composite good goes both for intermediate consumption and for final consumption. And the all-important bilateral trade shares is where the trade effect happens, which is in a typical Ricardian fashion, depends on the relative costs of supplier E to country N of good J relative to all other suppliers, mediated by the level of productivity and the trade elasticity, which comes from the fresh air distribution. The market clearing condition comes from the factor market side, which is just saying that expenses on labor has to be equal from the demand of labor, both at home and abroad. And from the energy sector, we have an expression for each of the three energy sectors. So in terms of the outcomes we are looking at, production emissions is measured in this way, which is the output intensity multiplied by the output of each sectors. And welfare is derived from the consumer problem. So it's income, it's going to depend on income, taxes, and of course on this utility function. We solved the model in changes, like the previous model for a sector factor prices, and product prices, after shifting policy, after shifting tariffs and taxes from tau to tau prime. And as we solve in changes, we don't have to identify trade costs or fundamental productivities, and we can extract this information from the trade and production allocations. So data, we used GTAP 2004, the multi-region input-output table. We are just expecting the 2017 to be released, so we hope to update that. 104 countries, the more important 48 developing countries we are focused on, the tarified sectors, non-tradable and tradable sectors, and all kinds of greenhouse emissions. And we extracted the tax data from revenues and expenses. So in terms of counterfactors, so as I said, 48 developing countries, we cover LAC, Africa, and Eurasia. Of course, we are excluding behemoths like China and developing Europe because they don't really fix their own, decide their own trade policies. And we are focused, as I mentioned, on the net zero target, VR. We are trying to look at the small and medium developing countries, but we have a lot of variation in terms of size and emission intensity across the sample. So two sets of counterfactors, as I mentioned before. First is the standalone plain vanilla trade policy. So the idea is to see how far this kind of plain vanilla measures can go in terms of mitigation. And here we draw from this insight that Shapiro had that tariff escalation, which is widespread among developed and developing countries, ends up favoring trade on dirt intermediate goods. And the solution would be to try to harmonize tariffs to eliminate this potential emission bias. We tried two different solutions. That's the Shapiro's exercise, which it converges tariffs to the country's bilateral mean, which is interesting but not very practical because countries face no commitments for their PTAs. Most countries have a lot of PTAs that cover a lot of their trade. And of course, as some countries like mine, Brazil, has already very high, relatively high tariffs for intermediate goods. So if you bring them up, you're going to have very high trade costs. So we also run these other options, which combine harmonization with trade liberalization, where tariffs converge to the MFN average, and since it's MFN is the most favored nation, we avoid touching on preferential tariffs and sort of respecting the country's commitment to their PTAs. So the other set has this combination of climate with trade actions. So we have the proverbial Pigouvian carbon tax, calculated in this way. You just add the carbon price to the carbon intensity of the goods on top of the already tax on productions that those sectors have. And we play with two different scenarios. The first one, the world is not doing anything on these terms, and each developing country impose a unilateral carbon tax, and then they combine this unilateral carbon tax with a carbon tax, which is calculated pretty much in the same way of the carbon tax. And the second one is this sort of a large country climate club, which is sort of more benign than what Don the House is suggesting, which for me sort of would be the last nail in the coffin of the trade system. So what they're doing here is to have this coordination of these three countries, okay, that they coordinate the introduction of carbon tax and carbon tariffs on those energy-intensive trade exposed and electricity sectors, which are usually the sector, I mean, the steel, pulp and paper, petrochemicals, and so on and so forth. But they train those tariffs and taxes on the emission intensity of those goods, which is not usually the case on these climate club proposals. And each developing country, so we are running each country at a time, not all of them at the same time, and see what happens if they just apply a carbon tax or if they couple this carbon tax with a tariff, and with no equivalence. If they impose a carbon tax, they're still gonna have to pay, so they're not gonna be joining the club effectively. So results, we organize the results a little bit different. Instead of being standalone measures and climate with trade policy, we organize them in terms of acting alone and acting in a scenario where the large countries are being more active, which I think makes it easier to compare the results. So very briefly, what we see here is that those kind of more trade benign, standalone kind of policies, the sort of emission effects, even if you look across regions, very, very small. I mean, if you think in terms of, achieving zero, the carbon neutral targets, they clearly don't go that far. If you apply a carbon tax to the 8 sectors, you do see very substantial reductions. I mean, a lot of variation across regions, within regions. It's going to depend on the type of specialization and the importance of the 80 sectors in each of those regions. But you do see some action in terms of reduction in emissions. Just a few countries like Costa Rica do manage to get to the target of the carbon neutral tariffs, but most of them don't. And the thing I wanted to highlight here is that when you add a carbon tariff to the carbon tax, you don't see that much difference in terms of results in emission. You do see, and I don't have the time to show this result, you do see that there are carbon leakages, 12 to 15% of the emissions. But and when you apply the carbon tariffs, you totally eliminate those leakages. But when you compare those leakages to the global emissions, they are peanuts. I mean, why bother about them? And if you are worried about global emissions, you don't have to worry about. This is when you expand the carbon tax to all sectors, and of course, when you do that, you get bigger results. Latin America, in particular, because you include agriculture, you have bigger reductions. But again, the carbon tariff doesn't add much to the scene. And trade effects, what we see, I mean, as expected, the tariff reforms, you do get some trade gains with it. But when you look at the carbon tax and the carbon tax with the carbon tariff, you do get some important trade costs. I mean, just disruptions in trade. I mean, a wide variation, but they mainly point to a important negative trade effect, which is exacerbated by the carbon tariff. Welfare effects. I mean, not much happening with the tariff reforms. When you go to the carbon tax just for the 80 sectors, you do see important negative effects over there, which suggests that the impact, the disruptions on trade are more than offsetting any gains that those countries might have in terms of environmental gains. The story is pretty much the same when you look at also when the tariffs apply to all sectors. So the last results of the climate club, So here we've got some counterintuitive results, but again, not much happening to emissions of those countries. You know, we have 50% of the world trade forming a club, but if you really want to try to, you know, impose reduction in emissions, you don't see much happening there. When developing countries, again, each one apply their carbon tariffs. They have similar reductions in emissions as in the previous scenario when they're acting alone. You know, variations across region depends on the specialization. And again, when they add a carbon tariff, an adjustment, border adjustment, you do see very small difference. I mean, a little bit, you know, lower, you know, higher emission reduction, but you know, it's kind of splitting hairs here to see what's going on. Trade effects. Here's the more counterintuitive. What we see is you see trade gains on those countries, and we try to decompose to see what's going on there. What happens, we are talking very, very big tariffs here. I mean, carbon tax is sort of 50, 60%. And what happens is that there's trade diversion. I mean, you're diverting trade from the, you know, the big guys, which have a big cost increase, to the small guys. So in the end, they do get some trade gains from it. You know, again, when you impose a carbon tax, you do see impacts on trade, and this is magnified by the carbon tax. Welfare effects, you know, again, it's sort of counterintuitive, but what you see is if you do nothing, you know, mainly because of the trade diversion, you get, you know, welfare gains, you know, in most of the regions, in most of the countries. When you add the carbon tax, you end up reducing those gains. Some of the countries have negative welfare results, and you know the carbon, again, the carbon tariff doesn't do much in terms of welfare. If you worry about welfare because of the leakage, why bother? And well, so that's it. So again, trade policy, very poor substitute for direct measures in developing economies. When you look at the NDC or VRs that we call it, those TERCMs don't seem to be taking those countries very far and just imposing them trade costs and not changing much in terms of welfare. The tariff reform, they're the most trade-friendly type of things that they can do. I mean, doesn't move the needle at all. When you pair with a carbon tax, a carbon tariff for carbon tax, it adds little in terms of mitigation, and despite the trade losses and minimal welfare effects, clearly, carbon tariffs are effective in terms of reducing the emission leakages that those countries have. But on a global scale, why bother? In terms of a tit-for-tat scenario, we're interacting with a large club that is trying to boss you around. I mean, the best response, maybe. I mean, this framework doesn't allow you to estimate what exactly would be the optimal policy, but it seems that it is better to do nothing than try to mess around with trade policy or trade measures. Thank you very much.
Time for questions.
That's
a question.
No.
Not even a one question.
Lunch break. No, we can do one question.
We can do one. One question. Okay. One question. In looking at your numbers, it looks like Africa, under the most restrictive or ambitious
trade measures to decarbonize the global economy in your model. Looks like Africa suffers quite a bit in welfare losses. But if you put that in also, of course, its percentage emissions go down proportionally, but since its emissions are so small in terms of global emissions, it seems to me they're paying a very high price in lost income relative to the gains of the global economy and emissions reduction. So would that be a fair conclusion from your modeling effort?
Yes, yeah, which is just reinforce this broader, repercussions in terms of climate policy, but in terms of trade policy, it makes even less sense for them, to try to use those type of measures. Why bother thinking in terms of trade policy, or even, if you think of broader terms of, the whole range of trade-related carbon measures, industrial policy, export restrictions, and things like that. If the goal is emissions, it's not. It doesn't make sense.
Okay. Shifting gears a bit. Thank you very much for having me on the program. My name is Philip Ludwig, and it's my pleasure to give you a bit of a teaser of my job market paper. So if there's anything interesting here, come find me in the break, and I'm happy to tell you a bit more about what's going on here. So in this project, I'm looking at an important channel through which international trade is contributing to climate change by looking at the carbon emissions created by the international transport of goods. And I always think it's a good starting point here to remind ourselves that even though we heard a lot about production emissions, even in the previous talks, transport of goods in terms of the entire carbon emissions created by traded activity, actually for 1/3 of that is accounted by the transport sector. It's not just production, even though production has the biggest share of the pie, we should actually focus a lot on transport as well. I'm going to focus on a particular form of transport, that is containerized trade, that by itself accounts for 40% of global trade, both in terms of value and volume. And given the sector's importance, it's long been a consensus that carbon emissions from maritime shipping have to fall. These goals actually have been codified by the multilateral agency sitting in Geneva, the International Maritime Organization, in as much as by 2030, this is the short-run goal put out here, total greenhouse gas emissions from shipping activity should fall by 30% relative to the year 2008. Now, the problem is that if we look at what's been happening since 2008 in this industry, we don't see any reduction in carbon emissions. We actually see an increase in emissions of 10 to 15%. So the goal that the sector is setting itself is clearly at odds with the trajectory it's currently on. And a lot of that has to do with a lack of enforceability on the multilateral stage. We have an agency sitting in Geneva that can put out emission standards and targets, but they're not enforceable because it's up to individual member states or the flag states of these vessels to apply this policy. And there's no consensus on how to move forward from this. And this has led to a lot of frustration in particular parts of the world, first and foremost in the European Union, which is now opting out from the multilateral arena and is starting to pursue matches unilaterally. So what the EU is doing is that starting from January next year, 2025, they're going to include maritime shipping in the emission trading system, which constitutes a quasi-carbon tax, and it's the first time that the sector is ever going to face a binding carbon policy for its activity that's happening in European waters. What does that mean? Any vessel journey that involves at least one European port, so it could be intra-EU, but also a journey from Rotterdam to New York, has to account for the carbon emissions that are emitted on that journey, right? At the same time, the EU is imposing fuel standards and so on. I'm not going to focus on these too much here. But the EU is not alone in this. The US has since voiced similar ideas about introducing fuel standards. So we might be at this wave where instead of pursuing decarbonization of the sector multilaterally, we see a wave of unilateral action directed at the sector. And this raises a lot of interesting questions because it is simply not obvious that a policy that is designed to reduce emissions in its immediate jurisdiction is optimal to tackle a global externality like carbon. Think about it. Maybe the EU wants to sell to its constituents that we have reduced our share of the pie. But if doing so is increasing emissions everywhere else, we're not really gaining anything here, right? And especially if achieving carbon emissions with this kind of policy is achieved through a reduction in trade. There's a big welfare question looming in the background here, as we just heard in the previous discussion, because the gains from trade tend to be quite large. So we want to kind of get some insights on the balance between the environmental gains from such a policy and the potential income loss from lower levels of trade. Now, the way I approach this in this project here is But first, thinking about a framework that combines trade, transport, and emissions in a unified way. And I'm going to start off here. Okay, my goal for this framework here is to show you this without any equations. So I'm going to focus here basically on the intuition, and you tell me afterwards if it works or not. So we start off in a world where, similar to what we just heard, we have Ricardian trade. So country sectors differ in how productive they are in producing their goods, which regards is Ricardian motive for trade. So countries have different levels of marginal cost in origin I and sector N. This kind of gives you a motive to look who's the cheapest supplier of your goods, simply because others might be better at producing it. Now, the second component that determines trade, apart from marginal cost, is tau, the transport cost between an origin I and a destination J, right? So much so standard. And you're always going to try to source from the cheapest supplier that is globally available. Now, the first step away from the standard framework is by thinking about the world in which transport of goods is actually not direct or a single parameter between an origin and destination, but trade in practice is quite indirect. So there's many potential routes leading from an origin I to a destination J, because there can be any number of intermediate stops between the start and the end point of a journey. So you kind of want to account for the fact that in practice, we have a transport network and trade is routed through that network. So we need an additional kind of theoretical component that tells us from all the potential routes that connects an origin to a destination, which is the optimal route that you're going to choose, also the cost minimizing one. So think about it like if you want to ship something from London or Felixstowe, as I learned yesterday, it's the biggest port in the UK, to New York, you might do so directly, but that might not be the cheapest one. Actually, it might be cheaper to first ship your product to Rotterdam, put it on a very big ship, and then from Rotterdam go to New York, right? So the real cost in this kind of framework is not a single iceberg transport cost parameter, tau ij, but actually it gets the subscript r here just to indicate the cost is route dependent. And in this kind of framework, the cost of transport is kind of the product of the individual segments that are on the route. So think about a route as a chain, and there's different segments on that chain. And depending on if we combine the UK, Rotterdam, New York, you have two chains, and that is actually going to be the route cost for that particular journey. So we have the second part of the framework here where I'm using Alan Akolakis framework, which is on an urban context, but applied to container shipping here, to tell me about what is the optimal route, and what is the traffic going to result from that route choice. Now, with this, yeah?
What if you go from Rotterdam to New York, are you only taxed for the carbon emissions within European waters?
Yes, yes. In that example, both of the segments will be taxed, but at different degrees. So if it's completely intra-EU, maybe the UK is no longer in the EU, but for the EU, non-EU counterpart is half of the tax rate.
So, the part that's European waters from Rotterdam to New York would be taxed within the European.
Any journey that involves at least one European port is taxed, and that applies for every segment of a route. Okay, but if this was New York to Boston, yeah, it would obviously not be taxed. Okay, so what is new here? In this kind of framework where you have routes and you have segment costs, these segment costs determine which routes are chosen. But these segment costs do not fall from the sky. They're actually endogenous objects themselves. And what I want to do in this paper here is kind of explain why we see heterogeneous transport costs in different parts of the transport network. And the way I'm endogenizing this is by thinking about or taking the transport sector a bit more seriously and saying that the cost of transport on an individual segment of the world, so Rotterdam, New York would be one segment, Rotterdam, London would be another segment. But the difference in cost of these segments depend on which ships have been allocated to this part of the network. So the idea here is very simple. As I'm going to show you on the next slide, ships are vastly different in their fuel efficiency. If some segment of the network has received more fuel efficient ships per container, that cost advantage is not just an advantage for the transport provider, but these lower costs are passed on to consumers in form of lower transport prices, right? So the heterogeneity that exists in the fleet and how this fleet is allocated is determining which parts of the network or network segments see higher or lower transportation costs. And the nice thing about this is once we understand how vessels are allocated, we have a potential micro foundation for why we have heterogeneous transport costs in the network. But at the same time, if we know which ships are operating in which part of the world and how much they're carrying, we can say something about the transport emissions that they produce in the process. Okay.
Do you want us to think about the supply and phase 3?
Very good point. So here, this is a short run paper. So I'm focusing on a fixed supply of vessels. I'm going to allow them to reduce the number if there's a negative shock to transport demand, but I'm going to say something about the long run at a later point. That's a very good point. So very briefly, one slide. How does this vessel allocation process work? The way I think about this is I go to the data and I want to learn something about the cost incentives that these vessel operators face. So let's have a look at fuel efficiency of the ships. Here I'm going to plot ships' size on the x-axis, measured in how many containers they can carry. I'm going to plot fuel efficiency on the y-axis, which here is measured as unit fuel consumption. What this means is how much fuel does a single vessel need to consume to transport one container for 1 kilometer. This allows you to make different ships of different size comparable in terms of their efficiency. What you see here immediately is that as ships get bigger, they become more efficient, right? The colors here just indicate that the yellow ones are ships that have been built in the 2010s. So in recent years, we see an ever bigger ships, and they also tend to be cleaner in the same process. Yes?
Just to clarify, I think you set this up as a sort of emotions choices for how you allocate. How far is that just determined by some ports have sufficient depth or capacity to be able to handle?
Super good point. So there will be allocation constraints in the bigger framework. I'm going to account exactly for what you're saying because I see where ships are going. So I'm going to say, if a port in my data has never been able to accommodate a ship of that size, I'm not going to allow the allocation to give a big ship to that port. You're absolutely right. So there will be allocation constraints in that process.
But there are some few more complications. There's always more complications. Of course, one of them is there's a tendency towards verticalization, that shipping companies, particularly in the container business, are actually buying up ports, port terminals. So they have a preference for port terminals.
Absolutely right. Absolutely
and of course,
right.
the industry is very concentrated. So I just wonder, I don't want to interrupt, but there's this additional squibbles.
I'll talk about this not in the presentation, but I'm going to talk to you afterwards because this is super interesting stuff.
Yeah.
Here, I want to make the point first that there's heterogeneity between ships and their efficiency, but that's only half the story because actually the efficiency of a vessel also crucially depends on how fully it is loaded. If you look at the efficiency of a vessel of 20,000 container capacity, which in the between dimension is one of the most efficient ships in the fleet, that efficiency advantage goes completely away if that ship is operating empty compared to a ship of half the size. So we have two-dimensional heterogeneity here where it matters how big you are and how fully you load it. And always going to be more efficient if you manage to keep all your ships operating at high levels of capacity utilization or high load factors. What was the question?
Yeah, I mean, in terms of efficiency, you have different metrics, right? You, for example, there is dead weight, basically the capacity, but then you have also like transporting fluids. So what made you choose for the dead weight? Just because availability of data?
So here in this between measure, this is based on a ratio of dead weight. This here is accounting for transport work. This is exactly what you're saying. So this here would mean if the ship is fully loaded, assuming its full dead weight is used. This here would say that its dead weight is actually completely unused. So this is the idea of the load factor. And it's important to understand why some of these policies might actually introduce inefficiencies once you slow down global trade. But very quickly to wrap up. So we have efficiency differences between ships. We have efficiency differences within ships. So a vessel operator always wants to make sure that all the ships are fully loaded. The problem is that there's not enough transport demand in all parts of the network to make sure that's the case. Actually, if you plot the amount of transport demand in different network segments on the x-axis here, and look at the load factors, the average load factors of ships operating on these segments, you see that only in parts of the network where there's a lot of traffic, operators are able to fill up their ships to a sufficient amount of capacity to ensure a load factor of like 70 or 80%. And this is ship independent. So if you have a big ship and you allocate it to a part of the network where not a lot is happening, you're not going to be able to fill up your vessel to capacity. Yes?
Does the load factor also depend on the direction? For example, from China to US, there's a lot of demand.
Absolutely. I'll get to this in a second. There's backhauling effects as well. But the cost incentives I want to talk about here are kind of important. So think about what we just learned. We have differences between vessels, with differences within vessels. You always want to make sure that your vessels are full, but you can really only ensure this if your vessels are in some part of the network and not in others. What this means is it gives you an intuition of what a cost optimal allocation for these vessels might look like. Because to take advantage of the efficiency differences of your big ships, you really want to use your big ships on part of the network where traffic is high, okay? And this is exactly what we see when we look at the observed allocation of vessels in the data. This is again at the segment level. You see that this unit fuel consumption is significantly lower on traffic-intensive parts of the network. And what I'm not showing you, this is precisely because this is where all the big ships are operating, okay? So this gives you a basic idea of what kind of cost incentives these operators are facing when making this allocation choice. Yes?
I was just wondering if in the model, waiting is an option. So if it's not filled, I can have one ship instead of two. Okay.
I'll come to this. Is important. It's the next bullet point here. So in container shipping, these vessels operate like buses. They go around in circles. This is very different from what you're suggesting right now. This is in bulk shipping. So raw commodities, these operate like taxis, and then waiting is an option, right? Then you wait and you hope that you reach demand at the right moment in time. Container ships operate on these bus schedules. They go around in circles in a fixed amount of time. They know I have that much time in this port, then I have to go to the next one. So without showing you any formulas again, the way this works here that I observe this service network. You can observe these shipping routes from the data. And I'm kind of asking the question, so if these are the kind of circular routes that I have to serve, and I know how much demand is on these routes, I'm facing two allocation decisions. The first one is I have clean and dirty vessels, so you're going to make a choice about which routes should receive which type of vessel, such that my total cost across all routes that I'm operating remains as low as possible, right? And a second decision that can also happen, especially if you hit with a negative demand shock for transport, is that the global demand for containerized goods might be lower than the amount of capacity you have at your disposal. So you might actually face a second allocation problem where you have more ships than you need, and you somehow have to make sure how to optimally allocate the extra ships, because a route that already has received the sufficient number of vessels and is receiving additional ones will raise the cost of the route because it will lower the load factors of all the vessels that are already operating, right? So it's introducing inefficiencies if you have surplus capacity. That only happens if you have surplus capacity, but I'm putting this up here because it's going to become important when we look at the results. Now, with some magic that I'm not showing you, you can solve this. And the nice thing is that you get a deterministic allocation of vessels for any given vector of transport demand. This is arguably quite a simplistic allocation procedure here, but it's nice because it's a unique allocation for any type of vector you might be facing, which is nice because it means that whatever kind of shock you introduce to this framework, you're going to get the new allocation of vessels, and that allows you to say something about two important components. First of all, think about a carbon tax that is shifting this allocation around because now the EU segments become more expensive to operate. Maybe now another route that does not involve European segments is now a more attractive target of your clean vessels than before, right? So what this is going to do towards the left-hand side for you, it's going to introduce the standard shock propagation that we know from trade routes, right? It's going to shift around the cost of different segments in the transport network. Consumers choose maybe new routes and new targets where to source their goods from. So it's kind of the trend propagation mechanism that we know from trade. On the other side, though, under this new allocation of vessels and the new vector of transport demand, we're going to get a different level of carbon emissions. And the nice thing about this is that it allows us to compare two types of welfare components. On the left-hand side for you, it's going to be the standard change in real income across countries. On the right-hand side, it's going to tell you something about the change in carbon emissions for that process. So you can directly compare environmental and non-environmental welfare components and say something about what this policy actually means once we account for both of them. Okay?
Do you take into account like the capacity constraints of ports? Because I would imagine that like the ports in North Africa are like, no, you said, well, there's never a big ship going there, but maybe they have like one or two spots. Like, how do you account for that?
I don't account for that. Okay. I only account for whether they can accommodate it, but in this kind of macro framework, we actually even aggregate to the country level. So not accounting for this. But what you're saying is important, I think, in particular moments of time where maybe there's an increase in demand and then these ports face capacity. So here I'm kind of looking away from this a little bit because I'm focusing only on shocks that are going to decrease transport demand. So if it worked in the baseline, it's going to be less of a problem. Congestion is going to be less of a problem than the counterfactual where there's less traffic around. But it's right. You can think about congestion at the port level, maybe in some extension. I'll think about this. Okay. So basic framework, basic intuition. What can you do with this? I'm focusing on four main results here. and stop me if anything is unclear. So the first result here is like, does this allocation mechanism actually matter when we want to measure the environmental gains of such a policy? What I'm showing you here is that for different level of carbon taxes, how much emissions are you going to save when we compare the new model that I just presented here to kind of the state-of-the-art model in the literature, which is accounting for the right amount of change in transport demand, but treating the sector as completely homogeneous in terms of its transport technology, right? And it turns out that if you ignore this heterogeneity in this industry, in terms of different vessels between and within heterogeneity, you're going to overestimate the carbon emission savings from the policy by a factor of 2, right? Because if the sector can respond and reallocate any of inefficiencies from lower levels of demand, you're going to get emission savings, but just half as much as under the current state of the art. The second result here is that, yes.
Sorry, something. Behind these results, I guess there is the allocation of where production is taking place.
The third result.
Yeah.
I'll talk about it. You're anticipating the right. Give me 2 more slides. Second result, before we talk about production. Do we actually get any emission savings? In the model, this is directly linked to how much overcapacity there is in this industry and what the sector is able to do with the overcapacity. What I'm showing you here in the dots are 2 extreme cases where on the top here, I'm saying the baseline level of capacity that the sector has at its disposal is fixed and they're completely inelastic. They face kind of rigidity in the sense that they cannot park their ships if they face with this negative transport demand shock. They have to keep them in operation for reasons that I'm not specifying deeper here. But in that kind of scenario, even though we have less transport demand, which would mean that you have less activity, so you potentially have a lot of emission savings, the inefficiency that is introduced from the surplus capacity is so large that the carbon tax is actually increasing global transport emissions from maritime trade, right? This is an extreme case. I'm not saying we are in this scenario. If we look at the opposite case, I'm using the elasticity that is historically observed at its highest level during the COVID crisis or the financial crisis, then we get emission savings here, right? There's a question.
No, I'm just thinking that that's very important that for emissions we care about levels. So it's true that it's more inefficient because the ships are empty, but the average yes, no? If you're keeping the same ships running around, they have less fuel, so they are emitting slightly less, and they are emitting more per unit of power.
This is accounted for both of these. This is the level result as well. You have surplus capacity. And if you think about this within ship efficiency, it means if the ship is full, that is most efficient.
Yeah, but for you don't have not the total emissions.
Yes, but the inefficiency is so large, even if you multiply it with the level of transport demand, you're gonna get it. Basically, it's the net effect of 2 things. You have the level effect and you have the per unit effect. And in this case, I mean, it's an extreme scenario, right? They're not completely inelastic in practice, but the net of these 2 forces is actually so large that you get an increase in emissions. We are not in that world. We are somewhere here. But the point I'm stressing this so much is even though this is a short and medium run paper, issues of overcapacity are extremely large in this industry and they're likely to increase, right? If you look at the current order book of these vessels, you see that in this year, the next year, and the year after, they're ordering more and more and more of these ships. And even if these new ships are clean, if this produces overcapacity because the gap between transport demand and supply is just widening, even in the long run, we're actually slowly moving towards more of the red line. So the efficacy of this policy would severely be constrained by increasing overcapacity in this industry. So this is a message from the short run to the long run. And now it's kind of establishing this link between overcapacity and environmental outcomes in this industry. Now, third result. The nice thing about this framework is that you can actually also say something about production emissions. It's going to be a bit more ad hoc because it comes from input-output tables. I'm not doing anything with the efficiency here, but because you have trade diversion and you have a level effect, the world is cooling down, you have less trade going on. You actually also have emission savings on the production side. So for a 10% fuel cost increase in the EU, you actually get global production emission savings of 1.4%. And if you compare this like in levels, this would account for 20% of the total environmental gain of the policy. So because production is a big pie, a small reduction here actually gives you quite sizable emission savings as well. The important thing, though, is that because you have trade diversion, and I'm going to show you where it's diverging to, per unit of output, the emission intensity is actually increasing. So we have a level effect where we have less emissions, but per unit of output, production has become more dirty. And that's precisely because the EU carbon tax is going to predominantly affect the EU and its neighbors, right? Where on aggregate, emission intensities in production tend to be lower. And it's shifting production towards other parts of the world, North America, China, and to some extent Australia, where emission intensity in production is a little bit higher, right? So what this means is that we have an emission intensity increase because Europe is just losing, in relative terms, its share of global output on a marginal level. And that is important because this is where the unilateral nature of this policy becomes important. The fact that the EU is introducing this means that we have an increase in emission intensity. But if China were to impose this spillover effect from transport emission savings to production emission savings would actually be much larger because we could even get a decrease in emission intensity, supposedly because production would move in the other direction towards the European Union, where production is a little bit cleaner. Last result, a world in red. The problem, echoing what we heard from the last presentation, is that the net effect of the income loss and the social benefit from lower emissions is actually tilted towards the income effect, right? This is here the social welfare where I compare both of these effects, and there's no country in the world that's benefiting from this effect. There's heterogeneity here, but welfare is falling in every single country. And the way to show this is in kind of a welfare ratio, where you compute the loss in real income and relative to the gains, the social benefit, where you multiply the emission savings with some social cost of carbon. And I did this for both the values that the Biden administration is currently using at 50-51 and the EPA estimate of $190. How to interpret this ratio is that if the ratio is 1, then the effects are actually balanced, and it might be a good idea to do this. If the ratio is larger, it means that the income loss exceeds the benefit from the policy. And the problem is if you just peek at the x-axis here, that we have ratios that are orders of magnitude larger than 1. So not only there's not a single country in the world that benefits from the policy, but it seems that this way of decarbonizing the sector, from a welfare perspective, is just euphemistically put very costly. Okay? Yes.
So your policy starts in the vessel sector, right? You're introducing a tax, right?
It is increasing the leg cost in the network for European legs.
Okay, but if this were to be thought about a tax, it will generate the tax revenue.
Yes.
Right? Are you using this somehow?
It's a lump sum payment in the.
So this is.
Yeah. Yeah. It's a lump sum payment on the European side, and you see, I'm nostalgic because I think the UK is still in the EU. Conclusions. What do I do in this paper? I study how unilateral policy affects carbon emissions in global supply chains, particularly by introducing this new framework, which allows us to say something about trade, transport, and emissions in a unified way. The main takeaways for today are that carbon savings, this carbon tax can generate emission savings, but the price of it in terms of welfare is just very high. So you might want to think about some alternatives or tweaks to that policy that makes it a bit less costly to decarbonize the sector. And secondly, two of the points that I mentioned here, the efficacy of this policy is closely linked to issues of overcapacity in the industry. And because it's a unilateral approach, who is targeted here really matters based on how much savings you're going to get out of this. So looking forward, policymakers might want to be mindful about some of the distortions and trade-offs introduced by this kind of policy, because it turns out that, echoing other findings in the literature, the gains from trade remain high even after you account for the environmental footprint of the policy. And with that, I thank you for your attention.
We do have a few.
Yes.
Can you account for the emission measures introduced by IMO? So somehow should come about those things and get a bit more homogeneous in relative terms of transport.
So in this framework, you can actually consider all kinds of policies. So shocking the cost of the network in form of a tax is just one. Another one, what the IMO is thinking about is introducing efficiency thresholds, which in this framework would be an allocation barrier. So when you allocate your ships, you have to make sure that in that jurisdiction, the efficiency of vessels that operate there cannot be above a certain threshold. From the perspective of the model, that would actually be very negative because the sector, given the constraints it's currently facing, is trying to allocate the ships in a cost optimal way within the simple language of the model is also emission minimizing. If they introduce these emission standards, this in the short run, it's going to be distortive. But the idea behind it is that in the long run, it's incentivizing investment in the industry and pushing towards carbon neutral propulsion technology. So I think the benefits of that policy will be in the long run, but in the short run, it's going to be distortive. Yes.
Yeah, just two ideas for potential extensions. Do you think you could consider something like a cash for clunkers policy? So something that creates incentives to retire the old vintages. I know that the Maritime Association is really talking about this stock turnover problem. So I think that might be really valuable given the long sort of lifetimes of these dirty assets. And secondly, I think a biodiversity paper might be possible with the machinery you've already built. An easy constraint to add would be sort of migration patterns of whales and to ensure that the shipping network doesn't interfere with those, which is a huge concern for marine conservation. And there's excellent data on migratory routes for blue whales, etc. So as like a future project, it could be super interesting to see that, okay, if we put the biodiversity constraint in where you're not interfering with these major migratory routes, what does that lead to?
Super interesting point, super interesting. I'll chat more with you in the break. Thank you for the comment. Any other questions? Otherwise, I have to retire.
Great, thanks. Thank you to the organizers for including our paper on the program and for all of you for coming out. My name is Todd Gerardin. I'm an assistant professor at Cornell University in the Dyson School. This is joint work on the solar panel industry, joined with Brian Bollinger and Ken Gillingham. We've done a lot of work on solar that some people might be familiar with, as well as Drew Vollmer at the DOJ and Daniel Zhu at Duke. We have this kind of clunky working title. We had a discussion last week that said we should call this paper the Long War Against Cheap Clean Energy. So what are we thinking about here? As we already heard in some of the previous talks, protectionism is back in vogue in the US and around the world. And in the context of the United States and also here in the EU and Canada, solar panels have been subject to several trade restrictions over the past decade. And we think this is an interesting area for study both as an environmental economist, so as a trade economist like my father Daniel Zhu, for a few reasons. First, in the United States, very few solar panels have historically been produced domestically, at least in the last 10, 15 years. There was scope, as I'll describe in a bit, for foreign manufacturers to partially avoid the tariffs that the United States imposed on imports. So that might mediate the effects of the tariffs. And then crucially here in this environmental context, in addition to the typical effects of tariffs or duties on producers and consumers in different countries on government revenues, we also have third-party effects through environmental externalities, which, as I'll show you, turn out to be quantitatively important in our study. Finally, in the context of the United States policy environment, I think here in the EU as well, this case highlights a tension between efforts to decarbonize the economy and also efforts to deglobalize manufacturing. In particular, in the US, through the Inflation Reduction Act, there's a lot of policy mechanisms that have been put in place to try to onshore clean energy manufacturing, electric vehicles, and solar panels and other areas. And we'll be able to use our model to speak to the prospective effects of those types of policies. But what do we do in this paper? We have two interrelated research questions. We want to think about the effect to which these import tariffs on solar panels cause trade diversion or trade destruction. And so as we heard about in some of the previous talks, you might imagine, given that there are multiple places firms can manufacture and do manufacture solar panels, that by imposing import tariffs on Chinese solar panels, the United States might just source solar panels from third countries that were already producing, perhaps at comparable cost, and reshuffle the trade in solar panels with minimal welfare and environmental effects. Or, on the other hand, it might be that those other locations of manufacturing might be higher cost than places like China, where the United States was getting solar panels from, and this might lead to higher costs, higher prices, and less trade overall, and also less environmental benefits. And so we want to think about quantifying these effects. And then we'll go through and think through a national case from the perspective of the United States and domestic benefits, as well as the global case for efficiency impacts of these types of supply side policy. First, the tariffs that we initially started focusing on, and then a more broad set of policies like domestic manufacturing subsidies. The way we approach these questions is first, we'll descriptively document how firms, how production activity by firms evolved over time using rich, detailed data on manufacturing by firms in different countries. And we'll see how that responded to tariffs in particular, which we think gives quite compelling evidence that these tariffs did have an effect, not just on trade diversion, but on actual production activity by individual firms. In order to quantify the implications of that and think through these kind of welfare implications, we develop a model where we'll combine techniques from IO and trade to think about manufacturers who are competing, can produce in one or more locations, can expand the set of locations they manufacture in order to serve this US consumer market for solar panels. And then we'll take that model to counterfactual analysis where we'll think about the status quo, as well as a world where import tariffs have not been put in place, or other policies have been imposed instead, such as domestic manufacturing subsidies. Try to trace out the effects of these policies. A bit of background on this industry. So the manufacturers we're focused on studying here are solar panel manufacturers. These are vertically integrated firms who take polysilicon as an input and they process it through a series of steps into wafers, then solar cells, which generate electricity when exposed to light. And finally, they assemble them into solar modules or solar panels. The market we're interested in here is the market for solar panels. Those are, of course, an input into another market, and that is the market that the environmental economics literature has studied much more extensively, and that is the downstream market for solar systems that then generate electricity. So solar panels are combined with other inputs in order to construct those small-scale residential solar systems, as well as larger-scale utility solar systems around the world. Descriptive fact, China dominates the global supply of production of polysilicon, of wafers, of cells, and of solar panels. And in the early 2010s, more than half of US imports of these products came from China. So this is part of the motivation initially for these import tariffs. Total imports? Half of the imports of solar panels. Yeah, solar panels. Not, we're exclusively focused on the solar market here. There was not a lot of trade in solar cells at this time. It was mostly imports of solar panels.
And what was the concentration of production then?
What's that?
Concentration of production of output in terms of solar panels is in China.
Yes.
So percentage of global production.
Yeah, so now it's about 2/3, 70% of the solar panels, much more of the polysilicon, more than that scale. Earlier I guess it's been roughly stable in the 2/3 to 3/4 range over the last 15 years. Yeah, certainly upstream, there's even more concentration. There's a lot of different firms, it's not just one firm, but all located within China. So in response to this rise of competition from abroad, from Chinese firms, there are some domestic firms that petitioned the US government to ask for some protection. And there was a series of trade actions by the US government in order to protect domestic industry. Initially, this began in 2012 under the Obama administration, where there was an initial set of anti-dumping and countervailing duties. What are these? These are intended to address the claims that Chinese manufacturers are selling their products below their marginal cost of production, so dumping, and claim that they're benefiting from subsidies from Chinese governments, local or national. That's countervailing duties. Together, these tariffs are applied on a firm and location-specific basis. So a firm with a given identity bringing in products from China would be subject to duties, but if that firm imported products from other locations, they would not be subject to duties. And those duties were quite substantial. They ranged from 23% up to 250%, depending on the identity of the firm. A second round of these same type of policies were imposed in 2014, and they were just larger in scope. So expanding not just to cover products from China, but also to cover products from Taiwan. And these were to foreclose avoidance opportunities that appeared to be present in 2012 and 2013. And these are really kind of have much more bite collectively than the initial tariffs. And here again, these varied by firm and varied on the specifics of the product they were importing and ranged from 38% to 170%. So collectively, these were not additive. These are all ad valorem tariffs. These weren't additive, but collectively, this would cover any product of any solar cells or any solar panels that are manufactured in either China or Taiwan. That was the state of play for quite a few years. And then under President Trump in 2018, there was a much larger and more broad-based set of import tariffs put in place here under the Section 201 authority, these safeguard tariffs. It's supposed to protect domestic industry from all competition abroad. And these were 30%, in addition to any previous anti-dumping tariffs levied on effectively all imports of all products of solar panels. An important caveat that we'll come back to in the data we'll see is that firms did have the ability to import solar cells up to a certain amount and produce that final bit of production, assembling solar cells and solar panels domestically without being subject to tariffs. And finally, another round of Section 301 tariffs in 2018 also applied to products from China, solar panels, and many other products. In addition to all of these other ones, again, ad valorem tariffs, 25%. So this is the long war that I was referring to earlier. Okay, so what are the implications of this? One thing we could do to think through the implications of this, or just look at the data. What did firms do over time? And a natural place to start would be to think about what happened to these Chinese firms in the aftermath of these initial anti-dumping and countervailing duties. If we look at their production activity across the globe, this is one way to characterize that. We've just looked here at the share of capacity, manufacturing capacity Chinese firms have over time, all Chinese firms, and just computed the share of that production capacity that's outside of China and plotted that over time. We see that started on the order of about 5% of those firms' production capacity was outside of China, 95% inside China. Most firms exclusively manufacturing inside China at this time. And if anything, somewhat declining until 2012. And then since then, especially after 2014, rising more rapidly to on the order of 15 to 20% of capacity. And if we look at the same graph of production, it's on the order of 20% of production of their solar panels. So I'm not going to claim Granger causality purely on the basis of this graph, but it is suggestive of firm responses to the tariffs they were exposed to. And just to give a sense of the magnitudes here, if this is in percentages of their capacity or their output, the level of production of these Chinese firms outside of China is the same order of magnitude as domestic consumption of solar panels in the United States. So because the US is only a small sliver of the global solar market and China dominates the supply of solar panels, in principle, this expansion of offshore production could have gone a long way to supplying the entire US market for solar panels. To get a causality, to be a little more careful, we'll think about an event study methodology where we'll compare different types of firms and make, essentially draw similar graphs using fixed effect regressions and think about whether firms that were differentially affected by tariffs responded differently in terms of their offshore production. So here we'll compare firms who are exposed to the tariffs because they're active in the US market at baseline and engaged in the process, and they are assigned a firm-specific tariff, to other firms who are also in China and therefore face similar cost drivers, but who are not active in the US market and are therefore not exposed to the same degree to the tariffs. And then we'll estimate two-way fixed effect regressions here, and this is a plot of event study coefficients. Here we're looking at an outcome of whether firms offshore any production activities. This is just a binary indicator, so you can think about this as probabilities. So at baseline, we have parallel trends of firms that are exposed and not exposed to tariffs of some rate of offshoring, although quite small. And then over time, there's a differential response in that the firms that are affected by tariff tend to offshore at a higher rate than other firms, on the order of 25 percentage points at the end of this time period. If we do the same thing thinking about production levels rather than just expansion of capacity at all, we see a similar pattern, although particularly, as I said earlier, these 2012 tariffs seem to have been less effective in preventing Chinese firms from importing products to the United States. And we see a response in production that's much more stark after those 2014 tariffs that foreclosed avoidance opportunities. So partly on the basis of this evidence and the institutional details, we're going to focus on this period 2014 to the end of the sample for our main modeling exercise. We can do the same kind of comparison. You might be worried about things like the firms that are exposed to the tariff that were already active in the US market might be larger firms, so they might be more likely to offshore manufacturing for these other reasons. Or we can condition on the area of common support and the distribution of firm size at baseline, and we get the same results. We can't make these kind of offshoring comparisons to foreign firms, but we can do the same kind of production comparison and look at the evolution of production levels for Chinese firms that were affected by tariff and compare them to foreign firms that were not affected by tariffs until 2018. And we see very similar patterns there. There's expansion, offshore manufacturing outside of China. It's larger for firms that are affected by tariffs than unaffected, both inside and outside of China. Yeah.
What does this look like in terms of offshoring to the US versus non-US?
Great question. Non-US until 2018. Effectively, if we look at underneath these event study plots at what's going on, all of this production activity in this time period, and really most of it even after that time period, is happening in Southeast Asia. A very small amount of that is then happening in the United States. So to circle back to the more recent tariffs, where now the tariffs are broad-based, they don't just apply to Chinese firms. And so it changes the incentives firms face, not necessarily able to substitute to other third-party locations, but they do face a tariff advantage if they substitute to production in the US. And we see that. So this is a plot of actually the whole supply chain, but if you just focus on this dark blue line, that's domestic solar panel production over time. And we don't see a huge resurgence in solar panel production after those anti-dumping tariffs. We do see some of a resurgence in production or growth in production here at the end of the sample period after these broad-based tariffs that apply to all imports. But I'll make a few observations about that. So first, this is only about a fifth of domestic consumption of solar panels, so it's still not explaining most of the consumption activities. We're still importing a lot of solar panels. Second, if you notice this dashed line here, this is the production by domestic firms that existed prior to tariffs. So these are kind of the incumbent firms that the United States government was attempting to protect or safeguard with these tariffs. We see no increase, if anything, a decline in their production. And this significant increase in production that's all driven by foreign manufacturers, Chinese and otherwise, South Korean, for example, who are setting up manufacturing facilities in the United States, importing the solar cells that they're producing abroad and not producing domestically, and assembling them into solar panels in the United States, and then selling those products free of tariffs.
I'm assuming you're gonna talk about price effects later on.
Yep. Any other questions? Yeah. One descriptive fact that I haven't put in the slides for the sake of time is just in this industry, as you might be aware, costs have been falling rapidly due to innovation, scale economies, lots of reasons. And so prices overall have been falling rapidly, but we're going to think about what are the cost and price implications of these differential production patterns very carefully. Yeah.
Are they importing labor or are they hiring?
In the US or in the US, they're hiring domestic labor. In Southeast Asia, it's a mix. Yeah, they're definitely importing labor there. And that's been, that's caused some consternation and trouble, but that's kind of outside the scope of our analysis. Okay, so we have these clear patterns that suggest there's changes in production activity, so real changes in economic activity, not simply trade diversion, but those event studies, those plots enough aren't sufficient to pass judgment on the welfare implications, either the domestic welfare implications or the global welfare implications, because they don't tell us anything about comparative advantage and cost effects of this kind of offshoring activity. And so to address that, we'll write down a model of competition among firms. My background is coming more from environment and IO, so we'll take a stance on conduct among firms that we think is reasonable given the details of this industry. And then we'll borrow techniques from trade in order to think through how they make decisions about offshoring and sourcing solar panels, given that competition. Before we get to the firm side, what's happening on the demand side? As I said, solar panels, demand for solar panels is derived from downstream demand. That's not the final demand. And where's that coming from? About 2/3 from large scale systems and about 1/3 by capacity from small scale systems in the United States. In the paper, we've estimated demand a few different ways. What I'll show you today is based on a simple constant elasticity aggregate demand specification. We'll regress with instruments, regress quantities on prices here, net of subsidy prices that consumers face. We can also do something more like what my co-authors have done in other papers of a much richer microbounded demand system where we have two demand systems for large scale and small scale, aggregate those together, and we find quite similar demand elasticities, which is ultimately the parameter here that we're interested in. So we're really, for this purpose of estimating demand, this elasticity of demand will be crucial in helping us learn about firm cost, about dispersion and levels. On the supply side then, what is the environment in which firms sit? We have entry firms, which we take to be exogenous in this setting, both because most of the major players here preceded the tariffs, and there's not a lot of evolution in the set of firms that are in this market over time. The predominant home location that firms have in this context is China. As we said, the production is concentrated there. So we'll take that as given. Of course, firms do have choices about forward-looking investment choices about changing the set of locations in which they manufacture. We don't observe firms moving all their manufacturing to new locations and closing manufacturing facilities in their original home locations. It's really just a matter of a simple expansion problem where we can make capacity investments in other locations. For now, for the results today, what we've done here is we really just bounded the implications of this kind of investment margin. We find that for the tariff impacts, it actually isn't quantitatively important. The really important thing is this kind of production decision. And so what we'll focus on today is this. Firms are playing a static core no game. We have a bunch of data and descriptive evidence that we think is consistent and with or no competition among firms, given the set of production locations they have today. And so whether or not they have access to just a manufacturing facility in China or a facility in Southeast Asia or a facility in the United States will dictate their competitiveness in the product market. What does that look like? This is all standard. Firms are choosing quantities to maximize profits. You can think of this as the firm being a intermediary, like Trina Solar America, who's importing solar panels and then selling their solar panels to the domestic market. They can import those solar panels from different production locations. We observe competition in the market. We observe equilibrium outcomes, aggregate market data here. And under this assumption we placed on conduct, as well as an assumption of constant marginal cost, again, we think this is reasonable in this context. Then this optimization problem gives us first order condition, which we can rewrite as an expression where we have this cost, which we don't observe, as a function of observables, prices, and market shares, as well as estimable parameters, specifically that estimated price elasticity demand I mentioned earlier. So we can get all that information, we can estimate demand, and we observe price and market shares. But now we need to think about where those costs come from, right? Because these are firm level costs, but they depend crucially upon the firm's ability to substitute across different production locations. And so here we'll borrow from the trade literature and we'll build on all the papers that we heard about today, starting with Felix's paper, where we're thinking about firms that can produce solar panels in multiple production locations. And those production locations are substitutable. The extent to which they want to choose to produce in those different locations in order to serve the US market depends on the comparative advantage of those locations. And so we'll be thinking about wages, observable wages in different locations, how they evolve over time, technology that is present in a given location, and then of course, crucially, tariffs or any subsidies for manufacturing activity that might shift around relative comparative advantage. We're also in the process of expanding the model to allow for both dynamic and static and dynamic economies of scale, external economies of scale within these locations. And we think these are important, both could be quantitatively important for the sector, given the extent of innovation that we've seen. We think they're also important to give the tariffs their best shot at being a sensible policy, right? The kind of infant industry arguments around scale economies require us to allow for that in the model. So far, we have static economies of scale. We're working on adding dynamic economies of scale. What do we get out of this model? We get a formulation that will relate these costs that I told you we can already get from data and demand elasticities, relate that to a bunch of Greek. What did this capture? This, much like we saw a version of something like this in Felix's slides, will tell us, given the set of locations where firms can manufacture, so they're summing over the set of locations have different wages, different tariff rates, different technology, so different productivity, the specific type of location, different external economies of scale, depending on the scale and the scale elasticity here. So if I'm a firm that just has one location, so no summation term, this is just governing the wages and the tariffs and technology in that location are governing my costs, as well as potentially firm-specific component of productivity that's fixed over time, time varying but common cost shocks, productivity impacts that will help explain the evolution of costs in this industry. And we'll estimate all these parameters in blue, conditional on different values of the theta, the trade elasticity. Okay, I'll jump past the demand estimation because that's fairly standard and less interesting. And I'll talk a bit about our supply estimates and then get to the counterfactuals. So first, what are we really interested in understanding? Like I said, we're interested in understanding the dispersion and comparative advantage across locations and the extent to which tariffs or scale economies affect the comparative advantage of locations. And so one way to just capture that, well, residualizing all this other stuff that's important for explaining the equilibrium outcomes, but not as important for explaining changes across counterfactuals. I'll just plot out essentially this component of the cost model relative to the United States. So here we have costs in the United States, and they're not fixed over time, they're evolving, they're rapidly falling, but just think of this as a benchmark relative to those rapidly falling costs. Is 100% of the cost in the US. And then I'm plotting here in red the cost of manufacturing in China, and in blue the cost of manufacturing in other locations, think Southeast Asia. We can see, unsurprisingly consistent with the production patterns we see in the data, it appears as though the cost of producing in China is on the model predicts the cost of producing in China is about 2/3 of producing in the United States, a little higher for other regions at the beginning of the sample period here in 2014 when the second round of tariffs went into effect. And then those costs evolved somewhat over time and relative to one another. In fact, the cost of China appear to be higher at the end of the sample period than in the other region. This is absent tariffs. This is just the fundamentals. So changes in relative wages as well as changes in scale economies.
A couple comments. First, if we layer on the tariffs, if I show you another plot where we have those firm-specific tariffs that come into effect in 2014 and those broad-based tariffs in 2018, what we see are predictions of this model that are exactly in line with the descriptives insofar as China, once you've layered on tariffs, becomes more costly to manufacture in than others in this other Southeast Asia. And so it's intuitive that firms might substitute to Southeast Asia.
So the Chinese subsidies, do you observe them or do they go into the fundamentals?
They're in the fundamentals. Yeah. We can talk more about that at the end.
I think that is very important, right? Also.
So we can do that. Yeah, and we want to do that for welfare evaluation. And we can take on face value what the claims are about the Chinese subsidies. You know, we have the tariff rates, and those are assessed on the basis of those claims of subsidies. We can account for those. Talk later maybe about endogenous subsidies in response to any action, tariff action or other subsidy action that we haven't thought so much about, but I'd be happy to talk about. And then continuing on logic, later in 2018, when these more broad-based tariffs come into effect, China is now, more costly location to manufacture in, inclusive of tariffs, than is the United States. And then gradually over time, the same happens for other, and that could explain that is consistent with what we observe in the data, which is this onshoring of solar panel manufacturing at the end of the sample period. Yeah.
But all the panel manufacturing.
Yeah, this is all capturing costs for panel manufacturing.
The other stuff.
Yeah, and right.
No.
Yeah. If we think about the role of external economies of scale, and as I said, so far we just have static, not dynamic economies of scale in here. But if we think about these costs, I mean, you might be a little bit surprised to see costs in China appear to be, higher than the other location at the end of the sample period. What's driving that? Well, relative wages have been rising in China relative to Southeast Asia, so that's not so surprising. But really, most of what's driving this is the scale effects. So because these tariffs had the effect of pushing production outside of China to other parts of Southeast Asia, relative to a counterfactual without that happening, it's reduced the scale of manufacturing in China, it's increased the scale of manufacturing in Southeast Asia. And so that will push against their cost advantage. And then it's also, when we have that production happening in the United States, it's affecting the scale in the United States. And again, that's changing relative scale relative to a counterfactual. So if we think, now this is a kind of extreme case, but think about a world in which none of that offshoring had happened and we plot out the cost predictions there, we see China remains, dash line here, China remains the lowest cost source of solar panels. Until right at the end, where relative wages put it at parity with other manufacturing locations. Okay, that's all. Just giving a sense of this comparative advantage of different locations, and why is this interesting? It's fun to see that our models, consistent with real world data, but more importantly, it allows us to say something about counterfactuals with different tariffs or different subsidies. So in my last 5 minutes, let me say a little bit about that. What are we going to do? We'll solve the model out for different sets of policies. We can solve it under the status quo, make predictions of the model. We can solve for a world where there were no import tariffs imposed on products from China. And the model will make new predictions about where firms source their production from, absent those tariffs. That will yield new predictions about firm costs of serving the market and then a new product market equilibrium. Given a new product market equilibrium, we can compute consumer surplus impacts, producer surplus impacts for foreign and domestic firms, as well as using equilibrium changes in quantities and the state of the art in the literature on the external environmental benefits of solar panel adoption in the United States to quantify the external environmental impacts of changes in solar policy, supply side solar policy. So what do we see? If we first think about the baseline of the model with the factual, not the counterfactual, that's the prediction here. This is the share of production that the model predicts that we get from China, starting about 50% in 2014 and falling rapidly over time. In the appendix to the paper, you'll see that's exactly consistent with what we actually observe in import shares. And so not a targeted moment, but consistent with what we see in the data. So a nice measure of model fit. In the absence of tariffs, if the government hadn't imposed tariffs, the model predicts that most solar panels would have come from China. Again, there's some changes over time in the composition due to the changes in comparative advantage, but still most of the solar panels coming from China. What's happening instead? Where are we getting those solar panels instead? Because these shares will have to add up to 1. This is the United States. We see a baseline model predicts approximately 0 solar panels being produced in the US. With the tariffs, that's absent the tariffs. With the tariffs, as we see in the data, there is this rise in manufacturing in the US at the end of the sample period, but only after those more broad-based tariffs are put into effect. Really, the effect of the predicted by the model and consistent with the data is that there's this expansion of manufacturing in Southeast Asia and that we're sourcing our solar panels from there instead of elsewhere. What are the implications for welfare of all of this? This is a comparison of the impacts of imposing tariffs relative to a counterfactual world in which there had been no tariffs on domestic and global welfare. Of course, these tariffs led to, I'm not showing the price impacts immediately here, but these changes in cost led to higher prices, so reduced consumer surplus. On net, reduced producer surplus, but benefited American producers, some of whom are doing their production abroad, but are not exposed to tariffs to the same degree that Chinese producers are, and harm those Chinese producers. It brought in some tariff revenue, also exactly consistent with what the government has reported as the tariff revenue made on these. Actually, most of the good change in government revenue predicted by the model is because we have fewer solar panels, so we have to give fewer subsidies to people to adopt solar panels. But there's an environmental externality, so we shouldn't really think about that absent this piece. And what is this piece? This is local air pollution benefits and global. So local pollutants, CO2. And we see in terms of magnitudes that just swamps everything else in the calculation. Even if we think there's environmental regulation, these are a little bit overstated at baseline. These are still swamping the kind of the traditional consumer and producer surplus impacts of the policy. On the other hand, if we thought about a counterfactual world in which the government imposed provided a subsidy to domestic manufacturing that did not discriminate based on the identity of the firms, we get quite different results qualitatively. Of course, we're subsidizing the market, expanding the market, so we have more consumer surplus, more producer surplus, and that's shared across firms of different types. It costs money for the government to do that, but we're also increasing the level of environmental benefits by just expanding the market generally. In just a couple minutes left. That's what we're good at, the classic stuff we get out of the model. And I should say, thinking both about the national implications and the global implications, these tariffs look bad for domestic welfare as well as global welfare, where domestic welfare is excluding global pollution benefits and foreign producer surplus.
Is the maverick column a little bit like the Inflation Reduction?
Yeah, exactly. I should have said, yes, this is exactly modeled off of the Inflation Reduction Act. This is a 30% subsidy to domestic manufacturing. So it's just going to be shifting, just like tariffs are, those the comparative advantage of locations. Other outcomes that we might think could justify reducing welfare in principle if you're a politician. What about domestic employment impacts?
Are the subsidies very relevant from a fiscal standpoint?
Are they what?
Are the subsidies relevant from a fiscal standpoint?
Yes. Sorry, this is what Robin just asked. This is based on actual subsidies that have been imposed, that have been put in place in the last few years after our sample period. So
it's an election issue.
Yeah, maybe we can talk offline more about that. So yeah, of course it has fiscal costs to subsidize the industry, but the government is committed to doing it. So we think it's reasonable counterfactual to consider. Briefly, since we're basically at time, what are the trade-offs in terms of employment? We subsidize demand. If we have tariffs that are imposed on imports, that implicitly will partially subsidize domestic manufacturing. We saw the expansion of domestic manufacturing. That's good for domestic manufacturing employment in the solar sector. But of course, because this is an intermediate input into the downstream system market for solar systems, on net, this actually looks like it reduced total employment in the US. If we adjust for relative wage differences in wages here, we still find the same effect. That it had negative impacts on wages. Of course, these are all partial equilibrium results. That's what the politicians want. And then here, on the other hand, with a counterfactual subsidy like the Inflation Reduction Act, we're expanding manufacturing, we're expanding the market generally, so we don't have these countervailing effects, and it predicts increases in jobs. National security benefits are another potential concern, as came up earlier. These are all we've seen in terms of domestic production thus far is just the final stage of production, and so. To the extent that you think national security benefits are important, the tariffs didn't actually achieve those national security benefits because the entire rest of the supply chain upstream of those solar panels was still in China or Southeast Asia. So I'll leave it at that. Thanks for much.
Okay, thank you, Aaron. So lunchtime. Just to remind you, we have a really good master lecture coming up at 1:30 with Charles Salinger and panel Corton, so please be back on that.
Really nice. We wanted to talk to you over dinner last night. So.
Yeah.
This should inform the US election.
Yeah.
Well, so
nonsense is period.
So I was talking to someone last week who worked at Treasury.
John, I'm just gonna get everyone to come in.
Okay. Is everything set up with the slides, everything's working?
Yeah, no.
How's everybody, Gail, Costas and Bo and?
Hi. Our office used to be right next to mine. Now we're all in this building.
Yeah, that was great. Yeah, that's right. It's the famous world.
Yeah, so you saw.
No, I thought you'll have something very, very pleasant.
Yeah, no, it's a bit. It's just that I'm close. Separated.
Yeah. Guess we'll get my,
They had already sent them to me, but I had, yeah.
Oh, okay.
And therefore, I should jump in. How are you? So good to see you. Change your hair. Yeah. Wow. Discuss later. Okay. So I'm here. Yeah. Yeah, we can meet. Brilliant. How are you doing too?
Nice to see you. Nice to see you. Okay.
Hello. Okay, everybody, can everybody settle down, please? Welcome to everybody to the masterclass in Environment Week. My name is John Van Reen. I'm going to be chairing the session. We're delighted to have a really exciting set of speakers this morning. We're going to start off with an academic panel with two speakers around the area of trade and carbon border adjustment mechanisms. And then we're going to lead into a policy practitioners panel, which will be chaired by Richard Newfarmer after me. So I don't need to give Sam Coulson much introduction. He's the James Burroughs Moffat Professor of Economics at Yale, and a world leader in many areas, but particularly around trade, which is going to be the subject of his masterclass today. So Sam's going to speak for up to 45 minutes, and then we'll move on to Harold Padinger, who's Professor of Economics at the University of Vienna. So that's what we do. Over to you, Sam.
Thanks, John, and thanks so much for inviting me. Okay, so this I'm talking about carbon policy when it's not done at the global level. So that's the policy dilemma, is emissions are done at the global level, and it's kind of good to remember sometimes that it doesn't matter where they come from. It's just the accumulated amount up there that matters. And so that has a policy implication. Now, there is a solution, which is if all countries could get together and impose a carbon price equal to the global social cost of carbon, then that would internalize the externality and we'd be done. So then I wouldn't have to talk for another
44 minutes. The problem is that we haven't made much progress towards that ideal, and that sets up the problem that we have here. So the way I've tried to pose it is that I'm going to ask this question: what would be the best a coalition of countries? If it was the world, the best would have been this. But if it's less than the world, what's the best they can do on their own if the rest of the world is just passive? The rest of the world's not out to do them in, but it's passive. It's not taking a stand on this policy. And this coalition is going to be called HOME. Now, on a more kind of nerdy technical side, I'm going to solve this problem in the form of what's called the primal problem. And primal problem means that you're solving for the allocation. And one thing that's kind of fun about that is that you can solve that problem without thinking about any taxes or anything. And then you look at the solution, and then the taxes come out as sort of the way to implement that solution. So it's sort of nice in the sense that you're sort of open-minded, and then it tells you what the taxes should be, rather than setting the problem up with some prior notion of what the taxes should be. Okay, and so this is a very stylized analytical model. No more apologies for that, that's just what it is. And we can combine it with data, though, and have a kind of mini computable general equilibrium model to have that feel to it. The two sides of this, the analytical and the kind of CG part, means we get to, with the analytical part, expose the logic of carbon policy and the different features that it takes. And then with the little mini CGE part of it, we can illustrate policy choices and some of the good and bad that can go on both EU, UK, US, China. We sort of all have to get together to at least be a big enough home so we can come anywhere near this. That's kind of critical. This is joint work with David Weisbach, and I'm just listing, we've been working on this for a long time. I feel like we're getting traction now, and so a lot of what I'm presenting is this last paper. So I want to kind of keep in mind three international challenges that then come out towards the end of, through the talk, and towards the end, they're going to pop out again. So the first one is kind of ironically, even in autarky, we'd have an international challenge, and that's because of that first point, that emissions are moving around the world. They're kind of traded around the world or spreading around the world, whether or not we have any international trade. And that has the implication that Home's efforts aren't going to be enough, and that Home's efforts will only bring it a portion of the benefits it brings about in terms of climate, and that foreign will have this strong incentive to free ride, meaning, oh, let them do it, because we're going to get as much benefit of them from this. And so that's a real challenge. Now, I don't have any answers to this. That's kind of another literature, very important one, but you will see it nonetheless through this analysis. Okay, the second layer is trade in fossil fuels. And we want to, in this model, really think of starting from the fossil fuels, and that carbon works its way through the economy from the point of digging them up. So let's think about trade in fossil fuels. Just by itself already means that Home's policy is going to spread internationally through the price of energy. And that is sometimes called the indirect carbon leakage, but it'll have the effect that Home's efforts may be partially offset by just not any ill will, but just how foreign responds to that changed energy price. But then finally, we can have trade in goods that embody those fossil fuels. So there's carbon embodied in goods. And that gives us the potential for really what people typically mean by carbon leakage or direct carbon leakage. So then Home's efforts are partially offset by production moving from home to foreign. And that could be through trade. It could be from just the moving production around, but it could mean just moving the produced goods around. Okay, so there are three foundations in the literature for what we're doing. We're building on, and I want to give a lot of credit to this Markuson paper because that kind of set us on the right path in what we're doing. And I think it's not quite properly interpreted in the literature. It kind of does something that people overlook. It's often cited as a paper talking about leakage, but it actually has something to say about that second issue that I talked about and how you can, how you want to affect the price of energy through the policy. Okay, so then the second building block is the Dornbusch-Fisher-Samuelson model of trade, and it's a Ricardian model. You know, I'm very, I love it because it relates very closely to the work on trade that I've done with Jonathan Eaton, and yet it's only 2 countries and it keeps it very graphical and simple. And we're going to add to it the idea that energy is used in the production of goods. So typically in a Ricardian model, it's only labor that is used to produce the goods. We're going to have labor and energy, and then there's the substitutability that means that a policy can have an effect by substituting out of labor into, substituting out of energy into labor. Then on a very technical note, we're going to build on this paper, talks about how to solve that primal problem. And then there's several papers which we followed in the footsteps of in making the policy one that is not out to hurt foreign. You know, it's home and foreign. Those are the 2 actors in this model. And we're going to constrain policies to be such that they don't make foreign worse off. And that's we find that a very appealing way, and it actually simplifies certain things. So we have this world of 2 regions, home and foreign, each endowed with energy deposits and labor. There's going to be increasing cost to extract fossil fuels. It's a static model, so that's, but you can think that there are increasing costs to extract fossil fuels due to just the heterogeneity in these energy deposits. There's one-way trade in energy. Either you're an energy exporter or you're an energy importer, because energy here is just a homogeneous thing. And it's always in this model going to be fossil fuels. And we're going to think of it as just measured in its CO2 content. But then there's two-way trade in goods. And I think that's very important to really understand policies, that you are both exporting goods and importing goods. And the DFS model, the Dornbusch-Fisher-Samuelson model, has that feature. It's very nice in that sense. And there, the trade, as in any Ricardian model, is due to the heterogeneity in technology. So heterogeneity in deposits, heterogeneity in technology. And then the way we're going to solve this is imagine a planner who's controlling everything in the home economy, but can't interfere with the sovereignty of foreign. Chooses a carbon policy to maximize home welfare, but again, with the constraint that the policy's got to be Pareto improving, it can't hurt foreign. And then foreign is passive, but reacts to the market prices. So just to quickly talk about the way carbon works in this setup, the carbon is sitting under the earth, nicely sequestered in these energy deposits. But then we dig it up, and then it gets traded, so it's embodied in energy trade. And then at this point, it hasn't been, there's no emissions, but then, you know, the reason that you want the energy is to combust it either as a household or a producer of goods. And then so now it's up in the atmosphere, but we can still say that the carbon is implicitly embodied in these goods. So even though it's already gone up into the atmosphere, we can do this. And the reason for doing that is we can track the carbon all the way from extraction to the ultimate consumer of the good for which the emissions happened, so that they could consume that good. So there are these 3 layers: there's extraction, there's emissions and production, and then there's consumption of the goods produced. And of course, if you're just using it to heat your house, those last two are the same thing because you're both emitting and consuming the heated foam by emitting. And this just gives you a little idea of the data. And this turns out to be the data that we can calibrate the model to create our little mini CGE model. And this is for 2018. And at that point, we had total emissions of 33.6 gigatons. And then that adds up, three different things add up to that. The amount of extraction in the two regions, home and foreign. Foreign has the star on it. So that sums to 33.6. The amount of emissions, which is not the same thing as extraction when it's actually burnt, combusted, that also adds up to 336 and 33.6. And the implicit consumption, including that embodied part, that also has to add up to 33.6. And then in the upper left corner, there's a little matrix of bilateral trade between countries of this embodied carbon. And all these units are just in CO2 units, because I'm always going to measure carbon in CO2 units, and the E stands for energy. And so, for example, this one is the fact that the home imports, through the goods they import, is essentially importing 2.5 gigatons of CO2 via their imports of goods. And then they also export, but they import more than they export. Okay, so how's the model going to work? There's some preferences. All you need to think about this is home welfare comes from consuming goods, and there are three sorts. Their service is very boring. They're the goods in the DFS model. Those are the goods that have the energy embodied in them. And then there's directly just consuming the energy to drive your car and heat your house. That's the CED. And you get utility from all these three. And then you have subtracted the harm from global emissions. So a key thing is it's always the harm from global emissions that matters. It's not from your own emissions. Okay. Now this fee is your social cost of carbon for home. This is home welfare. Now there's something like this for foreign as well, but they have a fee star. That's their cost of climate change. And if you add those, you get the global social cost of carbon that I mentioned at the beginning. This would be the thing that you would set the tax rate to, or the carbon price to, if you had a global, everybody was in home, so that foreign kind of jumped into home, then we just have a carbon price equal to PW. Okay, what about the technology? Well, this is the idea that this is heterogeneity in deposits in the sense that the amount of labor or inputs needed to extract energy goes up as you try and extract more energy either in home or in foreign, and that's just as you move into the marginal deposits of energy. Then this is a combination of labor and energy that produces goods. I kind of stripped out the efficiency part in this, so it's just a production function combining energy and labor. Then there's a thing called energy intensity, which I call somewhat differently. I call it more like a macro person would call capital intensity. It's energy per unit of labor, and called little kj. And then there's, from this, you get, together with the efficiency part, you get unit cost functions as a function of the price of energy. And where did the price of labor go? It disappears because it's just equal to 1, because there's services as a way to sweep out wage effects, just to keep it focused on energy. So that's why the unit cost function only depends on the price of energy in foreign, in home, or in foreign. And then the derivative of that with respect to the price of energy becomes the energy per unit of output, which is what some people would call energy intensity. So it's just that guy. Okay. So there are going to be some savings from trade just because climate benefits of trade, just because when you buy things produced more efficiently, well, then they're using less energy. So that's a good thing about trade. Okay, services produce 1-to-1 for labor, which is why they disappeared from there. Okay. So the fossil fuels just trade in a homogeneous good, no cost of trade, there's a price of energy. That's pretty much it for the fossil fuels. But this, while so simple, is really critical for the policy implications. Then goods, I put in costs of shipping goods to match models of gravity models of trade and so on, so that we have tau and tau star. Services costly traded, totally made up just to make the model simple and keep us focused on energy. And then there's a concept of business as usual, kind of our starting point for evaluating a policy. So business as usual can be thought of as a competitive equilibrium if there's no carbon policy, but it can also be thought of as a solution to our planner's problem if the planner perceives there being no global social cost of carbon. So that's kind of like the first welfare theorem, or the second welfare theorem. But we're gonna use this BAU as handy because then we can evaluate all the carbon policies relative to that and just say, how do they move us relative to business as usual? And we're gonna actually think of the data, since not much progress has been made, other than Europe, we're gonna take the 2018 data as business as usual. Okay, so this is why people like the DFS model, because it's like trade economists, I have no idea what they're talking about, and suddenly you show this picture, and look, oh, that kind of looks like a demand curve. Now I know what's going on. So what this really is the schedule as you move across the continuum of goods from 0 to 1. It shows you comparative advantage. In other words, home's relative efficiency as we move from the goods labeled close to 0, where home is very efficient, to the goods labeled close to 1, where foreign is relatively more efficient. And I should have always used the word relative in front of that. And here it is, AJ star over AJ. Okay, because the little a's are input requirements, they're not efficiency, they're inverse of efficiency. Okay, now what happens in BAU? Well, this would be your typical picture from the DFS model. You have that tau of moving goods, and you find the good for which it's equally costly for foreign to produce it for itself or for home to export it to foreign. And that's why the tau is there, to take account of the fact home's got to export it to foreign. And that good cuts the chain of comparative advantage, or the set of goods, into the goods that home exports and then the goods that foreign produces for itself. Now, I remade this picture this morning to make it more empirically realistic, which is in fact most goods aren't traded and home exports represented a small share of goods. Okay, similarly for foreign, we can say what would be the good that would be equally costly for foreign to produce and ship to home versus home producing it for itself. And that's going to give you this good at which the AJ curve is equal to 1 over tau star. Okay, now we're going to see this again once we have policy, because this is in the absence of policy. This is BAU. And we always talk about these goods here as the endogenously non-traded goods. The comparative advantage isn't strong enough between these 2 points to make it worth trading these goods, given that they're trade costs. And that makes the model very realistic, and we can generalize it to many countries and so on. Okay. Now the planner is trying to maximize home's welfare, primal problem. One nice thing also about the primal problem, it means we don't really have to be thinking about carbon prices. We can just think about more regulations and things like that, because the solutions apply equally well to that. Carbon prices are sort of a simple way to carry out such a policy, but it doesn't have to be done that way. You have to keep foreign just as well off. And because of this, we can really think of the social planners just maximizing global welfare, because they're trying to not make foreign worse off, but they have a constraint that they can't meddle in foreign's economy. So That's why it's not, that's why it doesn't just give us that the carbon price is equal to the global social cost of carbon. So what it really is going to be doing is they're maximizing the change in global consumption minus the global social cost of carbon times the change in global emissions, because this is where the harm comes from. Now, you might say, how come I measured it when it came out of the ground? It hasn't been emitted yet, but remember my picture, they're all the same. I mean, once you dug it out of the ground, you're gonna combust it, so we might as well just measure it at this point. Okay, and generally what we're gonna have is that you achieve a reduction at this, a reduction in this at the cost of a reduction in that. And you can think of it, I was thinking my next slide was a picture, it's coming up right after this. So the solution strategy, actually, let me kind of quickly do this. There's going to be a Lagrange multiplier on energy. And the idea is that this planner has two things going on. They're going to value energy a lot because they want people to use it sparingly. And they're going to not value so much digging it up because they don't really want to bring it up into the Earth's surface where it's going to be combusted. So those two things are going to be going on. That's a key variable that Lagrange multiplier on energy. Okay, and so then they're going to try and solve Holmes' economic problem, including the price of energy, Lagrange multiplier, how much they extract and how much their consumers consume directly. And they're going to meddle in what's going on in each of those individual goods that gets traded. So let's jump into it. But here's where I thought I was just a moment ago. Let's take a high-level view of what the solution is going to look like. There's going to be a frontier of global emission reductions on this side and reductions in global consumption. Why reductions in global consumption? Because to reduce emissions, you sacrifice something. And we can think of it like a production possibility frontier. And then the optimal policy is going to find the point at which that's tangent to the inverse of the global social cost of carbon. So if the inverse of this global social cost of carbon has this slope, that's going to pick up that point with the little x as being the optimal thing. And the rest of my talk is really about what determines this curvature here, which is sort of like how bad is that trade-off? And how can we make it better? How can we make it so that we get more emissions and less reduction in world global consumption? So I want to go through three things about properties of the solution. And okay, so I have 20 minutes, I guess, right? Yeah, 24. Okay. So the first thing, valuing energy, I hinted at this already. The social planner values it this much when it's above the ground and this much when it's pulled out of the ground. In other words, it kind of doesn't, it says, oh, we got the benefit of having more, but now we have more emissions, so we got to subtract the VW. Once it's dug up, we value it at lambda E. Now, the foreign economy values it at PE, both for digging it up and for using it, because they don't have a policy. Now, I call this the Pigouvian wedge. In other words, the wedge between the energy below the ground and above the ground. And then we can already see that this is going to determine how much people consume. And if lambda is higher, they're going to consume less. And this part down here determines how much extractor is going to dig up. If this is lower, they're going to dig up less because they're not going to go for the, deep undersea deposits or the shale sands in Canada and so on. Whereas over in foreign, they're equating these two. The cost of digging it up is equal to the marginal value to a consumer using it. Okay, now I haven't put in the firms yet because that part's more complicated, but this part we can already take care of. A question, though, is the policy through Holmes net exports of energy, and this is the second international challenge part of the talk, they can determine where that PE is between either way down here or way up there. So they have that leeway to determine that. And they're going to want this to be really high if they think extraction is very inelastic, so it won't respond much to the high price, or if demand is very elastic. And then they're going to want the price really low if they think demand is inelastic, so it won't respond much to that low price. And here I'm talking about what's going on in foreign, who they can't meddle with their economy, but they can kind of meddle with the price of energy that economy is facing. And so if demand is very inelastic, they say, oh, make the price low, they're not going to consume much more, and they'll dig up less because of the low price. So they have that leeway. And that's what I said there. So what do we have then? Now, I said it's kind of like opening up the presents, because you've done the hard work of solving the planet problem, and then you get to interpret what it means in terms of taxes. So the fee W can be thought of, and it doesn't have to be thought of this way, but this is consistent with it because there's several ways to implement things. But I'm going to think of it where you start with an extraction tax. Okay, so that's literally dollars per unit of CO2 that you take away from the guy digging up natural gas in South Dakota. Okay, and that's going to be PW. That's going to be a big tax. And then you make the, oops, I want, yeah. So then you have PE plus TV is sort of the cliff you make between the price that foreign consumers face and the price that home consumers face. And that's done through a border adjustment on energy, because we're only talking about the energy trade. We're talking about number 2 of the international challenges. And that means that these extractors at the end are going to get PE plus TV minus TEN. Okay, so we've basically broken it up into a consumption wedge. And the reason I call it a consumption wedge is it's the wedge between what foreign and home and foreign consumers pay. And this bottom one is the extraction wedge between what home and foreign extractors receive. And you create those 2 different wedges through the tax system. So notice that from the point of view of an extractor, they're kind of happy about this TB because it made the price of energy higher in their country, home. But of course, they're unhappy about the TEN. And so their effective tax is really the TEN, the Pigouvian wedge, minus the TB, which is exactly this value. And so you can move the pain around between the consumers or the extractors. And I feel like up till now, people talk too much about this and kind of forget about this one. And in fact, some policies in the US make this the whole thing and just make that 0. And there's no reason to do that. And it's not optimal. Because there's, I mean, I guess what I jumped over, there's a kind of condition of optimality based on those elasticities of supply and demand in foreign that determines where that PE should be, where you make that trade-off. Okay, so now let's go to the inner problem, which is all the fun part. Okay, so we're going to start with imports. Imports is very simple. You want to, the first order condition says you should make energy intensity of home production and imports the same. Now, I said you couldn't mess with what's going on in foreign, but you can tell them, you know, if you want us to buy your goods, you got to produce them with the same energy intensity we would have used. And so that's one first order condition. And that means the JM is equal to J bar M. And so you kind of didn't mess with the import margin. You left the DFS import margin unchanged, the import threshold. And then the other thing that says is that marginal utility is equated to cost. And it means that you just consume less of goods produced at home and less of imports by the same amount. So this is sort of about the extensive margin of trade, don't mess with it. Intensive margin of trade, move it down evenly between stuff you import and stuff you produce yourself. Now, how do you do that with taxes? Now that border adjustment, which came in first through trade and energy, now we're moving to the third challenge of international on carbon policy, is we now have that same border adjustment that applied to energy applied to the carbon content of imports. And so we're gonna, and that's gonna induce foreign to want to produce with the same energy intensity as home. So foreign thinks about, oh, I'm producing this, I know I'm gonna have to pay this tax, that's gonna make my product more expensive, so I'm gonna try and minimize the amount of carbon embodied in my goods. And so even without messing with their sovereignty, you've kind of got them to produce goods in the energy saving way that you wanted. Okay, so so in other words, we've gotten rid of one form of carbon leakage, which is, or this policy has gotten rid of the form of carbon leakage that would take place in home, were home to substitute into foreign goods which were cheaper due to the policy. Well, just make the policy such that they're not cheaper. And you do that through the border adjustment. Now, what about exports? Well, another for certain condition is that you should have the energy intensity of exports be the same as the energy intensity of home production, goods you produce for the home market. You want that to be the same. So you want these three energy intensities to all be the same. That means that in principle, you would be crowding out by demanding that, you're going to make your exports more expensive and you're going to crowd yourself out in the foreign market. So what do you do instead? Well, you want to subsidize some of your exports in a given range to keep them competitive. Now, why that seems kind of contradictory. Here you're making them more expensive, but here you're making them more expensive in a way that makes them want to produce in a more clean way. Here you're making them cheaper in a way that doesn't take away that incentive. It just makes it so they can produce at a cost at which they can sell in the foreign market. Okay, so what this JS is what, had you not had the subsidy, it's where your export threshold would be, and the JX is where you actually make it due to the subsidy. And here's, let me just jump to my picture. Okay, here was back to DFS. I love this picture. Okay, this is BAU. This is business as usual. What are we going to do to it? Okay, here, absolutely nothing. Keep it exactly where it was. That's optimal. What about on the export margin? Well, you kind of do two things. Here's where it used to be. Remember from the Tau. So you do two things. You determine this value here, which is where home would be able to break even without any subsidy. And you determine this value, which the way to think about this is kind of relative cost, but what really would be relative cost is this. And then, but you say foreign really is more costly than we thought because they're using energy, which we value more than they do. And this is how much energy they use in their production. So this is the comparison we make when we're determining which goods we should want to be exporting to them. And why would they want to import them? Because we're going to subsidize exactly what's needed for them to be willing to buy them. Okay, so we kind of move from this to this, and we actually expand the set of goods. So we sort of undo leakage, more than undue leakage on the export side. Okay, so I think I'm gonna, since I don't want to run out of time to show you some of the data, but let me talk about policy for a moment. And Harold's going to talk about it much more, but I want to bring in the US as well. So you might think the US is never going to do anything. Well, the US did do something. It just wasn't very much in terms of carbon prices. But let me just look a little bit about something they might have done in terms of carbon prices with a bill that is in Congress and matches the features of other bills that are in Congress. And you might say right now going nowhere, but who knows? You know, tomorrow it could be seen as a great thing to jump on. So what do? Well, they start with a tax on extraction, exactly the way I described our implementation of the optimal policy. So that sounds good. Now, whether that is equal to the global social cost of carbon, well, there's something there because the EPA now uses the global social cost of carbon as their cost of carbon for US regulations and so on. So there's kind of a hint that they're moving in the right way in that direction. Okay. Then it says impose border adjustments on energy and goods. So on energy, it says if you're gonna, so in the US case, you're gonna be exporting energy. So what that means is you basically remove that extraction tax when the energy is exported. And that creates a cliff. So energy is more expensive in the US and foreign because we remove the tax when the stuff is exported. But we make that exactly in this bill, it's exactly the same. And so the effective tax on extraction is 0. And that's what we're saying is an optimal. Why make it the same? Why not make the removal in the border adjustment at a lesser rate than the underlying extraction tax? Okay, so that would be the main complaint here is just that they make the border adjustment too big. And then their border adjustment also applies to goods trade in the same way we would have, but again, it's too big. Okay, what about the EU's emission trading system? Well, it starts from a different place because it starts with putting a tax on production or a price on production through the cap and trade. Okay, so it's not starting with extraction. And so there are two things now. The CBAM moves, you know, Harold's going to talk a lot about the weaknesses of implementation of CBAM, but I'm going to kind of thinking of it as in its kind of pure form, it would be making the import margin unchanged, which is optimal. So there is a logic to it. And the other thing it does, which is interestingly kind of following the logic of the model, is that it doesn't remove the border adjustment on exports. Now, the only problem is it also doesn't subsidize exports. So in principle, it will hurt European exporters. And so one way to sort of sneakily subsidize the exporters is to just give them some of those export emissions permits for free. Now, why would that work? That seems like it would undercut the whole logic of it. But remember that exporter who gets those free may say, oh, actually, these are worth a lot on the market. I'm going to sell them and I'm going to produce green. So it keeps the incentive to produce with low energy intensity, even as it keeps the business, keeps an exporter in business and competitive in the foreign market. And then, but the other thing that the ETS misses completely is any sort of tax on extraction. Now, if you weren't going to change the system, which starts with the tax on emissions, how would you do that? Well, this sounds weird, but you'd actually subsidize imports of energy because Europe's an energy importer, and that puts the squeeze on your, coal extractors in Europe because you've lowered the price of energy. You've created the cliff you want, and you just do that partially. And so the ETS now raises the price above a lower price. And so it makes that less onerous to the producers because you're sort of splitting the difference. You're making the price a little higher to the users and the price a little lower to the extractors through a subsidy of imports. Okay, so quantitative experiments. Let me just go through the key points here. So I'm going to you can read later how we calibrate this. But remember this picture. So the first thing we're going to do is say, how does the size of the coalition matter? And that was point one. That was point one of the international challenge. And if you're just the EU, you can't get very far relative to what the global coalition would achieve. And it's a little discouraging, but maybe it's encouraging because it means we got to get together. The US has to join forces with the EU. We got to get China on board and so on. Okay, now what does this mean? These are all the possibilities. These would be draconian. This is what you would choose if you thought your global social cost of carbon was 190 like the EPA does. So you're not reducing global emissions very much. Like, I don't care how much Europe reduces its emissions. All I care is about how much global emissions go down. And so I'm not even looking at what the EU does in terms of reducing its own emissions, because all we care about is global emissions. Now, if the US join the EU, we can accomplish a lot more. Two things happen. The curve moves up and you move more aggressively on that curve because you're choosing an equal slope. Remember, 1 over the global social cost of carbon. If we could get the whole OECD on board, we'd even do better. If we could get China as well on board, then we're really moving reasonably close to the global coalition. Okay, so that's point one. What is this? I'm gonna skip over this because there's something that's more important that I want to show you. I'm going to now compare our optimal policy in that same terms, in terms of the kind of PPF, production possibility frontier, I'm going to compare it to a bunch of constrained policies, going to sort of see the policies that are actually in practice, where they land relative to the optimal one. And one way to just quickly get your head around what I'm going to do is think about these 4 quadrants, which are where you consume and where you produce. And a production tax hits these 2 parts, these 2 of the 4 quadrants. It hits production in home for home consumers and production in home for foreign consumers. The consumption tax goes the other way and doesn't tax that part, but instead taxes consumption that was imported from foreign. And then you might have a hybrid that combines the 2, and they may be at different rates. It turns out to be always optimal to have these 2 rates the same. So I made them the same color. This one you'd probably want to have a lower rate. So that gives you an idea of some of the different things. And what I left out was an extraction tax. That's going to be brought in now. Okay, so think about a production tax, which is like the ETS originally. It taxed production without CBAM. It's a production tax. Okay, now here it's being done not for just the EU, but for the whole OECD. That's kind of my baseline case, is OECD. Okay, so it goes like this. Why did this not go here? Well, this was kind of a recent discovery. We were thinking it was something about a computer glitch. It ends there. Why? Because leakage becomes 100%. And so you would never find it optimal to move beyond there. That's kind of like the peak of the Laffer curve or something. So this is all you can achieve. Not very good. Okay, whoops. I didn't want to do that one. So here's if you move to a consumption tax. Now that's kind of like, in principle, what the EU is doing as they put in CBAM, but not exactly, because remember, CBAM doesn't remove the tax on exports, but it imposes the tax on imports. So CBAM is a little more like this, and so you can see how that might be beneficial. Now it turns out, and this, we parameterize this with a fairly low extraction elasticity, a pure extraction tax would actually do quite well. It doesn't dominate, but it does quite well. Now, we have an extraction elasticity about 0.5. If you made that bigger, this would move down. Okay, now you can start combining them. Production consumption doesn't really add much to consumption. That would have added that little light blue corner that I showed you. Now, what does work well is extraction production. This, especially my co-author, loves this policy because it's super easy to implement. All you would do is just forget about CBAM, just have the emission trading system, have a subsidy for imports of energy, and you get this one. Because that taxes both extract. Now, but this one is not for the EU. This is taking home to be the OECD, which is why it looks so impressive. Now you can do better than that because it's still good to have a consumption tax. So combine that with an extraction tax and you get there, 0. Then you get there. And to be totally honest, our optimal isn't that much better than that. Hardly better than that. Okay, good. Wow. Well, I'll just flick this up. I think our practical policy prescriptions are, this is really the biggie, combined supply and demand side taxes. Tax extractors, don't just think about the demand, don't just think about the users. It's efficient to tax on both sides of the market. And then we have, this one is lesser in terms of its quantitative importance, but allocated emissions permits to exporters in CBAM in order to get around the leakage in the foreign market. Okay.
About Sam about the rates, and next speaker is Carlos.
Still some loose.
Okay, Sam has already said a lot about the general principles that govern international carbon taxation. I'm going to talk more about the challenges that are related to implementing carbon border adjustment in practice and as it has been implemented by the EU. Remember that in 2015, the Paris Accords came up with the conclusion to limit climate change to at most 2% of above pre-industrial levels. And that would imply an emission cut of around 50% as of 2030 relative to 1990 levels. Now, the problem is that most countries are not implementing sufficient emission reductions to achieve that goal. And the EU so far is kind of the only entity that kind of plays its part in a cooperative equilibrium. And usually it's not an idea to be cooperative when others are not very cooperative, strategic or free riding. So there comes in this carbon border adjustment that was first discussed in 2021 and was actually already implemented in 2023. So CBAM has already entered into force, and this has clearly changed the paradigm that trade policy cannot be used for global emissions reduction or as an environmental policy. So that's new, and that's also going to lead for sure to challenges of CBAM in front of the WTO arbitration institutions. Some countries have already announced that they will challenge it. But Sam has already talked a lot about carbon leakage, but let me remind you in a very simple graph why a carbon price in the EU, as implemented basically by a cap and trade system, so a quota, would lead to leakage. Namely, a carbon price in the EU will reduce the supply of carbon-intensive products by the EU. That is going to increase the EU's demand for importable substitutes. And that increase in imports will mean that some carbon leaks, because the same things would have been produced with less carbon within the EU, but now imported with more carbon. So you can see this in a very simple supply and demand diagram. So here we have a EU import market, sorry. You have supply, here you have demand. At the world price, P0, which would be the free trade price, you would be an importer of M0. You can see this here in the same in the next diagram. MD is basically the difference between European demand and supply, and XS is the rest of the world's export supply. So as the price increases, the world supplies more of the good. Now, what happens if the EU implements a domestic carbon price, let's say tau E, per unit of emissions, that will lead to an increase in the marginal cost to shift basically the supply curve in Europe to the left to S of tau E. This reduction in European supply means that for any given level of price, there's going to be more demand for imports. So MD shifts to the right to MD of tau E. And there you see that if there's only a European carbon price, but no border adjustment, there's going to be an increase in imports from M0 to M of tau E, right? So there's going to be leakage to the extent that foreign production associated with these additional imports is more carbon intensive. And that's going to be the case if the technologies are the same, because foreign doesn't have the price of carbon. So per unit of output, foreign producers are going to choose a different input mix that is more carbon intensive, right? So this is the true problem associated with leakage on the import side. But there's also actually leakage on the export side, which Sam has also explained, namely that EU producers are going to have a higher production cost, and that means that EU exports are going to be displaced by exports from third countries that in principle are less efficient, but will become competitive when the EU implements the high carbon. So there comes the European Union, and CBAM, the way it has been implemented, has three objectives, namely to deter carbon leakage on the import side to third countries, but also to provide reductions for foreign countries to produce in a cleaner fashion. So there should be reductions of CO2 emissions abroad. And there's a third objective that is implicit, namely the idea that other countries should be encouraged to introduce an emission trading system or carbon price as well. The nitty-gritty details of the regulations are such that when a foreign firm wants to sell to the EU, it will have to calculate the CO2 emissions that are embedded in the imports into the EU at the plant level. And these are emissions that are process related, or let's call it tier 1 emissions. So if you produce steels, you will directly produce carbon. Energy related, if this steel is production is fired with a coal power plant, so this creates additional carbon. And there would be tier 3 emissions as well, which would be the carbon that is contained in other intermediate inputs. And these are not going to be addressed basically by CBAM. Then the importer into the EU has to buy CBAM certificates that at the European emissions trading system price, market price, for each ton of embedded emissions. And that basically levels the playing field between foreign producers and EU producers. So it's going to implement exactly the solution that Sam has explained. This would be the ideal carbon border adjustment mechanism. So what you see here is basically if the EU in this here were to introduce carbon border adjustment, introduce tau CBAM, so a price on the carbon content of import, that would shift up the export supply curve, or basically create a wedge between a true export supply curve and the prices that EU consumers see. And that would reduce imports to the red amount, right? So without carbon border adjustment, there would be a lot of leakage. We would have the green imports, but now EU consumers see a higher price of these imported products. They basically can't substitute at all because the prices of EU products will go as much as the ones of imported products, and imports will be reduced as well, along with domestic consumption. So that's the idea of CBAM, but you see, and here I don't have a bit of a different message than Sam. Because of reduced imports, foreign market access is going to be reduced to the EU, and that is a problem under the WTO, which guarantees a certain level of market access to EU markets, right? And that's the reason why CBAM is likely to be challenged, because it's going to reduce imports into the EU by 30 foreign producers. So CBAM, the perfect is the enemy of the good, and this is usually a problem with European regulation. We are so extremely, we want to do everything perfectly, but in the end we end up with nothing. Because of the very high information needs that is required for CBAM, namely to inspect each foreign production plant worldwide according to the production process. It's very costly to do it, and therefore CBAM will apply initially only to a few sectors: aluminum and steel, cement, fertilizers, hydrogen, and electricity production. Now that is going to lead presumably to huge distortions. So even this is just 5% of EU imports, but if a European car producer who imports steel has to pay CBAM on the imported steel, but a car that is produced outside of the EU and contains steel is not charged according to the carbon content of the steel, then clearly this will lead to offshoring of car production outside of the EU. So huge distortions, and it might actually backfire because it will lead to offshoring of the downstream industries, right? Second, obviously there's going to be a lot of moral hazard involved. Nobody will want to report a very high carbon content truthfully, and therefore you really have to send an inspection team to each production plant. So it's very costly in terms of monitoring. Now these high monitoring costs can probably be paid only, they are basically shifted to the foreign firms. Only the big producers will be able to pay them. That is going to reduce basically the level of competition in European markets. So it's going to facilitate anti-competitive behavior and high prices in Europe. And because CBAM discriminates imported goods depending on their carbon footprint, so basically steel from country A is not steel from country B because it's taxed differently, there's going to be political opposition to CBAM because imports of carbon-intensive producers are reduced, right? And therefore, CBAM requires an environmental exemptions under Article 20 of the General Agreements of GATT from the non-discrimination principle. So in principle, under the WTO, you're not allowed to treat different WTO members differently. You can have only one tariff and not a partner-specific tariff. The environmental exemption allows you some leeway, but whether this is going to hold, we will see, right? For sure, it's going to be challenged. Now, there's also a fallback in case the producer is not able to report its carbon content. The EU is going to take the country-specific average, let's say the average carbon intensity of Chinese steel production. But that, of course, takes away the individual abatement incentive for foreign producers. And it might still lead to rerouting, so I can just relabel Chinese exports as exports from some other country, maybe, as we see how this has happened with EU sanctions of exports to Russia, then they go to Tajikistan or you name it. It's not so difficult. So our key message is that the high ambitions of CBAM threaten its feasibility. And what we want to do here is to propose some alternative border adjustment mechanisms that have much lower information requirements and as a consequence can be applied to all tradable goods. Because this is what you need to do in order to prevent this kind of arbitrage between sectors that are taxed and not taxed. So we want low information requirements, little bureaucracy, and applicability to all sectors. And we have two candidates here that we propose. One is an invention of our own, but it's very similar to Sam's idea that you must not hurt other countries. So what we call the leakage border adjustment mechanism that gives up on the idea of trying to reduce foreign emissions abroad. It just basically tries to keep imports at the level where they were before the EU introduced the higher carbon price. And the second would be to use carbon border adjustment, but using the EU carbon intensity of the sector. So what the EU carbon intensity in the sector is, we know very well because of the ETS, where individual plants actually have to report their carbon intensity. And that is applicable to all sectors. In the EU, intermediate goods are automatically taxed because everybody pays basically the carbon price. So the energy you use or the inputs you use that are produced in the EU automatically carry already the carbon price, right? So I can implement that carbon intensity even for a complex good that includes many intermediates. LBAM, as I said, concentrates on leakage. The advantage of leakage elimination is that it just preserves the status quo ante, so it takes away the cost disadvantage that European producers have relative to foreign producers by a tariff and potentially an export subsidy. That basically is non-discriminatory because you just need one tax, basically, that is the same for vis-a-vis any partner to undo this cost disadvantage. And in order to do that, you only need information on the carbon content of EU production, similar like CBAM based on European carbon intensity. And you also need to know something about when you change relative prices between EU products and imported products, how it's going to be relative demand shifting. So you need to know basically the slopes of the import demand and export supply. So what LBAM does is, so without border adjustment, we would be at P1. And now we set a tariff that brings the export supply back to an equilibrium such that we get the blue imports, which were the imports before the introduction of the European carbon tax, right? So we're basically undoing the effect on import demand that comes from the increase in the EU carbon price and reduce imports back to where they initially were, right? So LBAM, therefore, brings the international price back to P0 where it was in the beginning, right? So with free trade, the international price was at P0. With LBAM, the consumers see a price of P2, but the foreign firms see a price of P0, which means basically that the rest of the world is kept at the status quo ante, and therefore foreign exporters are not hurt, but they don't get the extra benefit from this additional import demand, right? And therefore, LBAM is likely to be compatible with the WTO because it implements a tariff that is not partner-specific, non-discriminatory, but also one that preserves market access of the foreign countries, which is kind of the key principle of the WTO. So much about ideas. We now go quantitative and have a quantitative multi-sector trade model where firms, there are many sectors with monopolistic competition. Production functions are sector specific. There are sector specific returns to scale. In contrast to SAM, here we take the price of energy as in exogenous, so it's not full general equilibrium. And we focus really on trading goods. Carbon emissions are a byproduct of the energy input and are a global bet. We go to a very detailed sectoral level, 130 sectors and 56 countries other than the EU. Let me give you a preview of what we find. Namely, any effective border adjustment mechanism needs to target all the sectors. So the current EU CBAM, which targets only 5% of imports, basically has almost zero effect in preventing leakage. The ideal CBAM that taxes imports in all sectors according to the carbon content, which we think is unfeasible, would of course be the first best and would be quite effective in preventing leakage. But actually, if you base CBAM on the EU emission content and not really try to compute foreign emissions, you can go almost all the way as well. The disadvantage of any type of CBAM variant is going to shift a lot of the burden on the foreign countries. And therefore, they are not going to like it, right? So it will have major trade impacts because they're going to be reduced imports into the EU. LBAM, on the other hand, keeps imports constant. If you complement it with an export subsidy, it will even keep exports to the rest of the world constant, and you can basically implement the status quo ante on all markets. Okay, so the experiment we do is we move the carbon price from $15 to $105. That was the actual change between 2018 and 2023. Then we will compute the discrete changes in equilibrium outcome in response to that EU policy change, and decompose basically the welfare effects. We look at different scenarios, either no border adjustment in the EU, the ideal CBAM, CBAM EU, which is only on these few products, LBAM, which basically holds imports constant, and LBAM X, which also gives export subsidies in order to hold exports constant. And there are some scenarios, CBAM Z, which takes basically the EU emission intensity to compute the CBAMs. So here you see that without border adjustment, that increase in the carbon price increases imports by around 11% for the average 4-digit sector. So there's a lot of increase in imports. Now the cost increase for the average sector is not that huge, maybe 3%, but given that trade is quite price sensitive, that amounts to a large increase in imports, right? The ideal CBAM, on the other hand, would reduce imports in the average sector by 8%. CBAM computed with ideal, computed with EU emission intensities would do almost the same. CBAM EU, on the other hand, which targets only very few sectors, would not prevent that increase in imports. Only in very few sectors it would. Whereas LBAM and LBAM X would just keep imports at where they were before the increase in the EU carbon price, right? Do we need very large tariffs in order to tax imports well? Under the ideal CBAM, there would be an 8% tariff increase and in the average sector, but 100% tariff increase in some versus to some partners that are very carbon intensive in some sectors. On the other hand, the CBAM, the LBAM tariffs would be relatively moderate, right? Because small tariffs are sufficient in order to keep imports constant, given that relatively high trade elasticities, somewhere between 4 and 6 that we have. On the export side, EU exports would be reduced a lot under all the border adjustment mechanisms, around -9%, other than LBAM X, which also subsidizes exports, right? We would on average need actually quite small subsidies of 3.7% in order to guarantee that exports stay constant. Emission impacts are also quite interesting. How much time do I have? 2 minutes. So remember that the EU accounts for around 6% of global emissions. China is around 30%. So without border adjustment, there would be a 29% in EU manufacturing emissions and a 0.85% reduction in global emissions. The ideal CBAM could reduce global emissions much more, by 1.4 percentage points. So there would be a gain of almost 70% compared to no border adjustment. If I compute emission intensity with the EU emission intensities and apply the CBAM, I could get almost there. LBAM X would also get us almost there, whereas CBAM EU would basically not make any difference, right? So it would not prevent leakage. Global emissions would be reduced only by 0.89 instead of 0.85%. And you see, no BAM does great in terms of reducing EU emissions. So when policymakers almost always show how much EU emissions went down, but that's actually not necessarily a good thing. CBAM ideally reduces EU emissions by less because the EU is a clean place where you should actually produce. Right? And here you see basically how this actual reduction in emission can be split into domestic emission reductions and leakage. So the green and the blue bars are basically, the green and the blue bar, yes, this is import-related leakage, and the blue bar is export-related leakage. So, and you see that the really big bar is the blue bar, which is export-related leakage, namely EU emissions being replaced by exports from dirtier production locations. And only LBAM X, the one with export subsidies, eliminates this blue bar, and that's actually quite important. Okay, I think I have to close here. We also find, I think there was a previous paper that had a similar message on the transport cost related ETS on shipping, namely that the EU is shooting itself in the foot with this CBAM because the welfare reductions on the EU are not compensated by the environmental benefit. These costs to the EU itself can be reduced a lot with border adjustment mechanism and are the worst without border adjustment. But you need to have a good border adjustment mechanism to reduce these costs. And the final message is that the CBAMs shift a lot of the cost. So here you have the welfare costs in terms of economic costs without environmental benefits. CBAM shift a lot of these costs to other countries in terms of reduced imports into the EU, but even more so, EU exports are replaced basically by exports from less efficient countries. And that's actually welfare costs to the rest of the world, right? Because now they have to import from more expensive locations, so to say. And CBAM, in addition, penalizes basically imports into the EU. So LBAM X basically makes the world as well off as it was before the increase in the EU carbon price. So therefore, LBAM is good because it will not create any political opposition because you set everybody at the status quo ante. So let me conclude here.
Thanks very much, Al.
Okay, the shift is a little bit more into the policy panel. Right.
Sorry, we're just going to be creative.
I think the organizers did something like that.
He's not sitting.
Order this backwards. What the heck?
Oh, yeah. I encourage you to take your seats as possible. Is this allowed? That's, yeah.
Or is this one?
Thank you.
I'd encourage you to take your seats as soon as possible. We have a terrific panel for you this afternoon. People who are dealing less in theory and a lot in practice. And I'm delighted to welcome them here. As you know, as we've heard this morning and in the session just now, climate change and trade are intimately related. Something like 25% of emissions are associated in one form or another with global trade. And of course, changing patterns of climate have severe implications for comparative advantage and for production and consumption around the world. But also, it's not only the direct effects on our client countries or partner countries, but also the effects on of what other external actors do for trade policy. And of course, what we've seen in the discussion of CBOM is it has, and a discussion earlier Mauricio put forward on his modeling work, shows that CBOM and the policies of the EU, but also the United States and of course China, have real impact on developing countries around the world and their choices. So those are some of the things we're going to be discussing with this panel. Let me just introduce folks around the table. To my immediate left is Minister of Environment from Chile, Marisa Rojas Corrida. Marisa has, Maisa, I should say, yes, has worked on the IPCC. She introduced herself as a scientist, which will be illuminating, I think, for this audience. She worked on the IPCC reports, the 5th report, the 6th report. She also worked with the UN Climate Change Conference, and before all of that, managed to get her BA from the University of Chile, and she's coming back to the UK here, where she actually got her PhD at Lincoln College in Oxford. So we're delighted to welcome her. I should say her PhD is in astrophysics.
No, atmospheric.
Atmospheric physics.
Astrophysics.
I guess there's a little difference.
A bit closer to Earth.
Down there.
Yeah.
To her immediate left is Ali Swaraz Hussain, who is the Pakistani ambassador to the WTO. Before that, he was the chairman of Planning and Development Board in Punjab and held various positions in the Punjab government in Pakistan. He has an MBA from INSAD in Geneva. He's now back in Geneva. Must feel like going back home. And a BA in engineering from the University of Texas. And to my far left is, I'm not sure politically, but at least geographically, is Catherine Wolfram, who is a professor of economics and energy, applied economics and energy at the Sloan School of Business at MIT. She was a professor at the University of Berkeley, University of California, Berkeley, in business administration. She was associate dean there. Director of the NBER Energy and Environment Program, and served for a while in the Biden administration as the Deputy Assistant Secretary for Climate and Energy in the Department of Treasury. She has a PhD from MIT and a BA from Harvard. We're delighted. This is a policy focus group that has sort of combined research and economic analysis with policy questions. So I think you might be going to think about the questions you'd like to ask them, because we'll have a chance to hopefully do that. But let me start off by asking Minister Rojas, we've been talking a lot about trade policy as the primary instrument to get to net zero. What do you see as both important policy instruments, and secondly, maybe the role of trade policy itself?
Okay. Well, first of all, many thanks for the invitation. Delighted to be here. Before becoming minister, I had only one job in my life, which is a university professor. So I feel very much at home. So this is the first time I'm actually outside the university in the current job. So it's nice to be back at a university. Well, in the case of Chile, I would say that we have a natural condition which was a very terrible condition for a long time, and then at the moment it is a positive one, and it's that there are no fossil fuels in Chile, and therefore up to 20 years ago, 15 years ago, and started I guess sort of 10 years ago, being Minister of Energy was sort of the biggest nightmare, the worst job you can get, because energy security was a tough problem, and you can see actually they lasted very little. They were changed quite quick, and then that situation became actually a positive one, because we actually had loads of this new energy, renewable, non-conventional renewable energy, and that of course has then helped to change our energy matrix. And I would say at the beginning it was really energy security issues to start going into renewable energy, and that then at some point allowed us to have a very coherent climate change agenda. And we have since 22 a climate change framework law that has two objectives. Chile is going to be carbon neutral at the latest by 2050. So it addresses the cause of the problem, right, through mitigation, but it also has an objective of being resilient to the effects, to the adverse effects of climate change. So adaptation, the consequences of climate changes. Well, both of those are in there. And it was very interesting to see these two presentations and understanding all the, especially the second presentation, all the sort of nitty-gritty problems that are which trying to solve a problem through this leakage, addressing leakages. And I see there are still a lot more questions than really answers. And so I would say that the answer in Chile at the moment is just home is just Chile, in a sense that we are really reducing our emissions, making sure that our forests still capture what they have to capture, but reducing the emissions. And so a very straightforward, well, not straightforward, but it's an energy transition that that was sort of based on this not having fossil fuels, having loads of available natural resources like sun and wind and geothermal, etc. So we could potentially include those in the energy metrics as well. And I would say that what does to speak to trade is that there's a very important aspect of the transparency included in our law and in the way that we are implementing this. So, which means that sort of all these complicated questions on actually what is the energy intensity of the production of that and that good should at some point or is being built up because we have a monitoring, verification, reporting system. There's a platform. We are doing this with not just the energy sector, but with the individual companies as well, et cetera, et cetera. So, and Chile is, of course, a country that has loads of trade agreements. We have a very small economy, so it is very open. And hence, I guess, sort of the framework for the transparency of the data, of that part of the information, and cleaning up our energy system, which accounts, in the case of Chile, for almost 80% of our emissions. So it's a very important part. So agriculture is much smaller, and in the other sectors, industry. Yeah, I would say that's the backbone of the way we are addressing climate change.
You mentioned two things that I find really interesting. It might be worth a follow-up question. One is, how are you doing in terms of implementation of policies and actual achievements towards moving towards net zero?
Yeah.
That's the first one. The second one has to do with measurement of carbon intensity of production. Because of course, that's one of the key criteria that apparently the EU would like to apply.
Yeah.
How is that factoring into trade decisions?
So in terms of emissions, and I think Camila just left. So there was someone from my team who's actually in charge of our greenhouse gas inventory, but I think she had a meeting at 3 somewhere else. So
we'll go find her.
No, so I mean, as you might know, many developing countries have very basic greenhouse gas inventories. In many cases, there's basically a team from abroad that comes in and does it every, I don't know, 3, 4, 5 years. So it's the data is not so good. We have had our in-house, I mean, we are doing it together with the other sectors since about 10 years. So I would say it's not the super basic, it's not the super sophisticated, it's somewhere in between. So we are in 2024 and our inventory goes back to 22. So it's sort of 2.5 years, which I personally still think it's too old, right? Because you can't really see what is happening. But the short answer to your question is that our emissions from the energy sector, and as I said, this is 80%, and the electricity sector is definitely going down. So we already peaked a couple of years ago. The problem that we are having at the moment is that electricity generation is going down because we have shut down a very important number of coal-fired power plants, but the transport sector is of course going up. The pandemic there did go in the opposite direction. Many people bought, I mean, being a middle income, still developing country, we haven't reached the level of, I mean, not everyone that could have a car has a car yet, right? So bending that curve is going to be a lot more complicated. But yeah, our emissions are going down.
Good. Well, that's good news. Let me turn to the case of Pakistan and ask you, Ambassador, similarly, how do you see trade policy and climate change in Pakistan through the lens of your policy? But I'd also ask a second question, which is from your seat in the WTO and the Trade and Environment Committee and in several of the other committees, environment is creeping into the discussion. And of course, in the previous discussion, now there was reference to the WTO rules. How do you see, question one, the discussion on bilateral or unilateral policies being taken in the EU or the United States as entering into the discussions in Geneva? And secondly, do you feel that developing countries have a seat at the table in discussing these things at the WTO?
Thank you very much. First of all, it's a pleasure to be here, and I thank you very much to the two presenters. I can now clearly understand the underpinning of the CBAM, the theoretical underpinning from Samuel's presentation. So thank you for that. That was not something that the EU ambassador was able to explain in the WTO. So after,
I learned a lot.
After getting bashed by all the other representatives, he finally brought in a team from the EU and he placed them in front of everybody that listened to them essentially. And I would also like to thank Harold and seek his permission. So henceforth, I'm going to start quoting him that CBAM, strictly speaking, is not in compliance with the WTO rule.
I think you may have known that before.
But it would be fantastic to have the professor, and actually if he'll allow me, I'll use his presentation to make a presentation during the upcoming Environment Week. And so first of all, thank you very much. It was fascinating. And the alternates to CBAM are also very interesting because we read carbon leakage as protection, essentially increasing the cost of imports for the EU. And one of the questions I had when I was looking at the first presentation regarding the model and was explained was a static model, is we have to see policy in the context of history. because the entire Paris Agreement was based upon a couple of principles. Well, things are not happening in other countries is because the polluter pay principle and the common but differentiated responsibility principles were agreed in Paris Agreement. It was also agreed that those who have actually contributed to the problem will pay for it. And there would be a contribution of 100 billion per year, which has not happened. So hence, not much movement that you will see. With respect to undertaking projects which are towards mitigation and adaptation in developing countries. I'm going to just touch upon very lightly on Pakistan, and I'm going to arrogate to myself the role of presenting the viewpoint of developing countries. Or let me put it in this way, IDA eligible developing countries and the least developed countries, because we collectively have a position at the WTO. And we have collectively put in proposals. So I think it would be befitting that I present that. With respect to Pakistan, we have a very clear NDCs. And they were dependent upon two things. Some that we will have to achieve based upon our own budgetary resources and allocations. And the others based upon the support that we will get as a result of the Paris Agreement. We are not getting there because the kind of investments that are needed to be made, we are not making. But we contribute less than 1% to the global emissions. And we are one of the most affected countries. So when we are told that there are going to be, I'm not just talking about CBAM, but there's a whole suite of regulations built around the Green Deal, which impact, and by the way, CBAM doesn't really impact Pakistan because the 6 sectors, we are not exporting products in those sectors, in the energy intensive sectors, but there are other developing countries and LDC which will be impacted by these provisions and regulations. I don't need to say that they are in violation of WTO rulebook. Even the subsidies, and the EU is trying to give subsidies, environmental subsidies, which again are not as per the rule book. There are countries which are giving billions of dollars of subsidies, fossil fuel subsidies. Maybe they should take that away and fulfill some of their commitments. That may have a huge impact on environment. I would not like to name members because that's normally not what we do at WTO. We just say our member. So
you're among friends.
Yeah. Oh, that's very dangerous. I don't want to go back to Geneva and hear from my colleagues. What were you talking about there? Trade is not just that discussion is taking place in Geneva. I think it's getting very intense. It's also getting intense because we see that there are tariffs on products which are going to improve the environment, right? EVs, solar panels, batteries. But then we see there's a trade war which is brewing up. So is it really about environment or the global good that the very first slide presented? We should be then open and allow all the environmentally sound technologies to permeate at a very low cost without a huge cost of patents. But that's not what's happening. That's first. The second, environment is really becoming important. And let me give you just one number. In 2023, there were about 4,000 notifications which were made to the Committee on Technical Barrier to Trade, which is the TBT. And 1,000 of those mentioned that the reason this particular technical measure is being introduced is because of environmental reasons. So you can imagine that environment is taking a front seat. The Committee on Trade and Environment was actually established and set up so that environment is not used as a barrier for trade. But I think increasingly the discussions or the proposals that are coming in actually are looking at how do we protect environment and use the trade policies such as carbon tax, border adjustments, subsidies, government procurements. There are about 10 listed potential policy options which are discussed. But a lot of them
go against the very core of the multilateral trading system, and that's where the tension is. It will continue, and we'll see how it plays out. So I'll stop here. Thank you.
Okay, but you didn't mention the suite of regulations that are occurring, not only at CBOM, it's the deforestation regulation appears to us and those of us working on Africa to be terribly important, right? And the administrative requirements for that are extraordinarily high. So to satisfy and buy permits and administer the system, not only are trade costs going up, but it's likely to discriminate, ironically, against the small countries that can't afford to pay those costs and push the products, in this case, forestry-based products, let's say, towards the large exporters, some of whom are the biggest violators of deforestation. So you might think about, I wondered if this is being discussed in Geneva or elsewhere. You know, there's the EU discussions with the ACP countries, with the African Union. Do you feel that the developing countries are being adequately represented in these discussions about foreign regulations and their impact on developing countries?
You're correct. Deforestation is something which a number of Latin American countries are very concerned about. Indonesia, Brazil, for example, which are the two also happen to be the G20 countries. Then there are EU waste regulations, which are of concern and are discussed. The developing countries and the LDCs are presented in the discussions. So the discussions do happen, but WTO system is actually under stress at this point in time because one main function, which is normally referred to as the crown jewel of the WTO, is dysfunctional, which is the dispute settlement. So my fear is that everybody is going to start doing whatever they would like to do, which will actually result in net loss of global welfare. Because if tariffication and if trade wars start and they start to expand, a lot more countries are going to engage in trade wars without any agreement on what are the rules of the game. We have the rules. At this point, a lot of countries are violating those rules with impunity.
Let me turn to Professor Wolfram. You have been very involved with U.S. policy, and I know follow it quite closely. And the Inflation Reduction Act has been touted by some as being a terribly important climate change piece of legislation. How do you see that and trade and climate change policy generally in the United States? And what would you like to see change, maybe for the better?
Sure, thank you. I guess I should say at the outset that I'm not really a policymaker. You went through my resume and I spent 20 months in the Biden administration. There were 20 awesome months, but my comments are kind of more weighted towards being an academic who, I've kept up with policy. I really liked both papers. That's an academic discussion, usually said at the outset, but in this case, it's true. I think they're a really nice combination of kind of theory and simulations. I do think that both papers do not address what I think is the most important part of CBAM. And I'm going to talk about this more in the public lecture tonight, but that is the fact that CBAM is generating these policy spillovers. So the fact that countries are credited with that whatever domestic price they pay when they go into the CBAM has really started a global conversation around carbon pricing and led to, I've documented this in a forthcoming policy brief, a bunch of countries either like formally adopting carbon pricing in the case of Ukraine and Turkey, or like thinking about it actively. So I think that's the best thing that CBAM is doing. We can have conversations about WTO compatibility. I guess my own thinking is that that just shows kind of the failure of international institutions, that we're talking about climate change in the context of the WTO, and we're constrained by the WTO. We should have a way to have these conversations that kind of puts climate first and thinks about minimizing emissions and whatever, rules we want to have to generate those emission reductions in the most equitable way. Okay, so getting to like trying to put on the policymaker hat a bit. Yes, the US passed the Inflation Reduction Act. It was a massive, or it will be a massive set of expenditures. Estimates are that it'll be about $1 trillion over a 10-year period. I think relevant for trade is we are taking the subsidy approach. We are throwing a lot of money at industry, at power generation. And it's non-trivial from a trade perspective. So I've seen estimates that suggest that manufacturing clean steel in the US, where you get tax credits for using carbon capture and sequestration, will be like 43% cheaper than manufacturing clean steel in Germany, even though Germany, you avoid the ETS price by manufacturing clean steel, but you're not getting these subsidies. So the subsidies are real and, I think have the ability to affect trade. With that said, so I guess one of the reasons I really like Sam's papers is they kind of make me think about carbon pricing in different ways that I hadn't before. So I wanted to make two comments. One is the idea of kind of the extraction tax and thinking about not rebating exports. Like the US is exporting a lot of fossil fuels, more and more, actually, even during the Biden administration. So as part of some kind of policy related work that I've done with a set of co-authors, we've calculated that the US could double the fiscal revenues that we get from carbon pricing if we don't include those export rebates. That it's a huge, we're exporting a lot of fossil fuels, so it's a huge component of it. That said, just one kind of from the practical perspective comment on Sam's work. I think theorists like to think about things in nice, like straight lines and no capacity constraints and no kinks. I've studied the electricity industry for long enough. Like I think in supply curves that are step functions. And in the case of US fossil fuel exports right now, there are huge capacity constraints. So we just don't have the LNG capacity to be able to export as much LNG as we could. So right now in the US, approximately we're facing a $2 per MMBTU price for gas, whereas the EU is facing about $10 per MMBTU. So we think that one of the big effects of not doing the export rebate would be just taking rents away from the people that are, exporting gas that they could have sold for $2 and selling it instead for $10. So I think like these capacity constraints are real, and before you get the US, tax on natural gas extraction affecting the EU price, that comes a long way. The carbon price has to be very high because first of all, what you're doing is just kind of extract or reducing the rents that people are collecting because of the constraints. I also had thoughts on the idea of these export rebates, and it does take me back to the IRA. So Biden likes to say, when I think of climate, I think of jobs. And usually my reaction to that is, okay, that's political. You have to say that. But from an economic perspective, it doesn't really make any sense. But I think the idea in both papers of thinking about export rebates as a way of encouraging the rest of the world to consume the clean stuff that the US or the EU are producing, I think that's a powerful thought process. And, maybe it doesn't fully justify when I think of climate, I think of jobs and the huge subsidies, but yeah, I would love to hear both authors say more about, okay, they're talking about export rebates where you don't tax. What about subsidies that like the ones that the US is doing? How do those factor in? I mean, my loose thinking is we're probably consuming too much of the good because it's being subsidized, but the fact that if we export this clean good around the world, that's a good thing. Yeah, I found that idea intriguing. I'll stop there.
Super. I'd like to turn it over to the audience so you'll have an opportunity to ask some questions. I would like to conclude, however, with a question that you can think about while we're doing other questions, which is what kind of research questions from your immediate policy perspective would you like organizations like the LSE, like the International Growth Center, to take up from your perspective that kind of haunt you and you'd like to have more research and analysis undertaken? But maybe that's a question we can come back to as we conclude. Open it up to the audience for some questions. Kathy, would you say your name and
Hi, Kathy Crum, IGC Country Director for Ethiopia. I picked up on what Catherine said about the spillover of CBAM of all its problems. So a related question is what might be consistent with the trade framework that still would reward poorer countries that are cleaner energy, hydro power driven, but avoid some of the pitfalls that come from this being used as really protectionism. What are some of the very practical things that are being discussed so that there can still be those incentives in place without being protectionist and without being discriminatory?
can I take one or two more questions and then we'll go to the panel? Come on, folks, this is a real opportunity to have representatives of Latin America, representatives of Asia, and representatives of the academic community. It's really the country directors of the IGC are not the only ones that have. Let's have one.
Yeah, well,
we'll come back to you, Claudia.
Yeah.
Marla. Another country director.
My hand down when you said
that. I couldn't see you from there.
My question is like, and it seems that in the last couple of years, there has been a recognition that to achieve the sorts of broader changes that are driven by the technical discussion we're having, there needs to be also this sort of movement in environment goals. And I wonder whether you could speak a bit of that. I think it broadens the conversation, but I find it very interesting that we've been talking about limits to growth at least since 1992. And we still haven't really achieved the behavioral change. So I just wonder whether this whole advantage of having to speak.
Super. We have a question for Catherine and a question for Maisa. Maybe we could take one for Ali or generally to the panel. Okay, Claudio, just by default.
Actually, it's for all of them, by the way. Thank you for the panel. I want to first make a comment, strengthening or ratifying Catherine's observation of the somewhat quote-unquote unintended consequences of certain measures or potential threats. In the case of deforestation, which obviously is quite important from a number of countries, not only Latin America, but also in sub-Saharan Africa. One of the consequences now in Brazil is that actually, obviously, there is no consensus on this in the country, but the measures from the European Union are actually helping spur, again, a debate and strengthen the notion that by 2030, deforestation should be driven to quasi-zero. It's not going to be zero. Then, of course, that raises the question, how much is it going to cost and how it's going to be funded? But the first question is, if we are facing barriers which are fairly objective, they're going to come about in markets which is relevant as the European Union, you cannot simply hide your head into the sand. So I think these are, I'm not sure if it's intended or unintended consequences of, you mentioned CBAM and the fact that many countries or most countries are now concerned, they're now thinking about the correct pricing of carbon. mutatis mutandis on deforestation. But I agree with Richard, that, okay, there is an administrative cost, and this also has to be thought of being also financed, particularly in poorer countries. In Brazil, that's not a real issue. The real issue is the power of the agribusiness, particularly those which are still bent on deforestation as a means of expanding areas, which are really, strictly speaking, there's no further need. So anyway, wait a minute.
I think there was a question there. Let's start with Catherine and just go backwards on the panel here if we could.
Hey, Richard, and LCD.
Yes, please, okay.
No, we're going to ask for a question for me. I wanted to ask if you could explain why the statements are.
Oh, a legal question. Okay, Catherine, let's, if you wanted to take the floor.
I guess I would like to hear Ali's answer first. I mean, I think that was gonna be my response to Catherine, is that let's not presume that the WTO is gonna reject CBAM. It's been pointed out to me that if the EU had not been concerned with WTO compliance, the CBAM would look very different. It would be much broader, it would contain export rebates. So, I mean, just because they designed it carefully doesn't mean that they succeeded, but yeah, and I'm not a trade lawyer, so yeah, I would like to hear Ali's response first.
Would you please speak to the entire WTO?
No, I'm not a trade lawyer as such. I'm a trade negotiator. And in negotiations, you try to get whatever the best you can within the total pie. And first, our negotiating position is absolutely clear. I would agree with you and your observation with respect to governments around the world having conversation around what's the impact going to be on CBAM, what is to be done, and that something is to be done. It's not just because of the EU's CBAM, but the UK is also bringing its own CBAM. And although some of the industry, at least in case of Pakistan, are not affected with respect to the EU, but they would be impacted with respect to the UK. Why we think it's not in compliance with the WTO rulebook. The first was in the slide. I'll refer to Harold's slide. Which mentioned about the MFNs. There is a clause under Article 20 in GATT, which does allow measures to be adopted with respect to environmental protection of actually human life. But you cannot violate the MFN principle. That's first. So I think the proposal probably with respect to general increase in tariff, which you refer to as leakage CBAM in the presentation, probably that would be compliant, which is a general increase in tariff rates, as long as it's within the boundary. And that's the first. The second, what is the schedule of commitments? These kind of taxes are not mentioned in the schedule of commitments in the GATT. There may be other duties and taxes because the preference within the WTO is tariff, because the tariff is very clear. So these are the two reasons I think that it's not in compliance, but it will be adjudicated, that's for sure. A lot of members at this point in time who are ready to challenge it. We'll see when that happens.
But as you pointed out, the judicial system in the WTO is basically non-functional.
Thank you, US. Yeah.
Right. Thanks to the US. So, Catherine, please.
Yeah, I don't have anything to add. I think we shouldn't give up on the CBAM, and I took your question to be asking about kind of alternative structures. So.
And by the way, with LBAM, did I understand correctly that if we use EU intensity measures, we will miss rewarding countries that are greener? And so is there an LBAM but help hydrogen version? That would be what's this practical thing of LBAM where you wouldn't just use EU sector intensity, but you would again continue to, in a fair way, make
How to incentivize those who are doing good?
And I would add how to have the policy, how to generate the policy spillovers, like in Alabama where you credit for an existing carbon price.
Well, you can sign a free trade agreement with that particular country and give them additional tariff reductions. Or in the FTA agreements, they can include provisions that cleaner the goods are, the better it is. The the plurilateral agreements are in compliance with the WTO rule book. But I think the ones that have been signed by the EU are with, well, at least with one of the country which is among the highest polluters, and there's no particular provision with respect to changing the behavior.
Let's turn to Chile because you had a question from one of our African country directors, and so I'm sure we'd be interested in your answer, Minister.
Okay, I was looking at my notes from our foreign ministry, who is in charge of trade, so that I could talk a little bit about the country position rather than my personal or even the one from the environmental ministry. And I think it is very, let me just first reflect on some things that the other panelists have said here, that the one of the positive outcomes of this whole CBAM issue is that many countries are thinking on implementing their own carbon tax, etc., or how to do it. I mean, at least it is having this conversation, and I guess having this panel is a result of that as well. In the case of Chile, and this I hadn't mentioned before, so we have a social cost of carbon that just went up from $30 to $60, and there's a curve. It's going to continue to go up to, so it's a gradual increase. We have a carbon tax that is already almost, it's 10 years old, and it started with $5, but I guess the problem was that it was not, a gradual increase was not included in that legislation, and we have been trying under this administration to reform this, but we haven't had the political space to do that yet. But there was a bit of, so our carbon tax is just $5. It's really, really small. So it's good to have it, but it's not super helpful. It doesn't really move the needle that much, but it has the possibility to compensate now. And something that is very interesting, I find, and I'm not sure if this is done in other countries, but actually the worst environmental problem in Chile is air pollution. And our carbon tax does allow to compensate not just CO2, but local air pollution as well. So that's a very different problem, I know, because the first principle of this conversation is that CO2 doesn't matter where you emit it. It's a well mixed greenhouse gas. Whereas local air pollution does matter where you put it, and it has a local effect. So I find that part is very interesting because it helps really in a very, very important development question for the country, which is how do we clean up the air of us that we breathe that. So it has an important, it's related to poverty, to health, of course, etc. So that instrument, I find it's very interesting. And the other thing is that with our climate change law, we also have now I don't know the word in English, reglamento, I think it's statute, like it's a regulation, like an internal regulation to how to apply Article 6. So as I said before, Chile has a very open economy. I would say that when those trade agreements were negotiated, if it had an environmental chapter, we have it, and we comply with that. We've sort of, but I don't know how much we have pushed for it. But much of our environmental legislation has been the result of one very important part, of course, is getting into the OECD. Yeah, that created the Environment Ministry, for example. So that is so I don't know if I answered the question about sort of development and climate change and the need for growing still and limits to growth. I think in the case of Chile, we still think we still need to grow in a different way, definitely in a different way. And there's an industrial policy under this administration that is trying to develop an industrial policy through our national lithium strategy, our green hydrogen strategy. And this law that we have, it involves 17 ministries. So it's really a whole of government approach. So yeah, I leave it there.
That raises the issue of interministerial
Coordination, yeah.
I'd love to get into it. Some great How much time do we have? Do we have enough time for another round of questions? I see you saying yes and you saying no. So we're going to say yes. One more quick round of questions before we answer the research question that I hope you folks are verbally while thinking about. Country economist from Rwanda, Christian Lippert.
Yeah, I have a question about the implementation of the international trade regulation. So I recently talked to an NGO who does like satellite measuring of deforestation, and they for the deforestation. And they talked to Ethiopia saying that okay, it costs every year $60 million for the government to measure each parcel of land. So it's too costly. Then I talked to the EU, and they could do it like countrywide, which would be like very cheap, but the EU doesn't want that. So I'm wondering how you see like this kind of like trade-off between like thoroughness of measurement and sort of like the ease of implementation of that. Also in terms of like shifting incentives from the individual firm to maybe incentives for more like public policy making if measurements are done nationwide.
Maybe can I just ask my sense of sort of, have you folks thought about this? Because deforestation must affect your export portfolio as well. Is that something that's on the radar screen and the cost of trading? Do other people want to chime in on that one?
Yeah, I guess I've said good things about CBAM. I think it has these positive spillover effects. I think the measurement challenges are very real. That said, and maybe this is an answer to the research question or one answer, I think there's been tremendous technological developments in terms of satellite measurement. So I would love to see that frontier pushed. And I think right now they're not super accurate. I've been looking into this for measuring methane emissions from satellites, and they're like plus or minus 10 or 20%, which we can't use to make payments based on. But that said, you can use it to kind of check compliance. And maybe there's a way to base payments based on them. Like if you think there's a plus or minus 10%, just dock all the payments by 10% or something like that. I don't know. I guess I would like to see a combination of economic research and kind of technical research on, given these new technologies for measuring like non-coordinated or non-compliant, non-cooperative countries even, we can measure Russia's methane emissions by satellite. So I think that's kind of a cool new frontier.
Actually, that goes to the research questions, but perhaps, yes, please.
I mean, I work on deforestation. I guess there is a lot of new technology for deforestation, and it's improving very quickly. I think there's certain NGOs like Unequal that have done great work in Brazil. They're expanding to other countries, so maybe Ethiopia team should get in touch with them. I know they're now doing it for Indonesia, so it's something that's actually ongoing and happening in real time. So I think that's something that is at the frontier. I wanted to ask Maisa about to hear a bit more about the lithium strategy, and given that we've been talking about these kind of tariffs on goods and the sort of trade war that's going on with EVs and all this, whether Chile is being affected by this and whether there's some type of response that the country is putting together to the situation.
Yeah, I don't think we are being impacted at the moment. I mean, I think that the complete answer would be very long to explain because it's a very complicated legal system that we have with lithium, which is very different to anything else in Chile. So, but at the moment, there's only one company who is exploiting and extracting lithium in one salt flat, and it's huge. So that all the lithium is coming just from there. And the strategy has a number of objectives. One of them, of course, being more extraction and trading of lithium. It's an industrial strategy, but it has at least 2 environmental objectives as well and a couple of scientific objectives as well. So from the environmental point of view, the idea is that on the one hand, that we are going to shift from the method of extraction for the new extraction concessions. So not, I don't remember the word in English, but basically they take it there and it evaporates and you get the lithium. I mean, it's very basic. And there are other types of methods that they are trying to using now. So that's one thing, and that's of course good because it will have less environmental impact. But the other part, which is I'm especially fond of, is that we are going to preserve 30% of the salaries because, and therefore comply with our biodiversity framework of 30 by 30, you know, 30% of important ecosystem protected by 2030. So we have already done that. We looked at all of them. And 30, the most valuable ecologically speaking, are going to be protected. I mean, protected areas. So and then there's a lot of scientific, technological objectives as well, which are very interesting, I think. So it has been a complicated conversation, but I mean, from what I heard from my predecessors, sort of, you know, mining and environment are not the best friends usually, because mining has a big environmental impact, and Chile is a big mining country. But in this case, we have had really very, very good work together, and we've been able to think this is a strategy that has multiple objectives, and there should not be seen as trade-offs.
Yeah. Let's go down the panel just for quick research topics. What keeps you awake at night that you'd like to have a little bit more information / research / economic analysis that maybe this audience might be motivated to provide?
Does the topic have to do the environment?
No, well, sure. Maybe.
How do we make the WTO environmentally friendly or change it?
Good luck. I think one of the questions that is important, we can't look at environment just in the context of trade only. It's complex, it's spread across. And I think one of the research questions we would have is how to achieve coherence across different entities and organizations. So UNFCCC, WTO, WIPO, and there was yesterday a question around health that would also be WHO, because there has been discussion on One Health concept and framework that looking at animal, plant, human health collectively, which means environment will definitely be impacted. So one of these is how to achieve that coherence across, because, you know, in WTO, when we talk about environment, there are other things that we also ask, which have been agreed in other forums, but then we hear, well, no, that's not relevant. So, and that's why the discussion on environment doesn't succeed is, so how to do that? I think that's one thing that's important, because that's something on which the developing countries get a pushback.
So how to get the international system to work together. That's a small research topic. There must be somebody out there that would like to have.
So you can put it in the context, it's just environment across some of the organizations. So, reducing the scope of it.
I mean, in some ways, I just would advocate studying this topic in general. I think climate and trade is huge, and it's gonna be even more important in the years to come. So for grad students, I encourage you to think about this topic. I would also, I mean, this is kind of like a comment on the papers too. They're awesome, but I do think that they miss kind of the like dynamics and spillovers. So if the US is subsidizing green steel, is that going to lead to a subsidy raise? What are the dynamics of that subsidy raise, right? Like in Sam's model, he fully admitted the rest of the world is passive, but what if you make them not passive and they have some kind of response? And yeah, I mean, then Ambassador Ali referred to the idea of bargaining positions. How do different policies kind of shift the bargaining space? I think, yeah, I think kind of, in some ways, I think the economics profession has really focused on firms' incentives because firms are the emitters, but the policymakers' incentives are even more important because the policymakers are kind of coming up with the structures that affect how firms make decisions.
Minister? I know nothing keeps you awake at night, right?
No,
You had schooling up
yeah,
and
no. I'm thinking, I have many questions, but I'm just thinking if they were relevant to this audience. There's one thing I didn't mention, and I think it is sort of complicating the view a bit more, but I think it's incredibly relevant, which is the natural capital. And in the case of Chile, well, we have a natural capital committee now, and it's starting to think about how to include this in our economy. But it's, I mean, at least for me, it is still not very clear. I mean, I have some ideas of where we should start, etc. But how the whole discussion between climate change and loss of biodiversity come together. I know this is an extra complication, but I firmly believe that both are really two sides of the same coin, and therefore working them separately, it's not going to give us a complete and correct answer. That's sort of on one hand. And on the other hand, from a policy perspective, really is that, all these models that we saw are still very theoretical and sort of thought by a mathematician, a physicist, or an economist. But to have the correct incentives and being able to implement them so that the winners and the losers are not the same, and you make sure that the losers are not the most vulnerable, etc., is I think something that in many more theoretical policy making, and even I would say, OECD stuff, it's really still lacking. And I see it even in our own ministry. We have a division on environmental economics, and when they calculate the costs and the benefits, they're quite disjunct, and they don't really speak. And then we have the norm, we have the policy, and then people tell us, yeah, sure, this was, of course, invented in Santiago downtown, and you have no idea of my reality here on the ground, on the rural side, south, north, whatever. So something like that.
Very good, very good. It's been a terrific panel. I've had a great time. Join me in thanking the panel for what
Right, sorry, where's the microphone? If you just speak, these two will get it. Okay, great. Thank you.
Good afternoon, everyone. Thank you all so much for being here. My name is Jing Lee, and I just started as an assistant professor at Tufts University. This is joint work with Catalan Sprengel, and it's about entry and coordination in the electric vehicle charging industry. Each of us have presented earlier versions of this project at other venues. We have some new setup and results that we're excited to get feedback on, and this is still work in progress, so all your comments and questions are welcome. There are spillovers often in many settings when firms make entry decisions, and often these are thought of as negative spillovers. So when one firm enters, say, next door to another firm, there could be business dealing, and that would be considered a negative spillover. But there are also often positive spillovers, usually in network settings, so such as ride sharing or telecommunications. If you combine the presence of spillovers in a positive sense with independent decision-making, then there's the potential for inefficiently low entry chosen by the market, which would then warrant government policy. And we're interested in studying the role of spillovers in market and policy decisions in the setting of electric vehicle policy, and specifically focusing on charging stations for electric vehicles. Electrifying transportation is a key part of reducing greenhouse gas emissions and local pollution. I guess the Minister of Chile previously to this session made a good case for why this is important as an industry to think about. So we're focusing on charging, not the cars and the purchases and the tariffs and so on. So we're going to study the charging station entry decisions in this industry in the US. And we want to ask whether the market coordinates entry efficiently across different locations, and whether the subsidies that governments could potentially offer into this industry could improve the market functioning. So I'm going to jump right into what we mean by positive spillovers or the potential for them. So we're thinking about a setting where you have two cities named S and T, and they could be connected by some roads such as the highway. And in this part, in this illustration, we have 4 potential locations where charging stations could enter. The solid circles denote where charging stations already are present, and the open circle is where an entrant is thinking about entering. So in this illustrative example, the last entrant that is thinking about entry could be connecting the dots in a sense. So if you have electric vehicles that have a range that is right about this length, then they could be connecting the route between these two cities and thus increase traffic on this entire route for electric vehicles and increase the value of the incumbents that are not immediately near this potential entrant. And then this last entrance, private value of entry, also depends on which incumbent have already come in. So this is the kind of setting we're thinking about and the starting point for our empirical investigation into whether this type of positive spillover is present in the charging industry. So if you combine the presence of the positive spillovers, which we will empirically test for, and market features of whether these firms are making independent or coordinated decisions, then you could generate inefficiently low entry in this market, which would then open up the possibility for public policy to improve outcomes and welfare in this market. And we think of this illustrative example and this kind of spillover as a different kind of market failure from the environmental externalities that have so far been the major motivation for a lot of policy action in the EV space. And this is also a sort of more specific form of indirect network effects. So as the market thickens and grows, this starts to look more like a traditional two-sided market, two-sided network effect setting. But in the early stages of the EV market, when the entire route may not even be traversable yet by an electric vehicle, these are the positive spillovers that we are thinking about. So our specific research question is, we have one sort of economics question that generalizes to any other setting that looks like this, and then a specific policy question that is unique to the US, but there are similar policies elsewhere, such as in Europe. So in 2021, the US government passed the Infrastructure Investment and Jobs Act. And in this piece of legislation, they devote $5 billion toward improving EV charging infrastructure. And then in follow-up guidance, they specified that they want to devote these funds to ensuring that charging stations are available every 50 miles along US highways. So to us as economists, this seemed like a very, very specific form of subsidies, and we wanted to know whether this is justified by economic theory and evidence. So our first question for research is whether there are positive spillovers across electric vehicle charging sites. And then second, how would the money from the IIJA improve the charging network in the US compared to alternative policy design, such as a uniform subsidy where, say, anyone who wanted to take this up could get cheaper entry costs, for example. Yes.
Can I just have a curiosity? On the diagram you showed before, does this choice that to put a station on interacts with availability of transmission network such that electricity arrives to the location where an entrant might decide to do it?
Yes, yes. So in this example, it's very stylized. So there are 4 potential entry locations. If you want to add in real restraints or constraints from the real world, you could say, oh, these are the 4 places where the electricity infrastructure is adequate to support entry. Or suppose it were not, then like this would not be a potential entry location anymore. And then I actually have some other line examples like this where it's not so evenly spaced and the goal is that, yeah, so any kind of real world constraints like transmission and, just is there a parking spot or is there the road that allows me to reach this point? Those would all be encompassed in whether this point is even a potential entry location and how we think about it. Okay, so some other basics of electric vehicle charging that I would like to get into your mind so that we're on the same page. I hope that for this crowd, I don't have to go into the details very much, but so I think you also have all seen charging stations. I walked past some on the way into this building on the LSE campus. So we're calling a charging station a collection of charging equipment. So along the park outside of this building, there was sort of like 5 or 6 different charging points. In our data set, we would call that one charging station with, say, 5 connectors. So we're thinking about them as a collection of charging equipment that is at some particular site. So LSE in this example would be the site host. And they could be non-networked or affiliated with a network. I didn't look closely at the campus chargers, but a network offers a group of benefits. So they may have helped with the hardware installation. They may be helping with the operations and the payment and also any kind of ongoing maintenance. They may also have branding. In this case, this is a charge point station in the United States. There are still 3 different charging standards in the US for fast charging, and there are some adapters and collaborative agreements evolving in this market. When in our data set, whenever and wherever there are different standards with restrictions on access for different vehicles, we're going to estimate our empirical results separately, standard by standard. And then relevant for the entry motives, I want to tell you that the prices in the US at least are set by the owner of the station. And those prices could be linear, simple prices for every minute or every kilowatt hour of electricity, or they could be very complex nonlinear functions. They could be time of use rates and so on. So that's just a brief description of this market. And then what's relevant for thinking about the spillovers in this market is to think about who pays what costs and who reaps which revenue or profits. So regardless of whether the station is owned by a single site owner, which in this cartoon is the donut stand on the side of the highway, or if it's a multi-site owner that thinks about the world in networks, the owner pays the upfront cost of installing the station. The owner pays the variable costs, so the electricity costs and operation and maintenance, and the owner gets to set the prices. Who pays the recurring fixed costs? Well, if it's a single site owner that is part of a network and using the network as a set of services, they'll pay some kind of recurring fixed costs. That's a fee to the network. If it's a multi-site owner that rents space from somewhere else, then they'll be paying a rent to the site host. And by fixed, I mean fixed in terms of not a function of the usage of the station. And then there's recurring variable revenue, so charging revenue. And when as a single site owner, the revenue YJ depends on the own site characteristics XJ and the characteristics or entry decisions of other sites, the minus J. And the difference then between single site and multi-site owners is that the multi-site owner earns the sum of all of these charging revenue. And therefore, it's possible for them to be thinking about the impact that impact of their decisions on one station on the revenue of the other stations, the X minus J. Okay, and then in the United States, to give you an illustration of the different firms and business models present, here are 3 firms that exist and operate in the US. In our data set, we have about 20 different charging networks or companies that vary in size and geographic coverage. So ChargePoint is one of the largest networks and just in terms of the number of connectors, and their public statement in their 2022 10K filings for the US SEC is they say that they do not own charging sites or stations, they do not monetize the sale of energy to support asset ownership returns, nor monetize driver access to stations. So ChargePoint is sort of in this figure. They're neither the single site owner nor the multi-site owner. They're a network that earns fees from some of these upfront costs and recurring fixed costs. So maybe that means they don't care so much where charging stations are located because the usage of those stations doesn't enter into their publicly stated profit motives, perhaps. EVgo, on the other hand, is sort of mixed. Their CEO publicly said that they make money when their chargers are operating. They have a mixture of other owner stations on their network and EVgo owned stations on their network. And then Electrify America, on the other hand, they say they pay 100% of the upfront capital investment for the design and installation of new charging stations, and also the revenue that they earn. So you can see sort of the difference in network layout that these firms have chosen and present to the public. This one looks more like they planned out routes throughout the country, and this one, maybe they're focusing on urban areas, and then this one is sort of just everywhere, wherever you can find them. So for the data set that we use to then investigate whether positive spillovers exist and how firms are making decisions, the first part is to understand where charging stations have entered in the US and what those attributes are that they have. This is coming from the Alternative Fuel Data Center, which is run by the Department of Energy in the US. We know the entry date, the exact GPS coordinates of the charging station, the number of connectors at that location and the counts, the prices that they charge, and the network affiliation and other amenities nearby. We have data on charging station utilization measured in 2 ways. First, we know the status by station for every 30-minute intervals from 2015 and 16, and then again more recently for either California or all of the US. And we also have check-ins data from a third-party crowdsourced site that contains information on when drivers visited a station and charged and checked in, and also the vehicle information for this. The results I'm showing today are based on the check-ins data. We also have data on travel patterns coming from mobile devices across the United States. And embedded in the travel patterns data are also retail locations that we'll use to define potential entry locations. And then in gray here, so these are not behind any of the empirical results that I'll show you today, but I wanted to tell you we have them in case this changes any comments or suggestions you provide. We also know where EVs have been registered in the US down to vehicle, make, model, and so on, and then down to verifying geographic and time disaggregation.
Gene, what's the price variable? Is that what people pay to charge their car, or is that what's being paid?
You mean this one here?
Yeah, what's price?
Price, so it could be very simple, like $2 per hour, or it could be very complex, like some price for the first 2 hours, free afterwards, plus something for parking and so on. So
What
we,
is the customers first? It's not that there was a fee.
sorry, I didn't understand your question. Yes, this is the retail customer facing price. We do not know the contractual relationship between the site owner and the network. Nor have we tried to estimate that yet, but happy to think about it. Mark?
So we might talk about it, but about saving up, do you have a number? That precise, that we can see them as a-
No, and the very, as far as I know, the state of the art of the engineering literature on this is at the very, very raw data, you have cell phone pings. And from other surveys, you see patterns of movement and other demographics and whether people have EVs or not. And the best that people that I've talked to can think about, imagine doing is to try to correlate observables between movement patterns and surveys where you see observables in vehicle ownership. So I think it's, to the best of my knowledge, it's impossible to know from cell phone data unless someone has already just put it into the data set that, yes, I have a car and it's an EV or not. Okay, so what we want to do is two things. So we want to understand when a route, a highway segment between two cities becomes electrified, by which I mean an electric car can travel that route and charge along the way if needed. What happens to charging demand of incumbents that were already present before that last special entrant comes in that connects the dots. And we want to compare the impacts of entrants that complete routes versus earlier entrants that didn't, but in the next period then are incumbents. And we have two ways to think about it. The first one is more closely aligned to the illustrative example that I gave you in the beginning. So when the route is not connected at all, new chargers come in, but their impact on demand on this route is going to be somewhat limited. And then there's this last one special entrant that connects the route. And then perhaps afterwards, additional chargers are no longer useful. But in reality, that's not so stark. So we have a continuous measure or a score that we also have developed to try to include the additional usefulness of stations when they may reduce congestion and ease range anxiety, even after the route has already been minimally connected. So I'll show you event study results from the binary measure and model simulation results from the continuous measure, which relies on the model. Okay. So the data construction steps are as follows. First, we have to define a set of origins and destinations. For this, we take the 490 odd urban areas that are defined by the US Federal Highway Administration. Then we query a mapping package to find the shortest driving distance and route between every pair of these 493 cities to recover a driving route. And then we have our data set of where charging stations are and intersect the driving routes with the charging stations. And for a range of different electric vehicle driving distances, we say whether this route is connected or not for every single time period in our panel. So in this example, this is San Jose to Santa Barbara. I'm illustrating it as blue when the route is not yet connected at the 50-mile range. So for a very, very short range electric vehicle, could you drive Santa Barbara to San Jose? Before May 2022, it was not possible. And then in May 2022, this last special entrant came in, and now it would be feasible for someone with a short range EV to make this trip. And this happened to be in Los Alamos and was an Electrify America station. So we do this exercise, or we construct data along those veins for every single combination of cities in the US, as long as they're less than 600 miles apart in driving distance. We could pick any other threshold, but there are just some distances beyond which the number of driving trips becomes very, very sparse, and people are not really making those trips in cars anymore. So a route R becomes connected at some distance D when there are charging stations every D miles. So the distance range D is very important because if you have an electric vehicle that has a large battery, you only potentially need to charge every D miles where D is quite large. corresponding to that battery size. If it's a smaller battery, then you're looking for D to be small on a route to decide whether you drive that route. So we're estimating this for every standard and for different sets of distances. The YRT are the average number of driver check-ins at incumbent stations on route R in time T. And then the coefficients beta, H and K are for the impacts of the connection event at a given distance D, H or K periods, leads or lags. And we include route and time fixed effects. So our identifying assumption is that the demand shocks that may occur on these routes are uncorrelated with when and if a route becomes connected or electrified in that particular period. So before I show you those results, I want to pause for a second and ask at what distances D would you expect to see impacts from entry, and looking at the distribution of battery sizes and electric ranges might be helpful. So this is a histogram of the different car models that are observed in our data to be charging at fast charging stations in the United States. So you can see that there are different modes in this distribution. There's a group of very long range EVs, and then another cluster around 100 miles or so, and another cluster around 50. These vary by charging standard, so we'll do our analysis standard by standard. A significant share of cars have miles between 200 and 300 miles of range, but that doesn't mean that they're maxing out that distance before they stop. And also EV owners are not recommended to go entirely empty. They're recommended to only charge up to 90% or so and leave also a buffer at the end. Yeah, Claire.
There is the distribution of where vehicles with different ranges.
Oh, that's a very good question. I have not cut it. So are you thinking about urban versus rural or different sides of the country?
How far much, I don't think it's going to vary with other regions.
That's a great question. I haven't looked at that. Yeah, but we definitely can. Thank you. Okay, so here are the impacts on the Tesla standard, which only up until recently only allowed Tesla cars to charge on them. And so I think from this figure, you see at 50 miles, which is not really the distance that Tesla is targeting for their drivers. If a route happens to be connected at 50 miles on the Tesla network, we don't really see much of an impact on incumbent utilization along those same routes. But we do see effects at the 100 miles or around the 120 mile mark. And then not so much beyond that either. And so we interpret that by saying at very, very short distances, those connection events kind of irrelevant for long range drivers. And then despite having like maybe range longer than what you would expect to see charging distances that the check-in status say incumbent check-ins increase when the routes become connected at these given distances. And similarly, we could do this for other standards. So for the combo standard, which is also called CCS type 1, they have a larger variety of vehicles on the standard. So we see impacts at 50 miles and then at longer ranges such as 150 and not so much in between. And so we interpret this as saying when you see cars on the combo standard with a different set of ranges, the impacts at which you see kind of connection event entry impacts also changes accordingly. I think
there's a way to visualize this continuously.
Yeah, so we've tried this. In the interest of time, I'm not going to click on this button, but you could Catherine's asking if you put range on the x-axis and show the magnitude of the impacts, and we sort of see like jumps where we've picked out these figures and then back to zero when they're not. So I want to show you the continuous measure that we've put together. So this is useful in two ways. First, as I've already described, if a charging station comes in beyond the bare minimum of connection? Is it additionally useful for society? And we want to be able to measure that. And the second is if we want to do any kind of welfare analysis or study firm strategy, we want to have some kind of underpinning for understanding how useful that additional station is. And so I won't show you lots of math, but I'll show you a list more lines and dots to try to illustrate the components of this model. And so the first one is just the traversability one, which we've talked about already. It's the binary measure. And then we want to think about capacity and dispersion. So capacity is the number of connectors that are present on the route, if you just add them all up. And the dispersion is how they are allocated across potential entry locations. So to do that, we then first have to define what an entry location is. And that could be, this square could be an entry location and that square could be another entry location, but that would be quickly computationally impossible. So what we do is we take the retail establishments in the safe graph data and use machine learning to identify and cluster these retail locations into, into potential entry locations. It's so that it's like a set of well-defined, and this is also, I think, better than just saying the set of observed entry locations, this is the set of potential entry locations. So this includes ones where we've never seen charging stations where they could have been. So traversability, we've already talked about. In this one, I've just shifted around the potential entry locations, say, for example, for capacity constraint of the transmission line. And so if this entry is not there, then a car with 75 miles would not be able to drive it, but now it can. For capacity and dispersion, so here it's a uniformly dispersed route with 4 connectors in total. Here, this would be 8 chargers uniformly dispersed, and then here it would be 8 chargers that are not uniformly dispersed. And so our model with math is trying to allow for these different arrangements of chargers on routes to then map to some kind of quality metric and then eventually consumer utility. So, so far what we have is just a scale from 0 up that isn't yet mapping to dollar metrics. But what you can see is the relative changes in the network quality over time and relative to the other standards. So with California, which is a leader in the EV industry, from 2021 to 2024, we do see that the network has improved over time, but the Tesla standard, which unsurprisingly is not looking as good as the other standards under the 50-mile metric because they were never intending to do that. Whereas at 100 miles, Tesla looks a lot better relative to the other standards. And then the Illinois example is just to show that the levels of everything is lower than in California, so there's high heterogeneity across the United States. We can aggregate across all the different states and routes in the US that then show differences across different mileage, distances, and time. So our policy counterfactual that we ran very quickly with this model is showing us that if you try to put in 2 chargers every 50 miles along US highways for 300-mile routes with average vehicle range of 100 miles, our continuous metric with these components in the model will change the quality from 1.15 to 1.3, which, since I haven't mapped this to dollars for you yet, doesn't yet mean much, but we're working on that. And so to evaluate the policy, we would be doing this for many different distances for different cars and on different distances of routes. So to summarize, we want to understand whether the policy designs that we see in practice are helping to improve the market and whether economic theory and evidence would back up these policies. We find evidence of positive spillovers on highway corridors in the US charging market, and our model of consumer utility from route electrification can help us evaluate the impacts of the US IIJA policy. Europe has a very similar policy of having chargers every 60 kilometers instead of every 50 miles. And what's in progress is to map our continuous measure of network quality to a money metric and to evaluate welfare and to try different policy counterfactuals such as a uniform subsidy. Thank you so much.
No, I have more minutes left, so I think it would be very cool to look at the adoption curve and how this can Option for both EVs or opposition? Well, if you put two chargers every 50 kilometers, you feel more people to work about the EV, and then you like the spontaneous and the. Oh, yes, like the movement of that. And then as a side comment, as an EV user, if there are many users, the chargers is not much, but again, maybe the market is already organic. Versus, you know, if the charger never see the owners, you don't have it, but I'm not. There's some people going to there.
Yeah. For your first suggestion, I think then what we would do is like fit this paper into the next of my other copies from market paper, and then for the other one, we can.
Okay, well, thanks a lot to the organizers for giving me the chance to come down the road from UCL and talk to you about this paper. My name is Lucas Conwell, and the work I want to talk to you today is related to the privatized provision of what you can think of as one of the most important urban public goods, namely shared public transport. And I'm going to focus on a quintessential case of this privatized provision, which is minibuses in Cape Town in South Africa. Now, why should we be here discussing the provision of this public good of shared transport? Well, one reason is that workers in lower income countries tend to have longer commutes, which, along with other factors, other constraints like personal safety, can prevent them from accessing the most productive jobs. Another reason, especially at LSE Environment Week, is that basically all of the cities you see at this end of the spectrum are urbanizing and particularly buying cars at very rapid rates. And so any policy that we can implement to improve the attractiveness of shared transport is also going to have huge emissions benefits. And these long commutes, the fact that people are buying cars so rapidly is in part because these local city governments often lack the fiscal capacity to expand their public transport systems as fast as these cities are urbanizing. And so into these gaps, there's been an alternative that has historically emerged and which I term privatized shared transit. Here you can see also, again, the lower a country's income, the greater the fraction of all urban shared transit, so all buses and trains, that's accounted for by these privately operated minibuses. So around 50% here in my context of Cape Town, but up to 100% in many other African cities. And these privatized networks serve as a kind of lifeline for often low-income commuters who have few other options. But if you go to virtually any of these cities and look on the ground, then it kind of looks like chaos. Say on routes that are connecting busy origins to popular destinations, you may, like in Cape Town, see passengers waiting in long queues to board these minibuses at the stations where they originate. And conversely, on other routes that are less busy, instead, maybe the passengers are waiting forever on the minibus for it to fill up and actually depart, an experience that's probably very familiar to anyone who has ridden a minibus of any form. And finally, though these firms that run these buses generally only own one bus on average, they're often organized into these route level associations, which stand accused of all kinds of horrible stuff, like exploiting monopoly power, but also like causing gang violence and assassinations. So in this paper, specifically, I want to ask whether these privatized shared transit networks efficiently provide this public good of shared transport, and whether policymakers, by, say, introducing appropriate subsidies, can optimize the minibus supply and passengers' waiting times. If we want to answer these questions, we're going to need to go beyond the data and have a model of this privatized shared transit sector. And in my model, I first have passengers who queue to board minibuses, which themselves then only depart when they're full, as I was mentioning earlier is generally the case. And then this will reproduce the long wait times in Cape Town, actually account for around a third of passengers, of minibus passengers' total commute times. Then in the model, there are minibus associations which choose bus supply on a given route, and those buses then arrive in a potentially pretty congested fashion to the minibus stations. And finally, we've got a pretty standard spatial model of demand. Commuters choose a home location, work location, mode of transport based, however, not only on the commute times, the waiting times, but also other factors like personal safety. And I think it's important to already mention at this stage here that this combination of physical queues to board a minibus plus congestion in these buses' arrivals to the stations will generate both demand and supply externalities, which will mean any kind of equilibrium is generally inefficient. All right, so much for the model. Then, due to the lack of existing data on minibus operations, on passenger preferences, I organized the collection of a couple forms of data in Cape Town. First, data on these passenger queues, the buses' loading times, which I can use to directly estimate my two-sided queuing model using variation in demand over time within each of 44 minibus routes. And then on the demand side, I extend recent advances in what you can think of as model-tailored stated preference surveys to this context of commute discrete choice experiments, and I randomly vary attributes like travel time or the presence of security guards across different hypothetical minibus commute options. And then finally, I ask how policymakers can optimize this privatized provision. And it turns out the social planner would increase both minibus supply and demand across all routes. And implementation of this social optimum through optimal subsidies has, unlike other, perhaps simpler changes in market structure, has sizable welfare and emissions benefits. But it turns out that just wholesale upgrades to this technology, for example, expanding stations, adding queuing areas, or posting station security guards, has welfare gains that rival or even exceed those of optimizing the existing network, the existing technology. All right, so with that overview, yeah, Claire.
Other modes in the current fixed here, but this is substitution across the method.
Right, so the other modes are, I'll have formal transit and car, but yes, those are completely fixed and exogenous in the model and in my counterfactuals. All right, then let me give you a bit more context then on that initial slide and talk about what it would actually be like if you were going and riding a minibus in Cape Town. So if passengers want to ride one of these buses, they'll go to these publicly owned stations where the minibus routes originate, and there they might find they have to wait in substantial queues, as in this picture right here in Cape Town, to board. And if we look in this data I collected across routes and time periods, we see that this distribution of queuing times has a pretty long right tail. Now, at the front of the queue, there will typically be a single bus loading passengers from that queue. Most of the rest of the time, the loading bay is just empty. There's a bunch of passengers waiting, but nobody is going anywhere. And then now if we look across different bus departures, look at how many passengers are on these buses, we see that in this histogram, the vast majority, the overwhelming majority, I should say, of buses are departing with at least a full load of 15 passengers. And finally, the buses theoretically could pick up more passengers along the way, but in the rush hours that I studied, partly because of this fact right here, this is not an important margin. All right. And now I'll discuss one more piece of empirical evidence that will motivate my focus here on these wait times and this optimization of the supply. So completely separately from privatized shared transit, it's long been discussed in the transport planning literature that publicly provided shared transit. So say subways, buses, the London TfL buses are subject to a kind of demand externality, which has been termed the mooring effect, which is essentially a form of increasing returns that the more passengers you have on a route, the more frequent service the transit agency can justify, and the lower passengers' wait times are. So this mooring effect is something that's often been hypothesized for publicly provided transit, and it turns out that privatized shared transit in equilibrium actually functions in a similar way. What do I mean by that? Well, here on the left, I've plotted the number of arriving buses per hour across routes and time periods in my data, and on the y-axis, passengers' mean queuing times. And you see that the more buses are arriving to a route, logically, the shorter on average passengers' queuing time on that route. And this is a key component of what I term throughout my paper the indirect market mooring effect. So sort of leaning on this idea of the mooring effect for subways here, instead we have the indirect market mooring effect for minibuses from minibus entry. So that's one reason why we have shorter waits on busier routes. Another one involves the number of passengers on a route. In particular here, I've now plotted a bin scatter plot again of the rate of arriving passengers on a route, and on the y-axis, now the mean times it takes buses to fill up. So what I'm going to call all the time loading times. And you can see here that the more passengers are arriving to a route, the faster buses fill up. And that's what I term the direct market mooring effect. The fact that busier routes have buses that fill up faster and so lower waiting times. And so to sum up all of this on busier minibus routes, passengers have lower waiting times for two reasons. One, that the more buses there are, the shorter the queues become. And second, the more passengers there are, the faster buses fill up. And these correspond to then the indirect and direct market mooring effect. And it'll turn out then the social planner or say a smart policymaker can harness these to optimize and reduce passengers' waiting times. Okay, then let me give you just a quick sort of 10,000 feet view of the model I'm going to use to come up with these policy conclusions I mentioned at the start. So in my model, I've got a continuous time environment, a discrete set of locations, and three types of agents. First, there are minibuses, which wait in a reserved supply and then arrive to the passenger queue in order to load passengers. Then there's one minibus association on each route, which has a state-sanctioned monopoly, let's say, and it chooses the supply of minibuses, and then Nash bargains the minibus fares, the prices passengers pay with the city government, which this reproduces some of the local institutional context that the city government, among other things, approves the fares that the associations are charging when they grant the approvals to operate on these routes. And finally, on the demand side of the model, we've got commuters of heterogeneous skills who choose a home location, each of which has some associated amenity, as well as a work location with some, here in my model, just completely fixed wage. And finally, a mode of transport of the three I mentioned earlier, minibus, public formal transit, or car. And they make this choice based on attributes like travel time, but also based on the quality of the mode. For example, and this is going to be important for my specific counterfactuals, whether the mode has security guards at the stations.
Are you thinking of the minibuses as having a profit motive? Or are they following the planner's objective?
So the first one, so the associations, they're going to be maximizing profit, and that process will then yield the optimal supply.
My question was stupid, but if you want to. So I come from a rural area, and you don't wait half an hour, so you wait 2 hours because you know at what the bus is the parking. So if it's something where all of those things that in the rural areas you could say that so that then you feel you was wait a lot, but you show up.
Yeah, that's a great question. So let me say, in most of these routes are going to be quite busy, and so enforcing a schedule would actually be in many ways quite challenging, as transit agencies like TfL find out when they try to have a schedule and the buses all end up bunching up 1 minute after the next. However, there are certainly some very low demand routes where you might expect that there will be gains from a schedule, but anecdotally, I haven't heard any evidence of that, or you've seen this kind of regularity in my data, but certainly also a policy you could consider for those routes. Yes.
So these three choices that the commuters have, where to live, where to work, and which mode to use. So there's some sort of differences on how sensitive they can be, right? It's much more easy to switch the mode of transportation rather than just switching the place you live, right? Are these differences going to be relevant in your setting?
So, well, split answer. In my baseline case, I don't take those into account. However, then I do a robustness check where I have more of a nested load demand system where indeed people are much less willingly switch, say, home and work location, and maybe I'll touch on that at the end, how that changes the results. I think there were some more questions on the right.
What is the structure of the fares? Is it one fare flat per route, or the differentiated by routes?
Right, so they're differentiated by route, which in Cape Town is, and in my model, a route just means a combination of origin and destination. But within that, you know, both in reality and in my model, the fare is generally uniform. Yeah, Jane.
So I'm wondering, in the city and also in your model, like, is there some equity concern of, I want to cover a route even if there are not that many people traveling it, but still you want to guarantee some minimum level of service or whatever, and how does that enter your fare determination in the bargaining? Maybe
let's see. So in terms of what I'm modeling here, the bargaining, essentially the city government is just taking into account fares relative to income, which is somewhat in line with the guidance I've seen where they say that their primary consideration should be the ability to pay of commuters. So the city government is not directly taking into account wait times, but certainly in my counterfactuals, then there's optimizing the minibus system is going to involve a lot of exactly this, increasing service on these lower demand routes. And that's one reason why then also this will be a very pro-poor policy. Okay, then let me jump into just a few details of the model. So, and in particular of this queuing process, which determines the wait times of passengers and minibuses, and so is really central to everything I'm doing. So on the passenger side of the queue, passengers arrive to the queue at some origin destination specific Poisson rate, which is of course a function of demand, this Poisson rate lambda. They join the first in, first out queue, and when they get to the front, they board a bus if one is present at some Poisson rate mu, which is a really key parameter I call the queuing efficiency. And this whole process will then translate into an average queuing time for passengers on a route, which logically decreases the more efficiently people board buses and increases with this level lambda of demand. It also depends on this endogenous quantity PL, which is the probability that a bus is loading, which is a direct function of bus supply, as I'll get into now. So on the bus side, after the previous bus has departed, I model the next bus on a route as arriving at some rate lambda B from this reserve supply B that's been chosen by the association. And this arrival rate increases with the number of buses the association has chosen to put on the route according to some function G. And this is exactly the function which then captures the fact that there's bus congestion, that the bus doesn't instantly arrive after the previous one has departed. And kind of technical, unimportant detail is then the buses can only be in loading when they get a so-called loading shock. What's more important is that I impose that buses depart at a rate such that they on average have a full load eta bar of passengers. And this eta bar is a fixed parameter here. And all of this process then is sort of, again, flows into quite a bit of mathematical derivations, which then gives you the probability that a bus is loading on any given route, which affects not only passengers' queuing times, but also these loading times, how long it takes it to fill up. And notice then these loading times of the buses L, logically, the larger buses are, the higher this eta bar, the higher the loading times, but the more people there are using a route, the higher this lambda, the lower the loading times. And all of these relationships are going to be important then later for understanding why there's scope for policymakers to improve the situation. And for the sake of time, I'll skip on over the definition of the equilibrium and the details of the more standard demand side, and instead focus on how the model replicates these market mooring effects that I started with. Remember, we saw in this scatter plot before that bus supply has this beneficial indirect market mooring effect of decreasing queuing times, and the model then tells us that this total effect of bus entry on passengers' total wait time, queuing plus loading, has two terms. The important one is the first one, which is this negative effect of bus entry on passengers' queuing times, and that's larger the larger the elasticity of bus arrivals with respect to supply. So the less congested buses are, the more beneficial their entry, and this queuing effect is also larger. The larger this queue, the larger the waiting times are in the baseline equilibrium. So that's just telling us that more busy routes are going to benefit the most from additional bus entry. Now, the buses also have an effect on loading time, but that doesn't really matter much in practice. Then we also saw, right, this pink scatter plot of the direct market mooring effect, the fact that demand fills buses faster, and the model tells us that demand has an effect on total wait time, queuing plus loading time, which is again composed of two terms. And I want to focus on the loading term. This is the decrease in loading time, which is just directly proportional to what the loading time was in your baseline equilibrium. So if you've got big buses, they have a really long loading time, well, then this direct market mooring effect is going to be very large in magnitude. Okay, then when I go to then think about what's the optimal minibus network, I write down a social planning problem where the planner chooses bus supply and commuters' choice probabilities to maximize welfare, but subject to the queuing technology. And as a result of this physical queuing and the bus congestion, we have both a demand and a supply externality, which correspond to the direct and the indirect market mooring effects. That's why I've been harping on them so much. And it turns out then you can show that associations internalize their externality, the indirect market mooring effect, and commuters internalize theirs only in a double knife edge case. That's kind of like, if you're into the labor search models, it's kind of like a double Hosios condition. And if this, sort of knife edge condition is not the case any other time, then policymakers can do better and optimize both minibus supply and demand, and thus passengers' wait times. Okay, with that, I'll just touch on how I estimate the model here. I mentioned I collected a couple of forms of primary data. First, what I call minibus station counts, data on when buses arrive and depart, how many passengers are waiting in the queue at different times on a two-stage cluster sample of routes. And then I conducted this stated preference survey in order to quantify commuters' relative preferences for different minibus attributes. And just to give you an idea, commuters in my survey faced a series of randomized hypothetical choice sets composed of two minibus commute options each, with each one had a bundle of attributes like travel time, but also like security guards. You can see the nice little clip art here. And based on these attributes, they indicated their preferred option. And I also then combined the responses from this survey with an existing city-run stated preference survey that was representative of households citywide and asked about different modes of transport, and thus allows me to characterize these relative preferences for different modes. I use these two data sets, among others, to estimate the model for Cape Town, but I'll just give you a quick flavor of the most important, say, two steps of the estimation. So one key quantity we need is this queuing efficiency that determines how fast passengers board buses. And since I observe both sides of this queue, we can estimate directly an equation for n, the number of passengers waiting in the queue, as a function of the bus dwell time per passenger. And this is a somewhat, perhaps I'll say less intuitive equation, but that comes from linearizing the model and essentially the relationship between bus dwell time and queue length. How much bus dwell time decreases queue length helps us identify the queuing efficiency. And in the error term here, we've got interruptions to the loading process, which are unobserved, like weather or special events going on. And to address this threat, I instrument for this dwell time per passenger using essentially the distribution of local work start times, which was measured 9 years before I collected this data. I then, on the demand side, use the stated preference survey, which conveniently has these exogenously varied attributes. And so I can just directly estimate multinomial logit discrete choice model and identify all these different attributes in dollar terms. I find a pretty low value of time compared to the existing estimates, which are typically from developed countries. And I find commuters have high utility costs of using minibuses, in part, perhaps because of crime risk, given that of all the different quality improvements I test, security guards at the stations turn out to be the most valued improvement. And as an initial test of the stated preference method's ability to accurately capture preferences, we can compare the actual reported mode choices of these respondents to what the model predicts based on basic demographics, and we see the match is pretty solid. All right, and then with the last 4 minutes, we can get to the actually interesting part, which is the gains from these different transport policies I listed at the start. And let's start with the gains from implementing the optimal minibus supply and commuter demand through appropriate supply, minibus entry, and demand subsidies. And I'll consider first how this actually affects how the social planner wants to change demand and supply across different routes. So on the left, I've plotted the proportionate change in minibus passenger demand at the route level in a bin scatter plot versus the wages at the destination of the route, which is essentially a measure of demand on that route. And we see that these are all above 1, that the minibus passenger demand should be higher everywhere in order to fill buses faster, correct this direct market mooring effect. And then particularly so on these low demand routes, these are often suburban routes, not a lot of people riding them. They have really long loading times in equilibrium. And so the planner disproportionately increases supply there. Similarly, actually, minibus supply should be higher everywhere due to relatively mild congestion in bus arrivals. This corrects this indirect market mooring effect and reduces passengers' queuing times. And particularly on the high demand routes, this is where there are actually very long queues. And so it's disproportionately beneficial to increase bus supply here. That's why we see the planner doing so. All right, then as a result of this optimization, the queuing and the loading times fall across the board. Here I plotted the mean changes in these times for different destination wages, and we see that queuing and loading times are particularly falling on the lowest wage, lowest demand routes. And that's because in equilibrium, these had, due to these market mooring effects, these had the longest both green queuing time and pink loading time. And so when we then optimize the supply and demand, these routes had really bad wait times before. They benefit the most in terms of absolute decreases in wait time. However, this has a somewhat pernicious effect then of actually making low-wage destinations more attractive. And so if we look at the proportionate change in work location choice probabilities here on the right, again, versus the wages, we see there's actually a slight spatial reallocation towards lower wage work locations, and the average wages commuters earn actually decrease. However, the direct gains in terms of commute time more than outweigh these countervailing effects, these lost wages, and we see that the low-skill commuters gain about 1.4% in equivalent variation. That goes up by around 0.06% if we 0.06, I guess I should say percentage points if we take additionally into account the fact that commuters are switching from cars to minibuses, and so emissions are decreasing. And these gains are around the same order of magnitude estimated for other more heavy transport investments in the literature. It turns out, I sadly don't have the time to go into the details, but that other perhaps simpler changes in market structure, letting associations charge free monopoly prices or allowing free entry of minibuses, prove too blunt of instruments and generally cause to either decreases in supply and demand, which make the situation worse, or in the case of free entry, just too uniform changes, so there are few benefits. And in contrast, just to wrap up, upgrades to the minibus technology do in fact have large benefits, adding an extra queuing area to decrease wait times on these really busy routes, or posting station security guards, which increases welfare by over 2%. So I hope I've convinced you at least a bit that improving minibuses could serve as a low-cost way of improving commute times, spatial misallocation, and emissions. And this is an option worth considering for developing country cities around the world like Cape Town. Thank you very much.
Thank you. Hello, everyone. Thank you for attending this late to the last session. So the work I will present today is co-written with Doug Garland, who is now at the Tufts University. And I am Julien Wolfers-Berger from Paris-Saclay University. Our work is about how roads can impact deforestation. And I'll maybe start by stating the fact that economists absolutely love roads. I think if I would run a survey in this room, would be everybody would be keen for like more roads. Why do we love roads so much? Because it's a critical tool for economic development. It's important to like reduce within a country trade frictions, and which distort the resource allocations, and it can have a long-lasting effect on economic growth. And Doug has, for example, some papers on showing this. But outside of economics, not every scholar is on board with like more roads, in the sense that talking with like ecologists, it's clear that like new roads open access to previously isolated areas. By doing so, they create a migration of labor, of capital, of economic activity in general. And this can reshape land use, possibly at the expense of the environment. Right? What we ask in this work is how new roads have impacted deforestation and economic development in the historical context of Brazil. So this slide is pretty much useless for this crowd, but maybe a word to say that, so for those who came for the city papers and are not familiar at all with deforestation, deforestation is primarily caused by agricultural land expansion. And in Brazil, it's a big deal. And part of the agricultural export is very important for the industrial policy of Brazil. For example, in 2023, this is over $150 billion of exports in agriculture. And for example, soybeans represent 40% of those exports that year. what we do, given this, is that we are trying to quantify the impact of new roads on deforestation. Basically, we ask how much total forest loss since the 90s can be explained by new roads, and what are the economic costs and benefits of these new roads. With our method, we hope to disentangle price diffusion in space and how it changes specialization patterns, and how in turn it affects the forest. We try also to emphasize the general equilibrium effects of non-treated locations. And in the end, and it's relatively new result that I'm presenting here for the first time, we try to see whether there is like complementarities between infrastructure investment and another type of shock that can affect the forest, which is a technical change. And in the case of Brazil, this is the introduction of the new soybean seeds that occurred around 2000, so over the period of our study. And for those who are, I guess here everybody is familiar with Paula Bustos and co-authors' papers, and so this is in that scale. So the method we use is a quantitative spatial model where we combine agricultural census with the satellite data in Brazil, and we run two kinds of counterfactuals. The first one is that, so we reproduce the spatial equilibrium in 2017, and then we remove all the roads that were built since the 90s. And we look at what is the consequences on the forest and for example, the profits in the agricultural sector. The second one is that we are going to combine this new road or removal of the roads with the introduction of this new soybean seeds. And as in the paper I just mentioned earlier, we just exploit the difference from the gas data between productivity yields at the across locations. To have a sense of the findings, we basically find that according to our quantification, the roads that were built since the 90s explain up to 11% of the total forest loss that we see in the data. And but we have great heterogeneity across locations. In some locations, like the state of Para, in some mesoregions of the state of Para, it explains up to 90% of what we see in the data, according to the result of the model, of course. The increase of agricultural income is relatively limited, and the environmental cost is quite huge because if we, like just doing a very simple back to the envelope estimation of how much it is, we find that depending on what bond you take in terms of how much carbon is sequestrated per hectare, depending the type of forest, we find that the carbon cost is somewhere between 50 and 100 billion US dollars. And of course, it doesn't take into account many costs, like maybe first the biodiversity cost, but also the displacement of population, etc., etc. Okay, so relative to the literature, we speak to this all the environmental and development literature has been looking at the impact of roads on deforestation. It's not a new question. I think Alex Pfaff has been among the first to be looking at this impact using satellite data. Recently, Sam Asher and co-author look at this in the case of, in the context of India, using an instrumental variable setting. So those are mostly empirical reduced form panel data, and we hope to bring to the table general equilibrium effects. We also speak to all this literature of quantitative spatial models, looking at development and agriculture outcomes by focusing on roads in the context of Brazil. Also, all these very important papers on Brazil deforestation with policy components that also include the quantitative models, such as the work of Veronica here, for instance. And so we speak to those literature. So to build our oh yeah, sorry.
I don't know the literature well, so I was wondering, do the data generally or your setting attach like a road and then the policy goal of that particular road? And is it possible to look at differential impacts by different policy goals?
The policy goal of a road?
Yeah, like maybe one is meant to like reach people who live there and the other is explicitly meant to allow extractive things to be shipped out.
Oh, that's a very interesting point. Not to my knowledge, but possibly, not in my data, but possibly. It's an interesting point. Yeah.
Yeah, I have two additional complementary questions, I think, which is first, if you're looking at just deforestation itself, because there's also, so Lemonson also has some new papers talking about degradation, not just deforestation entirely, which also expands the frontier of deforestation quite rapidly as well, which is kind of another component of this. And the second question, which is there are two. So first, there's the new policy. I don't know if you've seen this recently, last week, a couple weeks ago. The government's been announcing some new road construction. So I don't know if you've considered doing some counterfactuals for the potential impacts of these new roads eventually. And the other one, which is the Transamazônica, I don't know if you can run some exercises for what the effects would be. So that was constructed during the military dictatorship. I don't know if you considered that.
Sorry, what's the last point, sorry?
The Transamazônica is the biggest road that was constructed during the dictatorship. So it was kind of one of the biggest infrastructure projects. And it was meant to literally cut through the forest. And I'm thinking that would be kind of an interesting exercise as well, considering the long run impacts of that road specifically.
Oh, yeah, no, for sure. So just to address your different points, so we don't look at degradation, but it's very it's very interesting. Sorry, what was your second point?
The new road. So if you guys could do like a counterfactual.
Yeah. So to be completely transparent, in the first version of this paper, we were looking at new roads, and the reviewers weren't interested. So, but it's an interesting question. But so now, in what I will show today, it's not with the new roads, but it's a very interesting question, I think. Yeah, so this is what we're trying to do. So we build the model on four main motivations that are going to structure our model. Super simple. One is that obviously road proximity varies across the country, right? And so that means that market access and location of ports also varies through the country. So that means that market access is going to vary across the country. Two, market access is positively correlated with forest clearing. And so this is a simple OLS regression per mesoregion level between how much forest is left and what's the distance to the closest exporting port. Three, there is a great spatial heterogeneity in land productivity, and this is going to shape comparative advantages. So for example, just to show maybe that map. So this is the relative yields of soybeans relative to corn, right? And so this gives an insight around the comparative advantages across regions. So basically here in that part of Brazil, those relative yields, potential yields reach 0.8 relative to corn, while here it's much closer to like under 0.5. And this is going to drive comparative advantages, part of the comparative advantages between the producing regions, right? And the last point that is of interest is that depending on, so there is this spatial heterogeneity in land productivity. And then the fourth and last point is that depending on which crop a region is going to specialize in, the pressure on the forest is going to be more or less important. Why? Because crops differ in land intensity, right? And so producing a ton of sugarcane is not equivalent in terms of land intensity as producing a ton of soybeans. And so we are going to try to incorporate these facts into a model. The model is pretty standard. It's a multiple location model that will calibrate to the Brazilian mesoregion. In each location, we have a continuum of plots, and on each plot, we can grow K crops. In our empirical application, we have 9, so we have 8 crops plus pasture. And the way the model works is that farmers have to pay a fixed cost to open the land for agriculture. Okay, so they face the fixed cost, and whenever the expected profit is higher than that fixed cost, then land is converted into agriculture. We adopt a trade hub settings where actually that encompasses the 18 largest and soy exporting ports in Brazil. And consumers, domestic and international demand, are located in that trade hub. There are iceberg costs to ship output to that trade hub, and there are iceberg costs also to import intermediate input from that trade hub. So basically, fertilizers are produced internationally, and so farmers in remote areas of our mesoregions have to pay that iceberg cost also to import this intermediate. Production takes place as it's the combination of labor, intermediate input, and land. All the factor intensities are crop specific, related to the 4th point. And the land is subject to a productivity shifter, and this productivity shifter is randomly drawn from a nested Fréchet distribution. And we basically do that to have 2 types of elasticities. One that is good, one for the forest to crop substitution, and another one for the between crops substitutions. And so it's going to govern how, as a result of changes in prices, land use is going to change. We have an outside sector that combines labor and neutral productivity, neutral productivity to get output. Consumers want to have a lot of variety given the substitution elasticity of sigma, and the remaining share of income goes to the outside group. We define a competitive equilibrium, and the way the model works is that, just to give you an insight of how this works. So in 3, this is the total amount, this is the share of agriculture in region I. This is the way it works is that this is agricultural capital phi is profitability of agriculture. Okay, this is the product of a price component and exogenous land productivity. Okay, whenever that profitability of agriculture rises relative to the investment cost to open the land for agriculture, then the size of the share of agriculture in region I increases. Okay, so I'm going to come to this in the next slides, but it's going to be adjusted by the changes in transport cost. And within agricultural land, crops are going to take more or less space according to this second equation, which is familiar to all the trade economists that are here, I'm sure. This is again the productivity times a price component. And our θ1 and θ2 are going to be important to in terms of responses to changes in prices. Just zooming on that agricultural profitability index, what we get is that we have that exogenous productivity, and we have here the farm gate price, the price of the intermediate input at the gate, and the wage. Okay, so just to give you a sense of how the model works in terms of first order approximation, super simple. The farm gate price, this is the price at the trade hub divided by the iceberg cost, and the intermediate good price, this is the world price of that intermediate good times the iceberg cost to get it all the way to the farm. When transport costs, whenever transport costs go down with a new road, then agriculture becomes relatively more profitable, and all things being equal, land is converted into agriculture. But it's just a first order approximation. Of course, it depends on how much market shares is being picked up by other regions, etc. Okay, How do we calibrate this model? We use the latest agricultural census data from 2017 from meso regions at the 137 locations. We take the gas potential yields. We estimate our trade cost elasticity, and we use different parameters from the literature to get the rest. To estimate our trade cost elasticities, we exploit the difference in soy prices across space. That we regress that soy price differences on the distance to the shortest distance to the next international soy exporting port. And the assumption is that these differentials is going to be explained by the differences in transport costs. We focus on soybeans because it's largely exported, but of course, roads are not randomly placed. And so to overcome that difficulty, we just follow Sousa Rodriguez method, building a network of straight line distances to the nearest ports and state capitals. Assumptions being that these ports and capital were decided by geography and historical factors long before the expansion of roads in the 70s, and they are also positively correlated with the actual transport costs. So controlling for land productivity, density, and quality of roads, as well as temperature and precipitations, we obtain an estimate that is in the range of the literature, and we get our variation in transport costs. So this is our variation in tons against across Brazil that we estimate. Armed with this, equipped with this, we move to the quantification. And so we take those parameters from those papers, and we invert the model to fit quantity produced from a scale productive parameter, and we also invert the model to get the amount of investment that allows us to back up the level of forest at equilibrium, right? So we exactly match the amount of forest at the beginning. So this is visible here. This is the land use. Forest is perfectly matched by model inversion. And this is the land use, the crop land uses. And in terms of local average agricultural price index, we get a fit that looks like this. Okay, so equipped with this, we move to the quantification exercise. What we do is that the first counterfactual that we run is we look at what happened if roads weren't built since the 90s. So we basically remove all the roads that were built since the 90s from our spatial equilibrium. We try to apply those aggregate and distributional effects. And in the second exercise, we combine this with the introduction of new soil seeds. So, we are going to see that. So, depending on that soybean seed introduction, the effect of roads is going to differ. This is what we are trying to see here. Okay, so this is the okay, so these are percentage changes relative to the 2017 equilibrium. What we find is that when we remove roads that were built since the 90s, forest cover increases by 0.9%, while agricultural income drops by 0.35%, and ag exports by over like a 5% decrease, and as well as input adoption around 2%. And if we try to look at heterogeneity across regions, the model behaves relatively well from that measure, in the sense that we somehow capture what's happening in the data with more or less heterogeneity. And we see that also like a bunch of those locations that weren't treated by the transport cost, the changes in transport cost. So it can be a bit confusing. It's like I'm removing roads away, right? So those who are treated, they see transport cost increase. But those, a bunch of locations weren't treated, and still they lose quite a lot of forest cover, because what is happening in the model is that those who lose connection to the market, so production is reallocated from the effect of roads is that production is reallocated from those who lose the connection to the market towards those who weren't impacted by those new routes. So it's a bit inverted. It's the same for the inputs, for labor and intermediate input. Everything is reallocated towards those who didn't see transport cost increase. So thinking reversely, that means that building new roads is going to capture part of the production as well as the inputs, in the production. If we look in terms of spatial allocation of those effects, so all these regions who were affected by deforestation quite largely in the past decades gained back forests thanks to that, and quite symmetrically, agricultural condo goes back down. And finally, to finish and to try to look at the complementarities with technical change, this map shows the difference between the net effect of roads with high potential yields and the net effect of roads on the forest with low potential yields in soybeans, right? And so what that means is that here in all these regions, the effect of new roads did reinforce the effect of the introduction of new soybeans on deforestation. But interestingly, in this region, for instance, what we can see is that the introduction of the new soybean seeds actually lowered the negative effect of roads, and we get something more negative. So to conclude,
sorry.
Oh, yes.
Something. Just I think there is a sort of trade-off in this counterfactual that you could form, that these roles they did not only have the effect on incentivizing partially the deforestation effects, right? But they permitted an immense process of economic growth in Brazil, way beyond what happened in agriculture, right? So it's counterfactual that you shut this road infrastructure growth, and then you see what happens in agriculture, misses what would have been missed out in terms of development driven by other forces, right? It led to a lot of migration, a lot of things that happened in Brazil thanks to this. It's a sort of hidden thing behind, I guess, the results, or maybe some.
Yeah. No, this is a good point. Well, we see some effect that I didn't show here on what's happening in terms of like total GDP, like the sum of what is happening in the agricultural and the non-agricultural sector. But perhaps it's a very good point, but perhaps to tackle that point, we need maybe something more like dynamic and long term. It's like more because we are comparing two static equilibrium. Exactly. I agree that this is a shortcoming of this, is that
there was also, like it's China shocked to Brazil, like part of it was immense demand coming from outside, and eventually in the absence of roads, there will be this demand shock from the outside, and we have been deforestation somewhere else, right? The same deforestation.
No, for sure. And no, I agree with you, and this is certainly a shortcoming of this approach. So yeah, having that in mind, what this study shows is that, according to this quantification, new roads contributed to more or less 1/10 of total deforestation in Brazil since the 90s, with great heterogeneity across regions. Like it can explain up to 90% in some meso regions. We actually find that the carbon cost of this is quite high, and of course, the carbon cost ignores lot of other types of costs. So it's important to think perhaps in general very carefully about, like, as a development economists, as people interested in development, the building roads is something that is of interest for any development economist, but perhaps putting in the context of natural capital and impact on forest, it's important to think about this carefully, probably.
Okay, so let me jump right in. Thanks so much for being here. I'm Sylvain Chapetet. I'm from the Toulouse School of Economics. This is joint work with Anoush, who's here, François, who's in PSE, and like colleagues, ecologist colleagues. So that's my first collaboration with ecologists. So let's see what we obtain. So the main starting point of this paper is the immense transformation that has occurred to farming across the 20th century. And this transformation is mostly linked to the use of synthetic inputs. So to give you an example, the change in yields for cereals that we have observed between 1960 and nowadays in France or Western countries, you also have North America here, is an increase that is tremendous of an order of magnitude. And this increase has been obtained partly thanks to the increase in the use of nitrogen fertilizer from, again, an order of magnitude increase. A similar thing has happened with the use of pesticides. So here you see results from experiments by agronomists, where you have here the number of treatments by pesticides that they have tried on different plots. And here is the yield. And you can see that yield responds positively to the number of pesticide treatments. And pesticides have been increasing tremendously. Pesticide use has been increasing tremendously across the Western countries across the 20th century. At the same time that this has happened, concerns have been raised that byproducts of these synthetic inputs have been becoming more and more important in the environment and have made damages. So to give you an example, here is the concentration in nitrate, a byproduct of nitrogen, in the Brittany region in France, so that's the weird arm on the west of the part of France, before and after this rise in the use of synthetic inputs. And you can see that we moved from somewhere around 2 to 4 microgram per liter concentration of nitrates to 1 order of magnitude. The same thing occurred with pesticides, and ecologists have started to worry that this was responsible for a tremendous decrease in biodiversity. This is extracted from a paper, a very famous paper in ecology by Chamberlain and co-authors that was published in 2000 in the Journal of Applied Ecology. This relates the temporal variation in the first principal component of intensity of agriculture that contains the use of synthetic inputs as main factor. And you can see that this is in the UK. In the UK, as very similarly as in France, agriculture intensified and the use of synthetic inputs increased across the 70s to the late 80s. And here you see the first principal component of bird abundance index. And you can see that around the end of the 70s, there is a sharp drop in this abundance index. The thesis of Chamberlain and co-authors is to say that this is causal. Like the rise of synthetic inputs and their intensive agriculture has basically caused, with some lag, the tremendous decrease in abundance of in bird abundance.
we are economists, and we know that this is basically a temporal correlation. So can we really infer from this temporal correlation like a causality that everybody infers? So in this paper, I'm going to try to answer 4 questions related to these increased use in synthetic inputs and the biodiversity loss. So the first question that we're going to try to answer, and I will argue that we will try to answer it indirectly, unfortunately, is whether synthetic inputs cause the biodiversity loss. Ecologists and agronomists have proposed clear mechanisms for why we would see the rise in synthetic inputs impact negatively biodiversity. There is the direct toxicity of some of these molecules. So pesticides have direct toxic effects on, for example, on birds. Pesticides, some of them are insecticides, so they are going to kill insects, and all of the birds and all the wildlife that feeds on insects or that feeds on species that feed on insects are going to suffer from that. In water, nitrogen and nitrate fertilize the river streams, generate algae bloom. The algae bloom are going, when the algae is decomposing, are going to deplete the water from all the oxygen, and that is very bad for the species. So we have clear mechanisms for why the relationship that I just showed you and that Chamberlain showed as a temporal correlation is plausibly causal. At the same time, there are also clear confounders. At the same time as agricultural synthetic inputs were on the rise, other stuff was happening in the farmland. Landscape changes. So one of the main landscape changes has been the destruction of hedgerows. Another is the increase of plot size and the uniformization of the plot crops, or the crops that are cropped. And that is also believed to be detrimental to biodiversity. Other changes have been happening over the Western countries. The urbanization has been increasing, artificialization of land with more roads. And at the same time, we might have also had the beginning of the consequences of climate change. So it's not completely clear that what I've just shown you is a causal relationship. Unfortunately, I'm not going to be able to answer this question directly because I don't have data that go far away enough before the rise of synthetic inputs, especially in biodiversity data. So the way I'm going to answer this question is I'm going to answer it by answering question 2, which is what happens if I decrease the use in synthetic inputs? Do I see a response in biodiversity? And this is not a completely super satisfactory way to answer this question, because if I say no here, that might still be yes here. So what I'm sure is that if I say yes here, I'm probably I have a lot of certainty that I can say yes here. But if I say no here, other stuff might have been happening that prevent biodiversity to restore after I stop using synthetic inputs. One thing that might be happening is what ecologists call points of no return or ecological death. That is, you have depleted so much biodiversity that even if you stop the human pressure on the environment doesn't respond. So we are going to start this project crossing our fingers that we see a response. Otherwise, the answer is going to be only to question 2, and I'm not going to be able to give you answer to question 1. Okay, so that is for ecologists. And now we want also to do economics. So one thing we are going to answer is, okay, there is probably a trade-off, right? I'm stopping using synthetic inputs. How much do I pay in terms of economic efficiency?
Biodiversity here meaning like abundance of birds or genetic diversity?
You will see, I'm using abundance and species richness. So we are going to look at it.
You will get both.
So we are going to try to estimate also how much we lose in terms of production and productivity when we stop using the synthetic inputs. Here, like the evidence we have is mostly correlational or comes from experimental plots. But farmers are not on experimental plots. They do a lot of substitution, right? And the correlations might go like might be played by spatial confounders. Maybe I stop using synthetic inputs in places where productivity of land is low, or on the contrary, right? And so I have clear spatial confounders when I do these comparisons. And the last question that is very important for us is whether I can stop using synthetic inputs by substitute them by using something else. So one thing that people think you can use is labor, so you can send people weeding out manually the fields instead of using herbicide. So I grew up on an organic farm, so my dad sent me to that. That's really painful, but you know, it's feasible. So that's one question. Another question is whether you can substitute, especially herbicide by mechanical, by machinery, by passing the tractor in the field to mechanically weed out the field. And that would yield to an increase in gasoline use. And there has been concerns in the literature that, for example, when you stop using synthetic inputs by converting to organic farming, you are going to increase gasoline use.
On the substitute point, is this a setting where birds are natural pesticides themselves? And so you might get knock-on effects where these pesticides kill birds and actually you're doing it.
Yeah, that's a great point. So we know now from Eyal Frank's work that these things can happen. I'm not going to have much to say on this here, but we clearly are thinking about how we might give things on that. So how we're going to try to answer these 4 questions is by using the expansion of organic farming in France as a natural experiment. So the expansion of organic farming in France, so first, why organic farming? Because organic farming is basically, by definition, stop using synthetic inputs. That's kind of the definition of what organic farming is. Of course, when organic farmers convert to organic farming, they might do other things at the same time, and that we are in the process of looking at that. So one of the things they might do is they might have also landscape changes, so preserve more hedgerows. They can also change a little bit the field, the plot size or the plot composition. So that is something is ongoing to check whether these mediators are capturing part or totality of the effect. So I acknowledge already that I prevent one question, but we are working on it. The second thing that I want to convince you of is that, like, France is a pretty cool setting to do what we want to do. You know, but you always have to say why you don't do that in the US. So a cool thing, a cool reason why, there are 4 reasons. So one is that France is actually one of the largest countries in the world that is like a big agricultural country, and that is a large share of organic farming that is increasing rapidly with very cool data on biodiversity. So these are the 4 reasons. For example, you could think that, like, France is not the first country, for example, in the world or in Europe in terms of the share of organic farming in the farmland, but we are second or third, depending on how you count. And the other countries are, I don't want to badmouth Spain, but it's slightly smaller in terms of agricultural importance. And another, for example, we are not also the first in terms of organic area in the world, but it's Australia, but Australia is a gigantic country. And the share of organic farmland in the farmland area is extremely small by comparison. So in France, we have had a rapid penetration of organic farming that reaches high levels. So that gives us a very interesting setting.
So I thought you would say that we call it organic vanity. So you are not going to fight it.
But
We look for problem.
Yeah, I'm looking for. We have this competition. So if you just the only thing I want you to keep from the literature is that, like, we are coming to the ecology to partly answer ecology questions. In ecology, so they are just starting at thinking about using this natural experiments method. So most of the evidence we have so far is coming from cross-sectional or temporal comparisons. So that's like So what happened in France starting in 2000 is there was a massive campaign of subsidizing the conversion to organic farming or being an organic farmer once you have converted. So this is the number of subsidies that people receive every year, and you see that it starts up around 2000 and even becomes much bigger in 2010. And after, I'm not for today, for the session today, I'm not going to use this huge increase here because you will see it takes time to build biodiversity. So this is mostly this part that I'm going to use. The second thing that is important is that the rise of organic farming is not uniform across space. And so, for example, in the Toulouse region where I come from, the share of conversion to organic farming is much higher. And actually, continuing to the debate, this region claims that it is the first organic farming region in Europe. They love to boast. And so you also see that Brittany, parts of Brittany are actually also highly converting to organic farming, whereas the Paris Basin, which is a highly agricultural region, has much less penetration of organic farming. You can also see that the penetration of organic farming changes very rapidly over space, which enables us, so I'm not going to show you that today, but we are in the process of doing that, to do like very fine-grained comparisons. And last, we have pretty cool data in France. So one thing that makes all of this possible is that we have the French breeding bird survey. It's not as cool as the UK breeding bird survey. So like here, I'm like yielding that there is a superior breeding bird survey, which started much earlier. But this one is like starting just at the beginning, just before the big wave of conversion to organic farming. And it has a lot of observations. And I will explain to you more about how it's the data that is collected. We also have excellent data on surface water quality. We know how these monitoring stations are related across space, and that is important because across river streams, there are diffusion effects of our treatments, and so we have to take into account the accumulated treatment along the river stream. We have good control, of course, and then for measuring the treatment, we have agricultural censuses. So this is also something we are working on. For now, that's what we are using. Every 10 years, the French administration goes to every person who is claiming to be a farmer and asks them how much organic farming they are doing among a lot of properties. And we are also lucky to have a very detailed accounting data, which contains values, but also quantities, which enable us to build yield measure on top of input use and profits, and also to build total factor productivity. So I'm going to show you two types let's say three types of results, but one set of results is going to be at the farm level. And that's the places where we are going to use to look at input use, yields, and the impact of conversion of organic farming on this. Conversion to organic farming is a staggered entry.
All right. A question about how biodiversity works in real life. Like, how important is it to have contiguous parcels convert at the same time? Or say you have a bunch of farms that have converted, but they're like interspersed with still non-organic. Is that different from if they're all in the same place?
Excellent point. So that is part of this thinking we are having about, like, connected to the question we just had before about how exactly the way conversion occurs impacts biodiversity. So we have, and I don't even have that here, so I can just give you that orally. We have some heterogeneity treatment effects for now, but we are working like hard on this, especially on like you're right, like is conversion occurring like in a contiguous area or not? How much of the conventional people are still around you? How much for a conventional person organic people are around them? All of that is something that we are investigating. So we have a staggered entry model. So we use the literature for staggered designs in Defendive. That's mainly what we are going to show you today. And so, like, here are the first results that we have. So here it's the Defendive event study estimates relative to the date of conversion that we have in the data. So here it's accounting data, and here it's spending on input use. In green, we have spending on fertilizers, and the most important one is nitrogen. In red, we are spending on pesticides, and in blue, we have spending on gasoline. So the first thing you see is that the date at which we know these guys are organic farmers, they decrease their input use slightly before. So that makes sense, because actually you need 2 years of being converted, but to sell your stuff as conventional before being considered organic. There are 2 painful years in which you cannot use your inputs, so synthetic inputs, but you cannot sell as organic. So people are kind of confused about exactly the date at which they are considered organic. So that's what we see here, slight anticipating. But if you go back sufficiently in time, we have this nice parallel trend. So what you see is that organic farming, like conversion, has a brutal effect on spending. So it's here, it's spending per hectare in euros. It's a 200 euro impact or 100 euro impact per hectare. So that's basically 100%, 80 to 100% decrease in synthetic input use. So that the first stage part of our regression, like that's taken care of. The second, the first interesting result we have is that these guys don't seem to substitute away by using more their tractors to weed out their fields. So that's the first result that was not in the literature so far to our knowledge. That's kind of controversial. It's like super surprising, but that's what it is. Second result, what happens to these guys when they stop using synthetic inputs? So this is the yield. We built an index for yields so that we combine all crops together. So the index is built by taking out the mean of the yield for the crop that year, dividing by the standard deviation. So these are units of standard deviation of yield. And you can see that there is a pretty brutal decrease of around 0.2 standard deviation. That decrease is pretty permanent, it's pretty long, and it's actually like not looking good at the end. It's not statistically significant at all, but something that is clear is that these guys are not regressing back to how they were before, which is something that people hoped would happen.
You have a measure of farm abandonment because I think
No.
some of these
Excellent. Yeah. Yeah, thanks so much. We'll think about that. To give you an idea of how big this is, if you put that in standard deviation of wheat, it's basically a 30% decrease in yield, which is like on the high end of the estimates existing in the literature. Data analysis nowadays say 15, 20. We find 30, so that's pretty large compared to the literature, which will mean that cross-sectional comparison tend to be underestimating the loss, which means that probably it's the highest productivity land that is converted to organic farming first.
The question is the pricing changing?
Yes, but this is quantities. Huh?
Yes.
So to summarize that, I'm sorry, I'm moving from per hectare to per farm, but big decrease in pesticide nitrogen expenditure, no change in fuel expenses. Another substitution that could happen, we are not very powerful here, so the zero is not super tight, but we do not see at least a huge increase in spending on labor. So there is not, the second substitution that we look at doesn't seem to materialize. These guys having price increases, so this is again an index, same way, so 0.14 of a standard deviation. It's not a pretty big increase. And so eventually, because price increase and subsidies increase, these guys, they earn more money. 5,000 euros per farm per year is pretty big for a farmer. I know, that is one. And what we don't see is reaction of total factor productivity. So that's kind of not so weird or not so surprising, but what we are working on at the moment is that it's a little bit unfair to measure TFP, including prices at the numerator, right? We have a price, we have an index measure of TFP. And so at the numerator, we have the price effect increases the value of the numerator. And so we believe that we should probably standardize our TFP by taking off this price effect. So that's something we are working on at the moment. Okay, so now for biodiversity. So we have this cool French breeding bird survey. So how does it work? So the National Museum of Natural History in France, they work with this organization of bird watchers. And these guys are like, they can detect birds just by listening to them, which is like very impressive. And so the way they do is like these voluntary people, they register into a registry and then they say, I live at this place. And then the National Museum of Natural History is going to select a random point, 10 kilometers around their house, and to tell them to go there. So that's an innovation they introduced in 2001, because before the guys went where they wanted, and so we were suspected bias in estimation. So here we have this very rigorous way of measuring the number of birds. They have to go there just after daybreak, 3 times in a row during the breeding season, and they have to go at the same place repeatedly over years. So we have a representative sample over here, which is very important. This has increased the number of listening positions and points where you measure biodiversity has increased over time, but that yields us a pretty large amount of observations. The way we measure treatment is we look at the increase of organic farming area over the total area in a given municipality. And we are going to focus on the change between 2000 and 2010. Unfortunately, like we would love to use the much larger change that has occurred between 2010 and 2020. This is work in progress, but as you will see, it takes a lot of time to do biodiversity. So for now, this is hard to observe late enough observations of biodiversity so that this is reflected in the biodiversity level. So for now, we are going to focus on the change in 2010. So these are all my municipalities. Here are my municipalities that are going to be my counterfactual. So they change their area or the proportion of organic farming in their total area by a very small amount. So that's why they are my counterfactual. All of the guys that decrease, I'm not going to consider. And then I'm going to compare these guys, the biodiversity in these guys, that stick to 0, to the biodiversity in these municipalities where the area increases of organic farming. I'm also going to split the data and to give you estimates for the parts where this increase is the largest.
It's a question, land use is increasing in the area?
So that's a good question. So no, in France, land use is pretty stable, slightly decreasing. But that's a good question. We should check at whether it stays homogeneous or not, where there is more organic farming. Say that again? No, birds are not increasing on farm, they are decreasing. So that is the area, sorry. This is the area of organic farming as the average proportion. Sorry, no, I did not explain. So this is the average proportion over time. So now I'm going to show you the birds. So like this is the average proportion of organic farming across all 36,000 municipalities in France, depending if you weight by area or not. And it moves from like small to like 0.2 percentage points. So it's still small, right? But that's as a proportion of farmland area, this is 12%, so that's much higher. And it has increased much more in the recent years, but that for now, today, I'm not going to show you the result. Same staggered DFND. And so now I'm going to show you results on abundance. So just the number of birds that I see, if they are all of the same species, I don't care. So what you see is that these things over around between before 2010, that's my date of treatment. And then starting after 2010, we see a slow but steady improvement in the number of birds you see. So you cannot read it, but that's 10 birds more here, which is around a 10% increase in the number of birds. If you focus on the places where there is more than 5% increase in organic area, so what we see is that the increase is larger, is twice as big, to 20 more birds. Now you might say, yeah, but you see all the same birds, so that's not very interesting in terms of biodiversity. So now I'm going to look at species richness, so that is just the number of species that I observe. If I observe 100 birds of the same species, I just count one. And here what happens is kind of the same thing. I hover around, and then after some time, I see one more species of birds on average on organic farmland. And then when I look at the 5% where the increase is the largest, I move to 2 more species. So again, around a 10% increase relative to the mean. This gets like ecologists super excited. So normally, if I was in an ecologist group, like I would not be jumping around everywhere, because this elasticity of how much I increase my biodiversity to how much I decrease my yield by stopping using synthetic inputs is key for them to decide whether you should do land sparing and land sharing. That is, whether you should decrease intensity of agriculture but crop everywhere, or whether you should be super intensive in some parts and do nothing in other parts. And if this ratio is above or below 1, directs that for us, right? For them. So the first time they saw this presentation, they were like, oh, you have clearly a ratio below 1, so you are in favor of the discount instead of the overcount. So they were like, so now we are working on that, because you should not compare these elasticities exactly like that. We have some work to do, because actually the change in area that we have in the yield equation and in the biodiversity equation is not the same. One is moving from 0 to 100%, and the other is moving from 0 to, let's say, 2% or 5%. So that's really different. So now we are working now that we learn that is very important for them, we are working on that. Okay, so I'm going to show you, like, I'm just going to comment that to finish, the results on water, because I find them super interesting and they were, like, at first very surprising for us. So the thing we find is that the more organic farming you have in the upstream of your measurement points, which you measure the concentration in nitrate, the less nitrate you have. So which means that organic farming is able to, by using less nitrogen, to have less nitrate in water. So that's yes, oh, cool. These are big impacts. This is around an 8 to 10% decrease. Again, this is to give you an idea. We have another paper on the nitrate directive. The nitrate directive covers 60% of the French farmland. Here you see it's 12%, and we have the same magnitude. So this is a big impact. But when you look at the impact of the nitrate directive, we have increased in the number of fish species, so increase in biodiversity in water. We have a decrease in chlorophyll, which measures eutrophication. And with organic farming, we see nothing. And we're like, oh, maybe it's because we don't have enough power, but it's like a surprising result. When we talk with ecologists and agronomists, they actually say, no, it makes a lot of sense. Because organic farming doesn't tackle phosphorus. Whereas nitrate directive, as a byproduct, decreases also phosphorus concentrations. And the reason is organic farming, the main reason for why there is phosphorus in rivers is because of animals, animal farming. And organic farming doesn't change the number of animals and doesn't change anything about how you manage nitrogen manure, animal manure. And what the ecologists are telling us, and the specialists of biodiversity in water, is that in continental waters, the limiting factor for biodiversity and for eutrophication is not nitrogen. It's phosphorus. So each time you increase phosphorus or you decrease phosphorus, you have a reaction immediately in terms of eutrophication and biodiversity, which we see in our other paper. Whereas if you don't touch it, then you're not going to have a restoration of biodiversity. And as a conclusion, I'm going to answer my 4 questions. So the first question, do synthetic inputs cause biodiversity loss? So I'm going to answer a yes, because I can answer a yes here. Remember, I was crossing my fingers. So I saw that birds respond to a decrease in synthetic inputs. What I find very interesting is that its response is not mechanical, right? We saw that for phosphorus and species water biodiversity, if you don't tackle the limiting factor, you are not going to see a response in biodiversity. Do yields decrease without synthetic inputs? Yes, and a lot. Is it possible to substitute synthetic inputs by other stuff? It doesn't seem that farmers are doing that. So that's where we are at the moment. Thanks so much.
So